What a stunning sunset. Feels magical here. How do you plan to tackle the next challenge?
Thank you very much for joining me on another episode of Chat with Traders podcast. On this particular episode, I have with me Mark Gardner. Mark's someone who began working in the field at just 17 years old, straight out of high school. Initially, he began with back office duties before breaking on the floor of the Sydney Futures Exchange, or SFE. Then later, he was picked up by a very large bank bills trader to exclusively execute trades, and he learned a great deal from this particular trader. Around 2005, Mark began trading his own book. Over the 10 years that followed, Mark had only 2 losing months, and to date, he's never encountered a losing year. Though in 2015, he did suffer a substantial blow, losing months and months worth of gains in the space of just a few short hours, which you'll hear more about during the episode. Today, Mark is also a partner and the chairman of Genesis Trading, one of the larger prop firms in Australia, and he's also leading a new venture, 42 Trading, as a foray into quantitative trading, which currently consists of himself and a couple others. Also worthwhile of a mention is that Mark is the president of the Australian Securities Traders Association too. Now, throughout this episode, we speak about Mark's insane work ethic, and no, that's no exaggeration. We also get into lessons from his past, why he sees a future in quantitative trading, and plenty more. Here is my interview with Mark Gardner. Now, Mark, listeners won't know this, but we were actually supposed to record this episode about 24 hours ago. So I jumped onto Skype. I was hanging around waiting for you, and you sent me a message a couple hours later to say that you'd just kind of woken up, and it was about 4:30 p.m. in the afternoon, and you told me you'd just wrapped up a 50-hour or somewhere around 50-hour stint. I mean, what's the deal?
Essentially, it's a rollover period in the Australian market, which is a fairly profitable period for me generally in the past, and there's a lot of opportunity over that period, and I'm sort of trying to wrap up for basically one of my first sort of extended 3-week break from the market in terms of switching the screens off and actually going and spending a lot of some dedicated time on the other projects. So there was a sense of urgency in terms of trying to tie things up towards the end of the week. But I've got 4 children, which gave me a good boot camp in sleep deprivation anyway. But I tend to I'll do stints, as opposed to, if the market's good, I'll keep going, and then I'll I'll conversely have a long sleep afterwards instead. So it's just a different routine. That's an extreme example, but I have a strike system where sort of laminated poster on the wall, which if I make 3 mistakes, errors, or any sort of poor judgment, and even including things if I miss a trade or I'm starting to drop in terms of sharpness, or once I've got three strikes, I basically wrap up immediately and go. So, but I'll try and sort of ride a hot streak if I can, particularly when it's busy. So I've been in front of the screens for 20 years, and my autopilot tends to be pretty solid in terms of instinctive trading. So it's not something it's not pleasurable by any means. It's not something I really want to be doing,
So these periods during rollover, these are like prime time opportunity for you?
Traditionally, it has been. In the last 4 quarters, my performance has actually dropped, and it's mainly technology-based in forms of stops and things. But in doing the analytics, there's a certain period where it started to become diminishing returns for me. But obviously, with interest rate markets and having to move positions further out the curve, or having to roll 3-year and 10-year bond positions, it is the largest collection of traders who don't normally trade the market. They're the people who are on different time frames who aren't necessarily tick sensitive. So you can get someone who doesn't normally trade our market, who just wants to roll their position and get out. So you can. I've always been a relative value trader generally, so you can take advantage of those short-term aberrations where which have been basically forced by people having to move their positions to the next contract. So,
and how often is the rollover?
It's every quarter in Australia, and it varies in length. Sometimes it'll be a short period of time, maybe 4 days. It's a FIFO market here, like first in, first out queue position sort of thing. So, given that I've basically been a screen trader for 20 years and have a fairly niche knowledge of the market, it's a good time to sort of take it's an edge that I have because of my experience.
Okay, so I probably should have asked you this prior to asking that last question, but just so everyone is clear on this, what markets are you actually predominantly trading?
Short-term interest rate. So I used to trade Australian sort of bank bills in sort of butterfly or double butterfly structures. So essentially, they're fairly non-directional, and they're taking advantage of a price aberration over long periods of time. So you generally use 6 to maximum 8 point range in these strategies, but they're very much multi-legged. So they're fairly stable. So you do them in larger size, but there's been I've sort of moved away from that in the last year and a half. The ranges have started to compact a little bit, and realistically, Australia was pretty late to the party in terms of having HFT and computerised and algorithmic trading come into our market, because we're 1 basis point to a point, as opposed to, say, bonds might be 7 or 8. I think 10-year notes are 2.5 or thereabouts. So the cost of execution is too great in terms of fill risk. So whereas in the markets that have got smaller increments, the systematic trading tends to do a lot better, because it reduces the amount of risk if you have to take another point or if you miss a stop. So we've kind of been insulated somewhat, but there's a definite there's been a definite increase in that sort of computerised execution and trading coming in the last 18 months, and I sort of made the decision to move to more sort of quantitative and statistical based trading in line with what was the people that I'm competing against. So
yeah, I mean, that's something I definitely want to speak to you about. So as we've kind of already touched on your work ethic, I actually just want to go into that a lot more, and then let's get more into your trading, because I'm very impressed by it. I don't know if it's something that I particularly want to try and adapt for myself, and I don't know if it's something that others should necessarily adapt for themselves.
It's not something that's necessarily I enjoy adapting to my trading either. So it's not an ideal thing, and lifestyle-wise, obviously not the greatest thing either.
Have you always had this kind of work ethic, like the willingness to put in such long hours and like excessively long stints behind the computer? Is that something that you've had kind of since day one when you were starting out trading, or is it kind of just evolved?
My parents sort of fairly blue collar, worked 7 days a week, and I guess it wasn't really I just had that was just what we did, and I didn't I never really realised that people went on holiday. My father, I think, went 13 years straight or something without a sick day or a leave day or something ridiculous. So it's just an example set by my parents were very hardworking, and then I actually enjoy what I do. As difficult it is, and sometimes psychologically debilitating or tough it can be, I still enjoy trying to work it out, and it's also, I'm not exactly, after 21 years, I'm not I've seen the life cycle of traders, because I've only generally worked at smaller shops or prop shops or but used to call locals on the floor, where it's been all individual traders, and there's very few that make it into their mid to late 40s. Or beyond. I mean, there's a few that do, but it's not the average. So it sort of is a trying to take advantage of squeezing the last blood out of the stone in terms of what I perceive as the winds of change, and with my edge, like my execution, my legging skills, and things like that have been extraordinarily good over the years. But I'm slowly seeing that edge disappear, and I'm trying to manage my own trading, whilst also I've got a team of young guys who I'm developing the more systematic stuff with. So it's really the 50-hour shift thing. That's an absolute rarity. But I'm almost doing 2 jobs at the moment, but that's what I have to do to manage the transition, and it really. Yeah, I'm not particularly bothered by it. I enjoy work, and it's not really a chore in terms of I'm trying to work out the next phase and things like that. And yeah, it's not a big deal to me, but it's I get a little lectures about it, but. Yeah, it's definitely not for everyone though. Realistically, a lot of young guys who've come up who's traded next to me, I'm very wary of that sort of 3-strike rule, particularly for them, like their decision-making process, because old bull syndrome where they're trying to keep up and they don't have the hardwired experience just to go on autopilot, or they also haven't been through 4 babies in the house keeping you up all night either. So it's more something you get used to.
Okay, now speak to us about this autopilot. How you describe this as autopilot, because I know a good friend of yours, Darren Reed, who was recently on the podcast also. I told him that I was going to be interviewing you, and this is actually one of the things he told or suggested that might be good to ask you about, is like, you've described your trading to him as though you go on autopilot at times when you put in these long hours. How are you able to do that, and where does that come from? Like, what do you mean when you're trading on autopilot?
Basically, because it's a more of a high volume, low range sort of scenario. It's very much I'm mindful of even how I've set up my screens in terms of fields of vision, like all the most important things and all the possible cheats in looking at the market, and conditional formatting on spreadsheets and things to give me visual triggers to do a trade very swiftly, and making sure that I have things in the same spots. And I essentially have, 21 years. I think we worked it out the other night. It's like 80,000 hours plus sitting in front of screens. So it's just time more than anything else. And it's almost like the same about a gamer, what might be reflexes or pattern recognition. I've got to say similar charts. I've had the similar quote spreadsheet set up that I look at the entire strip, and then I've got the same charts next to those, and then those have been in the same position on my screens for 15 years, essentially, in slightly different variations. But that consistency of being able to see things out of the corner of my eye, and then that's in the center of my vision field, and then I'll go further out to for things that are more that are sort of secondary importance, like it might be currencies, or if we're trading on the back of crude or gold or whatever, and then those charts and those indicators will be that further out, and then all my longer term stuff, 2-year charts and things like that on certain sort of structures will be on peripheral screens. So basically everything's within reach if I need to, and then it's the consistency of having the same market basically in the same charts. The level of pattern recognition essentially has become fairly instinctive.
Okay, that's really incredible to hear that you've worked out like an approximate of how many hours you've put in over the last 15, 20 years. 80,000 hours. That's a lot of screen time.
Yeah. I don't hold out too much hope for my vision in my 60s, but
What are some of the things you've done to try and avoid burnout? Like, is there anything you've consciously done?
Not particularly. I find I've got an active mind, so I've tried things like meditation courses and etc. And it sort of it has almost a reverse effect. Like if I'm stimulated, I'm fairly relaxed, and as long as I'm spending time with allocate time for my family and doing things with my daughters, and it's not I don't feel comfortable sitting on a beach or reading a book. Like I'm actually enjoy being stimulated and learning new things. So it's not a burnout factor for me. And I'm working for myself, so it's not. There's motivation, obviously. If I was working, I obviously wouldn't be working anywhere near these hours if I was working for someone. So there's a motivation there to be innovative and try to find new things and improve my trading and basically find new ways. If you enjoy it, or I wouldn't say love it, but if if you feel as though it stimulates you and it's engaging you, then I think burnout's much less of a factor for me. So, but if I had to do a very repetitive job, and I was working for someone else, and there was, on a career path, then I would certainly be very susceptible to burnout. So, it's not. It's more the fact that I'm lucky that I found something that it suits my personality in a way.
Now, I know you said a little earlier that these 50-hour stints is not something that you do too frequently, but especially around rollover periods, it is something that you do. And Tony, one of the guys who works for you, he actually made me aware of you. He reached out, he listens to the podcast, and he suggested that you'd be someone worthwhile speaking to. And he told me he's seen you trade for like 3 days straight once. How do you actually stay awake for this long?
I think 3 days straight's an exaggeration. And he goes home and I get naps, So, power naps essentially. So I guess the story doesn't really fit the reality in a way. But as much as you're focusing on it, it is definitely not something that most people can do, nor would I recommend it. It's not basically due to the intense repetition over such a long period of time that I can do. But it is like I'm not. It's definitely not something that I would steer people towards. I tend to potentially not use my time efficiently sometimes, but then I also will take I'll take a day off during the week quite regularly after I've done a long stint. So it's not something I tend to wear as a badge of honour. I'll use it sometimes for motivation to the mentees that I'll speak to or whatever, but nothing more than to get them to sort of harden up a little bit. But I wouldn't say that it's necessarily I wouldn't call it my greatest attribute. It's having the ability to basically almost mindlessly just repetitively execute. It is basically, it's just hours and it's experience and you just get, it's almost like a fitness. You just get used to it. And like I said, then I've got a system for my concentration breaks and things to make sure that I don't take it too far, which is born out of pushing it too far.
Yeah. That system of yours where if you make 3 reasonable errors, I shouldn't call them reasonable errors, but if you make 3 errors, then you call it quits for the day or for that session. Even if someone who's listening to this isn't trading for long periods like you do from time to time, do you think that might be something worthwhile adapting for themselves, like maybe a day trader?
Yeah, it's much more mistakes. Like even if I miss something, even the smallest of trades, like if it's basically 3 almost drops in standard. It's not. They're definitely not errors. It's most. If I miss a trade that I know that I would have normally got, or if I if I miscalculate something, or if I scratch a trade I shouldn't have scratched, or it's a really tight, high standard of things because it's such an efficient. The market's so efficient these days, and it's like you're competing against and the best people in Australia, in our market. So you can't really afford to be half-assed. So it's definitely something you could adapt to, a day trading thing, because I think you probably would, for a day trader, I think you'd probably extend the time frame depending on how long the time frame is for your trading. So just setting yourself a standards essentially, and having a rules where it triggers a point of review or a point of not necessarily stopping, a point where you have to step away. I think is a very good idea, because there's a definite tendency I've noticed with particularly intense professional traders is that you work harder when you're doing badly, and you tend to work less when you're doing well, which if you think about it, it's quite insane, because in a period where you're statistically doing worse, why would you put yourself in front of the screen more? And but having those rules preset to try and avoid overworking when you're not seeing it, or the market conditions don't suit you, or getting lazy because things are going well when you should be actually probably putting your foot on the gas and taking advantage of a period where you're doing really well. I think is really important, and it's a very common thing that happens to a lot of traders, that whole reverse hours to success rate. So
yeah, I really like that idea. I mean, it's such a simple rule, but it could be also very effective. And I'm sure it's probably saved you a lot of money over the years.
Yeah, but it's really important to set it in a neutral state. Like a lot of people will go and a lot of guys I've met, they'll, you have a bad day and you go and set a whole new bunch of rules, and you tend to do that in a negative frame of mind. And even I sort of fixed up someone sent me through a listed process rules the other night, and red heading, and it was all about don't not, and it's not because you're angry about the fact that you've lost. And so just even changing a more passive colour to the text and making the points a bit more constructive, because the next time you need them, you don't need a piece of paper on the wall that's effectively barking at you because you're already under the pump. It would make you feel worse. So I think it's really important to do it, set these rules in a neutral mindset and not as a reactive measure. So, and people generally are sensible enough to know what to do. I think where people become emotionally unstuck is that it's just the assumption that I'm sensible, but you're always. I think Mike Tyson had a great line that, everyone's got a great plan for the fight until they step in the ring and get hit. And when you're basically trying to compensate for periods where you're not in your best frame of mind, it's best not to make a plan when you're in that mode. And also try to keep positive in terms of the rules, because you tend to lean on them when it's a bad period, and you need that little bit of positive light to help you, just drag you out of a bad psychological state. So it's words like don't do this, I don't think are very helpful.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Well, Mark, kind of skipped over this at the start. I normally open the interview by talking about this, but no harm switching the order up. So tell us a little bit about how you actually got into trading, because we haven't heard much about your backstory. So I think you got into trading or financial markets at least straight out of high school. I think you're about 17 years old. Tell us about how you got your start. I mean, we won't spend too much time on this, but just for a bit of context, it'd be interesting to hear your backstory.
Essentially, in Australia, in your last year of high school, you have to do work experience, and it was just a family connection who knew someone who worked on the trading floor, and at 14 years of age, I walked down onto the floor and had to collect the chits, the dockets that all the traders wrote on, and it's very much a case of being in awe of the bright lights, and I went, this is absolutely what I'm going to do. So I literally went back every 3 to 6 months, like in the school holidays for the next few years, because I was not necessarily obsessed, but just enthralled. everyone always has romanticizes the floor because it's exciting, it's chaotic, and it's fairly intriguing to most people. Then as a 15-year-old kid, you're just like, wow. So, and then I literally 5 days after my last exam, I'm obviously I got a job with the company that I'd done continuous work experience or short stint internships, I guess you could call it. Yeah, and started 5 days after my last high school exam, and I think I was just 17 and 3 months old or something like that. So it was. I think I got my broking license before I could buy a beer. So it was strange that I could advise on futures and not buy alcohol, but.
I think that says a lot that you were doing work experience, because I did a stint of work experience when I was still in school. And I remember when school holidays came up, I told them I couldn't come in because it was school holidays and I didn't want to be going in doing work experience. But sounds like for you, work experience was unpaid and you were still willing to go there during your school holidays. Did I catch that right?
Yeah. It was something I definitely wanted to do. And I grew up in a small country town and the options were generally like fairly limited in terms of having to stay up there. And I wouldn't say I'm the most studious person. I have a very large thirst for knowledge, but I don't like reading. So I do a lot of audio books and things like that. But so university wasn't really difficult to do a degree when you don't like books. Okay,
so when you turned 17 and you got this job after school, what actually was that job doing? Were you working on the exchange floor or were you doing something else?
Initially, I was just, it was mailroom. It was the time before email, so I still had to fold statements into envelopes for the clients and run errands and be a runner down to the floor occasionally. And then probably about 6 months in, because I had one of the old MS-DOS computers, and when I was younger, we were, the market was it was about 96, I think. So they were moving towards screen trading, and I was very quick on the keyboard. So I essentially ended up just gradually drifting into the overnight broking department of the company, and I was cheap and took a lot of orders and with no errors. So that's where I ended up being. So, and in those days, guys would come off the floor and be trading at night time. So no one had their own terminals. And so as a broker in those days, you actually took quite a large number of orders because no one could self-execute. So
I believe it at some point after, I'm not sure how long you kept this up for, but at some point, a fairly big trader, I'm not sure exactly what this man traded, but he came along and sort of scooped you up and you started working for him. Can you tell us a little bit about how that played out?
Essentially, I was executing for this guy on a broking desk on a give up basis, and we basically did a deal on exclusivity, and I worked for him, him and him only. He traded that's where I learned a fair bit of methodology of what I do. It's the same market, slightly different. Over time I've sort of developed my own style, but it's short-term interest rate, Australian market, bank bills, 3-year bonds, and things like that. So he's very, very tough, strict, which was very good for me because being instantly successful at being quick on the keyboard at a young age bred a certain arrogance, I suppose, and he set the standard somewhat higher again. It was very difficult working for him, but if I had my time again, I'd do it. I'd do it again because it really taught me about basically you can't ever let your process drop. You can't ever drop your standards. You can't ever, we'd make money in the morning and we'd miss a small trade in the afternoon, and he'd be furious, and he's like, well, you can't base inefficiency just because we did well this morning doesn't mean you've got an excuse to miss that, no matter how much it is. Like it's an uncompromising set of standards, which I've sort of has held me in very good stead, I think, in future really. So but albeit very very tough, but it was something I think I needed.
Yeah, I mean, obviously looking back on it now, it seems like something that was very beneficial. At the time, I mean, how did you take it?
I did a lot of running, and basically, and I guess I didn't. I maybe in my heart of hearts, I knew that I probably needed a little bit of that it was going to be beneficial down the line. I don't really know, but it was because it was a high set of standards. He was a very good bloke, and he looked after me. But it was the unpleasant nature of it was not malicious. It was just watching someone with consistent, significant hunger. It was in hindsight, being yelled at was unpleasant, but it was it was also fairly inspirational because it was relentless, which was pretty impressive to watch.
What were some of the standards? Like, obviously, not missing trades and not missing opportunities. I mean, are there any other standards besides what we've already sort of spoken about?
It was concentration primarily, and essentially always performing at peak level. There's when there was time off. Have a lunch or something, and that was. But when you're at work, it was like, I guess it was almost like an elite sportsman in a way. Like if we're here, we're doing this like at 1,000%, and there can be no mistakes. And so it was from anything from just process of managing my book, developing. It was as in his order book. Developing spreadsheets or ways to better represent positions so we could do it faster than the rest of the market. Making sure that I had was keeping an eye on news, having a routine in the morning where he knew what was coming out, and I was always over economic releases. And I guess in a way, the greatness was doing. They often say greatness is doing a lot of small things really well. And it was the little things. There was no significant. The trade strategy in itself wasn't particularly complicated, but it was the level in which we executed that was our difference. And I think everyone's well aware of the failure rates within trading futures or general day trading. It's if you compare it to say elite sport, like you can't expect to win a marathon if you don't train. Like it's time put in for what you take out in terms of if you want to operate at that elite level. If you want to be in the top 10 or 5% or 2%, then you basically have to do what other people aren't willing to do. And you can't really describe it as a job or a hobby because in my experience, that's not really but that's to say that's my experience though. If anyone can, I can please give them my phone number. But it is a zero-sum game, and it's tough. The top 10% will always eat the bottom 90%, no matter what. So you just got to make it. You got to make sure that you're in that top part. You got to be doing the things that they do, or setting the standards, or at least having a point of difference that puts you into that elite category, really. So
yeah. So how long did you work with this trader before going out onto your own to trade your own book?
It was about 4 or 5 years maybe, and he decided to have a break, and he moved offshore. And essentially, I mean, as much as I wanted to trade, I was very conservative, and I kind of didn't have the gumption to go. So I was actually almost. When he was moving, he said, "Well, I don't have a job for you, but you can trade for me." And so I was almost, I'm not forced because I would have found a job broking, but I was pushed, and I'm very glad I did. In hindsight, I should have done it much earlier. It was certainly not I wouldn't call myself a very risk hungry person, and especially at that stage. So it was not exactly a glorious story in terms of how it started, but that sort of conservative nature and not necessarily fear, but risk aversion is probably what kept me so consistent over the following sort of 10 years. So
yeah, well, talk to us about that. Like how did you go once you actually went out on your own and you were trading your own book? I mean, what were those first couple of years like for you?
Because it had the background and I've been working with a very good trader, my execution and those small things were already sort of taken care of. Like I had a 10-year apprenticeship really, so it went very well. I think I really only had maybe 2 to 3 losing months in the first 10 years that I traded. So I was just always very consistent. That was doing those, but also not knocking it out of the park either. Like I wasn't being slightly risk averse. also has the downside. Whilst you don't take the big hits, you're not going to get the big wins either generally. So, but gradually towards it's probably about 3 or 4 years ago, the penny dropped, and I had a foundation of capital behind me where I could take on bigger positions and risk, and I became confident and was able to psychologically handle those swings. So the first, obviously in 2005, I think I started trading for myself, and whilst into the credit crisis, which was a disaster in terms of liquidity for these bank bill and 3-year markets. So I had to change methodology there, and then going to the GFC, so volumes dropped, and the same thing and then gradually built up to 2013 through 2015 in a much more mean reverting range bound market, which and size just very exponentially increased. So by 1,000% sort of thing. So, but that also led to because I lost the risk aversion but I had the consistency in the track record, it sort of led to a bit of a sense of arrogance, basically, which led to my first significant hit, which I thoroughly deserved, because I started to get a bit of an assumption that I don't lose. And as soon as you start thinking that, and there's consequences.
Okay, well, let's talk about this a little bit. Just going off something Tony had mentioned to me when he first reached out, he said, and I just want listeners to understand how consistent you were leading up to this point. You only had 2 losing months. I mean, you can correct me if this is not true.
It'd be in the first decade, it'd be 2 to 3 losing months, and they were minimal.
So what happened in 2015? What went wrong there?
Essentially, I was a situation in the market probably 3 months prior, and I had been doing very well, coming off of my best year ever, and I took someone on in the market, and I got lucky, basically. Well, I didn't get lucky, but I won, and I think that definitely created a bit of a God complex, I guess, in a way, and which kind of set me up for the next time, which was in March, 2015. Where that probably made the fall in March significantly worse. It was that constant run, and I also I'm a very goal oriented person, and I sort of started to feel like I'd achieved. I'd become a partner and taken over a prop shop that I was at, and I'd started the Trade Association, and that was going in Australia, and that was going well, and I'd achieved the things I'd sort of set out to achieve, and without, I don't think I realised until after the significance of not having a goal was, not only was it fairly hollow, the dream's much better than the maintenance of a dream. So I think I wasn't necessarily boredom, but a lack of direction, and that combined with arrogance, and I just took on a position far too large for the market conditions, and because I was essentially, I hadn't had any major hits before. Like, even our risk was it's the risk department sort of thing was it had never happened before. Basically, I mean, obviously there's delta loss limits and all those sorts of things, but it was just the thought that it wouldn't happen to me or didn't apply to me, and which made it a lot worse. And it was half a year, 6 to 7 months of a medium to good year lost in 4 hours. And it's kind of, because I'd never really lost before, it actually hit me probably a lot harder than it would even an amateur trader. It's because I'd never had to deal with the situation before, and so I just was very ill-equipped.
So how did this trade go so wrong? You said you took on a very big position, but to lose, I think you said 6 to 7 months of a good year's profit in just a couple hours. I mean, were there any other factors that played a part in this?
I don't want to sound like I'm making excuses for it, but there were triggers. But at the end of the day, the responsibility lay with me for the fact that I should have removed myself from the situation. But there was, I had a blackout at my house, and I lost the first, probably 20% of the evening, basically because I couldn't call out. It was a lightning strike, and mobile towers went out, so I'd lost a significant amount of money with not being able to cancel my orders. But I didn't calm myself down when I came back on and got everything back up and running. And, it was just a perfect storm of bad personality traits. So immediately chasing, getting very angry, and thinking that I'm usually quite good. I'm quite good at hedging my way out of trouble or whatever. And I just essentially tried to fix it all in too short a period of time in a bad headspace. And, then the position gets too large, and then it was large enough that there wasn't enough liquidity generally for me to get out. It was a rollover period as well, where the correlations tend to very much decouple. So all of my normal hedges didn't exist. So I ended up with an outright position, which I wasn't an outright trader. Like generally, I was a relative value trader. So it just snowballed, but it could have very well easily been solved by if I had someone say calm down I let my headspace. Usually, I'm 99.9% of the time I'm very level and very calm. So it's almost like stress thresholds for the average person are, say they're 20, an inch wide, for instance. But because people, with a normal stress threshold, will regularly have not a freak out, but they'll regularly experience points of where things overwhelm them. But there's a disadvantage as well, being having a broad stress threshold, because the irregularity at which you actually break means that you're actually far less capacity to deal with it. So it's like a breakout and a standard deviation breakouts, and in trades and tech, it was like once it gets through the point where it hasn't normally gotten to, there's a lot of bad stops. So I should have had the experience or the maturity enough to walk away, but I did the opposite. So that's what I mean. But in terms of the situation surrounding it, is that I don't generally like to talk about the beginning of the situation that night, because that happens. Things will always happen to you that you can't avoid. I really feel the need to take complete ownership of the fact that wasn't the reason.
Yeah. So let me ask you, I guess, two things. Have you done anything to sort of safeguard yourself in the event that something like this happens again, in terms of like blackout, or you don't have access to power?
Yeah, I've got two UPSs and sitting in my screens in here, and I've got a petrol generator that'll run me for 30 hours. So,
okay, and so you got those installed after this for this particular reason?
Yeah, basically. So, and it really led me to really tighten up my redundancy measures. So, in terms of I got a secondary system in case my system went down. We were two separate brokers, and I got I plug in the handset phones, the normal house phones. They don't need electricity, so I actually had to go and try and find one of those, which was quite difficult and basically make myself a little bit more bulletproof. And even to the point of I had a system failure a few days ago, but I have a secondary computer with everything very loaded on it that I can literally all I got to do is switch the screens, and I'm back up. So I mean, that's not probably measures that anyone below a day trader would necessarily need, but if you sort of think about it, like a redundancy package, which I'm actually looking at putting together, not necessarily as a business, because the volume wouldn't be good enough, but just if you spend $1,200, you can possibly avoid a $5, $10, $15, $20,000 incident. And I think it's something that a lot of people overlook, is that it seems like a lot of money at the time, but it's definitely having it happen to me, probably a similar situation has happened 3 times. That it's sort of money well spent, really.
Insurance worthwhile having.
Yeah, it's when you buy insurance for your house or your car. So it's a one-off insurance policy, I suppose.
Yeah, and it's probably tax deductible.
Yeah, exactly.
Another thing I was going to ask you, how did you... Okay, so let's fast forward to the following day or the next couple days. How did you move forward from this? Like, you'd just taken the biggest hit in your career. Like you said, you weren't in a good space. How did you handle this event in the coming days, moving forward? And how long did it actually take you to recover from this loss?
Immediately, actually, that little bit of arrogance or self-confidence or whatever you want to call it, I made a lot back very quickly, like the following day. And it wasn't really till the weekend when I just sort of got to, just sit down and take stock when the gravity of it hit me. So that was kind of when, and also when you go from being Mr. Consistent and people, you start to doubt you. I had having your first discussion with risk, in your career sort of thing. Like, it did rattle me a little bit, and it probably took it was about 6 months, maybe 5.5 months, 6 months to make it back in full. But there was definitely an inconsistency in my trading, which had never been there before, because there was I couldn't balance the being a very confident trader and also trying to get back to being a little bit more respectful of risk management. So it took me a while to find the balance, and it was the first time I really had probably two voices in my head instead of knowing what I needed to do. I think I had, up until that was the point where I had the 3 losing months or two. I think I had maybe 2 or 3 losing months over the next 6. So it definitely affected me, but it also, realistically, strangely to say, was probably one of the better things that happened to me, because there was a complacency in my strategy. Things were going well, so I wasn't looking elsewhere for ways to improve and develop. And I basically I started to learn how to safeguard myself. So I put in place a routine for when I have a bad day. I now feel equipped to cope with it, and not in the sense of I'll be right because I've been doing this forever. It's much more of a reflective and regaining your respect for the market a little bit. So
sure. Okay, Mark. Well, we're getting on a little bit, but there's still one thing I'd really like to speak with you about, and you've kind of hinted at this a little bit earlier. You said that you feel that your edge in the market has gotten smaller over the past 15 years, and more recently you've been getting into more quantitative methods of trading, pursuing more systematic strategies. How come? I want to ask you that. I mean, is it just because you feel your edge or the particular way that you've been trading is getting tougher? What's the attraction to these quantitative methods of trading?
It's definitely it is a tougher market, but I would generally find a way. It's a desire to be a much broader scope of strategies, more scalable strategies. But I guess what it comes down to is that who I'm competing against now is people who run systematic and quantitative strategies. Primarily, it used to be trader on trader generally, and I guess the critical mass of volume and reaction were human beings, and that's changed. And I'm not up against one guy sitting in a terminal now. I'm up against a team of an actuary, a mathematician, or a coder, and a coder and quant, and looking for probably significantly less return on capital than over a broader amount of contracts over 3 shifts instead of a human being can do like one or two shifts a day tops in one market. Like a quant strategy can do can trade 20 markets, 3 shifts a day, and they don't get tired, they don't get emotional. I just realised that the rules had changed, the competition had changed, and so I had to learn the new playbook. I had to improve myself and know and really adapt to my methodology to who I'm competing against, because as I keep saying, it's a zero-sum game. So you've got to be better than the best people, and now those sets of teams are sort of not necessarily dominating, but they've taken advantage of the inefficiencies of human traders, and that's why there's been a large level of attrition.
So how have you gone about approaching this? Because your last 15 years you've been primarily a discretionary trader. I think that's fairly accurate to say, yeah.
Yeah, absolutely, yeah.
So how have you approached this kind of new way of doing things?
There's quite a good article that I read recently that explained much more concisely than I'm probably going to put it now. I think there's a very distinct gap in both intuitive traders and logical traders or logical strategies. because they both need to be very good. Though I think they both need each other. But I mean, have you ever seen an IT guy and a trader try and have a conversation? It's quite interesting because they don't have a level of respect for each other's expertise. So maths guys will always stick to the maths, and the traders will have more of an intuitive based, adaptive unconscious, I think they call it. I mean, I don't like using the word gut feel because I think it really discredits the intuitive skill that a discretionary trader has, or a successful discretionary trader has. But abstract, the use of abstract reasoning, pattern recognition, which is just the reason I can't explain it is because it's an unconscious absorption over many hours in front of the screen. But the mathematical strategy style trading shops or trading groups, they don't have. I'm trying to, with the two, I've got two young guys working for me, and this is going to sound strange, but specifically with no previous experience in the particular field. But obviously, Tony has he's got a very strong background in maths, and Michael's he's very much more that abstract or creative side. So, and I'm essentially trying to avoid doing what everyone else has done in that space and try and marry up the two forms of thinking, because I really think that there's a definite advantage for a human trader with the efficiency of an algorithm or an algorithmic team or a mathematical team or statistics would be quite a sight to behold, I think. And until I get to a point where I'm stuck, I'm really trying to avoid bringing someone into, because I don't want to blinker or reduce the scope of looking in areas that we looking at areas that we haven't, that other people haven't looked in before, like that, but really avoiding that, using the confirmation bias or similarity bias. Like, people tend to gravitate towards things that are similar and things that back up their argument. So, and it's a great book, the new book by Michael Lewis. It's The Undoing Project, and the first chapter is very much about. He found in Moneyball that the scouts, when they were in the draft, they, no matter how much they said they were being unbiased, they went through and basically proved that they were. The first impression was always. Was always made. They were always made on terms of, like, they tended to like players that were that used to play like them, or they on a race point of view, basketball. That was the example they were using. There was never an Indian player in the NBA, so the people had tried, they just wouldn't get picked out of. When in fact their statistics were comparable, if not better. But it's a great insight into the human brain. Subconsciously makes a lot of decisions, and those biases the mathematical and algorithmic side can fix, but the creativity side, realistically, only a human can do, because it's the amount of complex calculations and the swiftness of being adaptive that I think could complement each other. So.
Yeah, I think that movie, or even the book, I haven't read the book, but I've watched the movie. Moneyball is a must-watch for every trader, for sure.
Yeah, it's just, I really try to make an effort to push myself to not surround myself with people, not necessarily people of like mind, but I try to challenge myself to talk to people who, do something different to me, and not in a dismissive way, but just to try and get a different outlook. Particularly, like, a lot of people, I've noticed a lot of locals or prop traders, if they're having a bad run, they'll always cuddle up to someone who's having a bad run too. So it's almost it's okay because everyone else is having a bad run too. But whereas I sort of try and do the opposite. Well, if I'm having a particularly poor run, I'll really try and force myself, and as much as it can be painful, to someone who's doing really well, because I see it as a way, like, you can learn what to do to change, or at least you're gonna hopefully pull in some of that positivity.
Absolutely, very good, Mark. Well, let's leave it at that for now. I know you don't really have much in the way of like an online presence or online profile. Is there anything you want to mention, like if someone wants to get in touch with you or find out more about you? I think you're probably on LinkedIn or something like that.
Yeah, I mean, I've got LinkedIn, and I've got at 42 Trading is a Twitter, and I've got a sort of bit of software, dualmouse.com, which is a dual cursor product for sort of designed for for traders, essentially, to be able to be collaborative and system share and things like that. So,
what's the link for that?
Dualmouse.com, dualmouse.com.
Okay, excellent. And at 42 Trading on Twitter. Yep, cool.
Yeah, no problems.
All right, Mark. Well, let me just say thank you very much for doing this. I've enjoyed speaking to you, so thanks a lot. I appreciate it.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's good, everyone? I trust you're having a nice week. Thank you for joining me once again. This episode is number 133, and I would like to introduce to you James King. Up until recently, James was the performance director at a commodity trading firm in London, Mandara Capital. And it was here that he implemented scientific methods to stack probability in the favor of success of their traders by using techniques he learned from his education in applied sports science and performance psychology. Now, James is setting out on a new venture, one which aims to support talented retail traders with extra capital and other beneficial resources. You can find out more about this at projectthor.co.uk, and we discuss it briefly at the end also. But for the most part, we discuss principles for success, testing for resilience, ensuring you're motivated and focusing on the right things, how stretch goals can be used to massively multiply results, routines, and heaps more. There's a lot packed into this episode, but my suggestion would be make a real effort to take just 1 or 2 things and put those into action. I know I certainly got a few ideas from this conversation. And if you think James sounds a little croaky, that's because he is. He was just getting over a cold at the time we recorded this. Anyway, guys, enjoy the episode. That's all from me, Here is James King from London, UK.
Yeah, that's perfect, mate.
All right, well, James, just to set the scene here, tell me a little bit about your education, your background, your experience, etc., prior to working at Mandara.
Okay, sure. My academic background includes starting off with a sports science degree, undergraduate at the University of Edinburgh. And then from there, that's where I really got passionate about psychology specifically, and sort of really identified that as a differentiator between what makes some elite and so many just sort of scratch the surface of that sort of area. So I then went on to study my master's degree in performance psychology, also at the University of Edinburgh, and that was great fun, and things sort of transitioned there from just focusing on primarily athletes, but to other areas. So whether that was executives, lawyers, traders, investors, fighter pilots, military personnel, performing artists, and it sort of looked at human performance more broadly. From there, I started to apply some of that knowledge. I started working as a performance expert for Men's Health magazine, sort of trying to digest some of the complicated recipes science gives you, and sort of making them sort of easily digestible for people to sort of apply bits and pieces from the performance sciences arena. And that's initially where I sort of started consulting and working one-to-one with athletes, Olympic athletes, footballers, and again, I started to work with traders, investors, and other sorts of performers too.
Okay, now the part I'm really interested to speak with you about is obviously the time you spent at Mandara. So I guess probably one thing just to preface that is, for those who are unaware, can you just explain what sort of firm Mandara is, and then also tell us about why Mandara wanted you on their team?
Sure. So Mandara is, now I guess you'd describe it as a commodity derivatives trading firm. So trading sort of specifically within the oil and refined products, but then over the last few years have expanded out into other commodities and sort of expanded geographically to new locations out in Singapore and into New York. The initial challenge that Mandara faced, the owner of the company set it up in 2009. Super motivated guy, really forward thinking, had worked at the sort of the big banks, and had grew frustrated with the lack of opportunity to put all these ideas he had into action because of the sort of red tape that sort of naturally exists at these sorts of institutions. He thought he could do it better himself. He set up Mandara. I think what's also unique about the owner actually is that he's sort of a bit of a geek in three areas. I'm sure you won't mind me describing it like this. Firstly, he's absolutely obsessed with trading. Secondly, technology. And thirdly, psychology. And I think that's almost that's sort of manifested when you look at the way Mandara's operated and the way it's become successful over the last sort of 4 or 5 years. So the gap I was brought in to fill was that traditionally, I guess, funds or trading houses that look to scale have this genius at the helm who then goes out and raises loads of money, and then you increase size. Mandara is slightly different. The owner saw an opportunity to actually scale knowledge. So instead of just going out and raising more capital and trading with that himself, his idea was to download the information that gave him an edge in these oil markets, and then sort of find talented people, upload that information to them. So essentially scaling trading expertise and then deploying traders who operated under those principles into new markets. And it was sort of that lateral expansion. And my role was to come in and make sure we identified the right talent and got that talent up the curve as quickly as possible. Up until 2012, the company was really still relying on the owner as the primary source of trading revenue. I'd hired lots of young guys, but for some reason or other, they just weren't getting it. They weren't getting up the curve, and they weren't learning what they needed to learn in order to generate P&L. And that's where the owners sought to look externally to other fields that sort of solved this problem before, basically. And that's where I was sort of put in touch with him. And it was also an interesting time because this was in 2012 and we just had the Home Olympics in London and we absolutely smashed it. Team GB did absolutely fantastic. It was Home Olympics, typical British situation where we win the Olympic bid. Everyone sort of pisses and moans about how much it's going to cost, how it's going to be a nightmare getting around London. So the remit to sort of the performance director, the team GB was make sure you win medals. And they did. They applied sort of every ounce of science they could. They applied it, and the results were pretty phenomenal. And this became a talking point around sort of the city at that time as well, just as I sort of started at Mandara there.
Okay, and we probably should mention that you're no longer at Mandara, correct?
That's correct. So I left Mandara at the beginning of this year to pursue some new opportunities. Maybe we could talk a little bit about that later on.
Yeah, we'll definitely get to that. Okay, so at Mandara, when you started there, you actually came into a new role, correct? So it wasn't a role that was like previously existed, like the owner was looking for someone to help solve this problem that they were having, right?
Yeah, exactly. So the role and the title I had at Mandara was performance director. And as far as I'm aware, I wasn't aware of anyone with that sort of title within the trading and investing space. It's a term sort of a title used primarily in sports teams. So, for instance, Team GB, the Olympic team, will have a performance director, someone who's responsible for talent identification, development, and then actual results that are produced by the athletes they manage. So most sports teams will have some sort of performance or technical director. So this was something new, and I think it characterizes Mandara as a company and also the owner, but this really sort of open-minded, challenging the status quo type attitude, which I think is sort of key to them, to us to be able to engineer the sort of results we did. But yeah, it is a unique role. But since then, a few other companies have sought to do the same thing.
And your role there as performance director, I've heard you describe it as really your main objective, the main thing you wanted to do in that role is stack probability in the favor of success for each of the traders on the team there. So do you just want to maybe flesh that out a little bit for us and explain what you mean when you say stack probability in the favor of success?
Sure. So performance in any arena, in whatever you do, it is impossible to guarantee success in anything. But most performance endeavors have sets of principles which, if you abide to, give you a higher probability of succeeding in those. So as performance director, my role is to uncover those and then ensure that the environment that we're performing in and the individuals there are free to sort of, firstly, are really aware of them, and then are sort of, set up for success in order to implement and stick to those principles. So much like there's principles for sort of trading and investing, there's also principles for other areas. So along with the performance director remit comes there's a set of principles for identifying talent. There's a set of principles for developing talent. There's a set of principles for managing talent. And there's a set of principles for performing under pressure. So my role is to make sure that, kind of like a checklist manifesto almost, okay, are we sticking to these rules? Because I know that if we do stick to these rules here, we stick to these rules here, and here, so on and so forth, there's a much higher chance that we're going to succeed and hit the targets we've set out to.
Well, would you be able to talk to us a little bit about, the first step in those things you outlined there? So actually identifying talent. How did you go about identifying talent? Because just if I understand right, you didn't really interview too many traders at Mandara there. You yourself, I think, were quite involved in the hiring process, but you didn't really hire in the traditional sense of doing interviews and going, sort of bringing people on that way. You did things a little bit different. Can you talk to us about how you actually identified talented traders or potential talented traders?
I think it's a really important sort of point to make clear, actually, to anyone listening that wants to perhaps get more out of themselves, full stop, because this is the one sort of step to me that if you get this one wrong, you've instantly sort of capped the potential moving forward. It's so important for the individual or for the company, bringing in the talent, or for the individual who's wanting to get the most out of themselves. So the first thing that as an individual you need to think about is make sure you pick the right goals in the first place. So by that, I mean, just like a cricket bat or a tennis racket, golf club has a sweet spot. So sort of a location at which the ball will absorb more sort of forward momentum than if struck at any other point and rebound away a lot further from the club or racket. So does each individual. And your sweet spot lies at this intersection of where your strengths are. So I'm talking about a bit of nature here. And with regard to strengths, there's two areas. There's sort of personality and character strengths. And then there's also, cognitive strengths, or if you're an athlete, perhaps physical strengths. And different types of strengths will give you an advantage over others in certain styles of trading, just like a certain body type or fast, slow twitch fibers will give an athlete an advantage over another athlete in a given sport. So, for instance, if you're going to be an NBA basketballer, it does help if you're sort of 7 foot tall. The second area that's really important there is interest. So it's really important to identify what you're really interested in, what you sincerely find meaningful. And I don't mean sort of hobbies necessarily. I'm talking about day to day, what sort of pattern of working do you enjoy undertaking? And once you're clear on that and how you really do enjoy what you enjoy focusing energy and attention to, that's a sort of another sort of motivational synergist. And then the third thing is values, is making crystal clear in the context of your career what's important to you. So if you succeed in this goal you're about to pursue, well, what's it giving you? What's the gap you're trying to sort of fill there? Is it for money? Is it status? Is it work-life balance? And at Mandara, a lot of the guys that came in were their values were along the lines of learning, and that was something that they got at Mandara in a unique way, in that we threw so much into that. I appreciate I'm going a little bit off piece there, but to come back to looking at it from the company perspective, it still relates to that same principle, we need to find people who are sort of performing in that sweet spot. So the first step as a company is to go out and model excellence. So if we're looking at, derivatives traders that have traded successfully and sustained success over a decent time frame, can we go out and find causation? So I'm looking in those three areas. What are the cognitive strengths of these individuals? Is there causation there? Are there any personality character strengths that seem where there may be some causation? And then again, down to the interests and values. And then essentially what we do is we come up with some sort of avatar, and it's our sort of hypothesis of if we could design someone like I don't know if you've seen Westworld.
No, I haven't. I've heard of it.
You have to check it out. But if we could design go on a computer and design the perfect human being, the perfect athlete for this style of trading, what would they look like? Okay, I'm going to program their strengths to be this. I'm going to program their interests to be this. And I'm going to program their values to be this. And once we're clear on what we're looking at and on what we believe will have the highest probability of success, we've got to go out and find it. So we've got our almost metaphorical square hole. We now need to go and look for our square peg. And interviews are perhaps probably the most bullshit tool in the box when it comes to actually identifying someone's suitability to perform said role. So we try to make it as scientific as possible. We've got all these variables that we want to find and be confident that the individual possesses. So we have to design tests, and where possible, we want to make these tests blind. We wanted people to come in, we wanted them to be themselves and see whether they were the sort of square peg that fits this square hole. With interviews, the thing is, all you really test is how good the individual is at interviews. And if it was just down to purely interviews, half the people that ended up working at Mandara probably wouldn't have got the job in the first place, actually. So we use really interactive behavioral tests. So if I deem resilience to be important, I'm not going to ask someone to talk to me about a time you've been resilient. I'm going to put you in a situation where in order to succeed, you're going to have to show me you are resilient. So it's a bit more evidence-based, and that's really important. And the last point I'll make there before I give you a chance to speak is that specificity is really key as well. We often hear about these sort of buzzwords that are really important, with regard to being a top trader, top investor, whether it's resilience, patience, confidence, motivation. But these things are all very specific. I don't really believe that people are sort of generically super resilient. People are resilient in some areas, less resilient in others, patient in some, less in others. So when we are testing these individuals again, specificity was really important. So the people we were bringing on board, they were there to trade, to make money, and to be very good at it. So everything was geared towards that, and it was as specific as possible to the role that they would be completing. I mean, our original assessment day was literally designed like almost the worst case working day at Mandara, to see whether someone could deal with it, sort of go extreme, and then we knew that we could sort of work in, and those individuals had a higher probability of sort of succeeding in the environment that we have them perform in.
Right. So a few things, just going back to the point you made about how you guys kind of almost created an avatar for the sort of person who would ideally suit the role that you were looking for. How easy was it, or how difficult was it for you to actually find someone who fitted that role, and how close of a fit would they be? And what if they did have some of the traits you were looking for, but not others? Is that something you thought could be taught? I mean, how did you guys how flexible were you on finding someone who fitted this perfect avatar that you'd created?
Okay, that's a really good question, because perfect doesn't exist. So, and also perfect isn't necessarily the aim either. Good enough is good enough. So we're looking sort of 80-20 on these tests. I mean, if you could imagine, say we had 15 core characteristics we were looking at. Imagine we were scoring them on a scale of 1 to 5. The rule would sort of be, no twos. So, it's tough. The first challenge we had was that, we just didn't have the applicants in the first place. For the early roles when we first tried this out, we just sort of burnt through people. Our standards were really high. And there was that trade-off between keeping the standards high and not just sort of, I think what a lot of companies do, and I've seen sort of this happens in the military as well, is that you need people. So you get clear on what you want, but then you don't find it, so you get to what's closest. Well, if you're looking at things a bit more scientifically, if that's what you need, then that's what you need. And then, there's no point if you've decided that you need people with those characteristics. There's no point in sort of course, there are times where you might have to compromise, but at the same time, you need to address the real root cause issue there, which is, okay, well, our gene pool isn't strong enough to provide us with the individuals that we really want on board here that are going to give us the best chance of succeeding. And actually, probably the first year at Mandara, a big part of it was actually expanding our gene pool. So how do we get more people to apply? How do we put more people through this process, which is in turn going to improve our probability of finding the right people? But there was no one that ever came through and got perfect scores in every test. And elements of the testing is intuitive, and there's some subjectivity involved, even though we do try to sort of remove it as much as possible. But of course, you make compromises here and there.
And some of these tests that guys would go through, I know you mentioned testing for resilience. What's an example of a test that someone might go through when you're testing them to see how they handle resilience?
Okay, so one of the tests we have is it's sort of simulated it's sort of simplified what someone trading within the refined product space in oil might have to go through during, say, a physical settlement period where there's a lot of volatility, everything's happening, you're sort of speaking to brokers, you're sort of watching what's happening electronically, you've got a direct trades team sort of communicating with you, you've got the guy to your left and right communicating. So it's a bit of madness. So what we did was we dumbed that process down, but using the same sort of areas of the brain or cognitive skills that would be used there, but in a very simplified manner. And we'd have them sit in this sim and and perform. So it was very specific, or as specific as we could make it. But in order to sort of bring about the resilience, the first thing you can do is turn up the intensity. So we did that. The second thing we can do is start putting pressure, giving the individual some negative feedback. So we did that. Have sort of actors playing the role of the arsehole across the desk, giving him some grief or a bit of hassle or some weak communications. See how they dealt with sort of getting sort of solving those small problems. The second thing we'd do is increase the emotional component we turn on white noise, which literally just spikes your sympathetic stress response. So it fills your sort of body with the chemicals that are sort of released when you are stressed or when you are under threat. And we'd also have the individual synced up to parasympathetic and sympathetic stress response monitors. So we had biofeedback into not just how the individual looked like they were coping, but we could actually see what was going on unconsciously, physiologically in their body. So we could just crank all those parameters up gradually and see how the individual responded. And we'd be looking at things like, it would be impossible not to do a bad job on this test. It was so brutal. But what we'd look at is, okay, this person's made an error. How many subsequent errors do they make? So we're looking at succession of negative errors. Do they make a mistake, recover, bounce back quite quick? Or do they make one mistake and then it all goes to shit? And everything we observed in these tests manifested one way or another, for better or worse, in real time with the guys that got through. So it was a great tool for us to really understand that in individual in order to sort of better prepare them moving forward. But another thing we would sort of do is halfway through this test, pull them out. And then one of the sort of selection panel, which was, our senior traders, would sort of good cop, bad cop. Got to be careful not to give away too many secrets here. But, pull the individual out and sort of say, you know what, I'm not going to put you through to the next round. I don't think you're motivated enough. I'm not sure you're smart enough. And I just don't think you're confident enough to do this job. And then we'd send them back in and see how that sort of negative feedback affected their ability to perform. One important point to make here is that this isn't a generic approach I suggest everyone use. The reason we were testing those specific things or traits in those very specific scenarios was that they were the scenarios that the individual would have to go through at Mandara. And it wasn't because we were, a bunch of arseholes. It was because, our expectations were so high. I mean, we were trying to get guys, we were sort of trying to condense 25 years of industry knowledge into like 3. So the intensity was just enormous. So we needed these sort of like superhumans that sort of freakishly really would sort of thrive in that specific environment. So I don't want to sound like I'm just endorsing, to test if people are good, you should just thrash them. The reason we were thrashing them and giving them those sorts of feedback is because that's unfortunately the sort of type of feedback that they would probably be getting. And there's no one that actually ended up becoming an awesome trader at Mandara that at some point the management team weren't having conversations about thinking, is this guy going to make it? Because it was such a big ask on our part from those individuals.
One of the things I find really interesting about your answer there and you describing how that sort of process played out was the use of technology. I can't remember exactly what they were, but you said there were 2 things that the trader or the candidate was like hooked up to that you could monitor.
Biofeedback, yeah.
Yeah, that's it. Was that use of technology carried over beyond just sort of the initiation? Like, was that something you used to monitor traders like each and every day on an ongoing kind of basis?
Well, you know what? It was very individually specific. I mean, that was another sort of core characteristic of what sort of went on at Mandara. We didn't have sort of of course, it was like a core development curriculum, you could say. But beyond that, there were individuals that sort of engaged in this science more than others. Just like you get at a football club, some athletes are going to love certain tools that a sort of sports psychologist or a neuroscientist might bring. And that was certainly the case at Mandara. There were some individuals who came and would think, we'd definitely use simulators as a facilitator for sort of skill acquisition. And occasionally, individuals will be like, actually, I want to look at I want to get some biofeedback on this. And some individuals use these tools to work on emotional control at times, to give your sort of listeners an idea. not many of them really did engage in that, although it was there. But there were a couple, and the couple that did actually were probably, two of our stronger performers who used it more than others. But we did have some times where a few of the guys, we were looking at blood sugar throughout the day while they were trading, just like you can go into a Boots in the UK and buy like almost a blood testing kit, quite cheap, and just sort of prick your finger, you get an instant reading on your blood sugar. A couple of the guys, periodically would use that and be like, oh, okay, how's my energy here? Or, and they'd be, measuring that. And I think that was, rather than something that was forced, it was sort of a product of the mindset that the individuals that we sort of screened in sort of were curious for any edge they could get. And that included physiological or the neuroscience aspect.
So here we're talking a lot about resilience, and you're using some pretty, I guess, advanced methods of training for resilience or testing for resilience. For the trader who's at home, the trader who's listening to this, are there any methods or exercises they can try to help build their own resilience? Because, you're kind of mentioning it here as though it's a key trait to have. It's can be very beneficial for traders to build up their levels of resilience. I mean, what would you suggest to someone at home might be a couple things they could try to help?
Right. Well, this is where I guess I'm going to be controversial. The thing I would suggest is that resilience is something that's in everyone already. It's there. If it's something you're struggling with consistently, then there's probably some more deeper sort of root cause problem you might want to look at. And it all comes back to that first point. Make sure you're chasing the right goals in the first place. Make sure you're using your strengths. Make sure you're doing something you genuinely, sincerely find meaningful. And make sure you're clear about, what you're getting from doing that. Again, when you're in that sweet spot, you're instantly at the best, operating at the highest level of resilience you sort of have in you. So that's where I'd always start, because the goal's not, if you're not sufficiently motivated to pursue the goal, then you'll find any excuse to be unresilient, and you'll be constantly distracted, and you'll constantly want to perhaps minimum effective dose everything and do the bare minimum. And if you find yourself doing that, then I would certainly, or the first thing is I'd remind you that that's not you. You are not resilient. But what is happening in those sorts of situations is that it's a clear indication to me that you're probably chasing the wrong goal, and it's not really got you firing on all cylinders with regard to motivation. The second part of that is that resilience is built by stepping out your comfort zone and making sure that you're sort of taking small steps, and it's a capacity that's expandable. So the other thing that could be happening is that if you are finding that resilience is perhaps an issue for you, then perhaps your steps are a bit too big. So what I'd encourage someone to do is, before we start talking about any resilience quick tools or hacks, these are sort of the foundation things. So the first one is, make sure you're chasing the right goal in the first place. And then secondly, check the step size. For instance, if you're sat on the couch for 3 months, you suddenly decide you want to go out and run a marathon, and then the next day you decide, right, every day I'm going to go out and run 5 miles. And then you find yourself that you're giving up, not doing it, or sort of you're quitting halfway through and making all the excuses under the sun. I mean, the point I'm sort of arguing is that you're probably trying to do too much too soon, and you need to build your capacity for that. And small, slow, steady steps are going to be better. And what happens is you set yourself small targets, you complete them, and then the unconscious message to yourself there is that I said I was going to do that, and I did it. And that reaffirms, and it becomes sort of a spiral of sort of uplifting sort of success there. And then that's where you build your identity around, I am resilient, I am confident, I am motivated. So make sure that your sort of step size is appropriate. I think we do live in a society where people watch an advert or a sold on something and then go from 0 to 100 very quick. And I think it's really important to really reflect, and before you pursue any goal, make sure you really are aligned with it. And then secondly, baby steps, and then those will very soon compound, and you'll find yourself going exponential. But general resilient tools as well. I mean, a lot of people are talking about meditation. Works for some people, doesn't work for others. I think it's about just experiment with stuff like that. I think you'd be silly not to try these things out, trying them on. Apps like Headspace are great, and I think they're almost almost every trader I've met sort of has that app somewhere, pulls on it from time to time.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
You've mentioned this a few times now, and I think it'd be really good if we can actually kind of go into that a little further. So how would someone know if they have a healthy motivation for wanting to become a trader? Like, how do they know? What does it mean to find meaning in being a trader, if that makes sense? That wasn't worded very well, but...
Yeah, no, I think I get where you're coming from, because it is a rather, it's not sort of a how to bake a cake problem. Back to the point I mentioned before, and then we'll go into it hopefully a little bit deeper. I think in essence, you know you're on track when you're pursuing goals for you, and sort of trying to avoid that lure of the external, whether that's a graduate who's thinking about going into trading because of the lucrative job offer, or the perception of this sort, the movie version of success, the sort of Wolf of Wall Street type stuff, or the pinstripe suit skyscrapers things that can sometimes seduce us into thinking that that's what we really want. I mean, I think the best way to identify, a big sign that you're perhaps a bit off course there, and you're probably overly motivated by the externals, is ego. So if you notice a lot of ego popping up, if you're very defensive, or you're when things are going well, you do become extremely cocky. I think there's signs that you're doing things for external gratification. And external gratification is there, by the way. These things exist and they are important to an extent, but they just can't be the only thing. So I guess the difference would be, I want to be a professional footballer because I want all the external glory that comes with that, versus I want to be a professional footballer because I just love training. I love playing football, and I just can't. People have to drag me off the pitch. I'm a bit like a gym rat syndrome with the individual in that area. And I think within trading and investing, I meet so many young, ambitious people who sort of talk about pursuing a career in trading, but they talk about it like another young man or woman might sort of say, I want to be a sports person. And it's like, well, when you say you want to be a trader or an investor, I mean, what specifically? Because they're all completely different. And you've got guys out there like Van Tharp, who have these great sort of questionnaires and psychometric tests you can go and complete, and they give you an idea of what sort of trading styles will suit your personality and your strengths and the sort of the way that you enjoy working most naturally. I mean, if you were given a choice of how you want to work, do you like being in a corporate environment? Do you like being in an office from sort of 7 till 7? Do you like freedom and flexibility? Do you like going into extreme levels of detail, or do you prefer more intuitive thinking, problem solving? All these things would influence the sort of, I guess, the way you'd go about pursuing success in trading and what sort of style of trader you're going to be. It's a bit like one athlete in a football or rugby team might be a great player in one position, but he could be terrible in another. So, playing prop in rugby is very different from playing wing. There's different character strengths, different cognitive strengths that are going to enable success there. And that success will bring with it motivation. So I'd really encourage people to think and really sort of get down and think about, what as a blank canvas, what am I naturally good at? What things do I pick up quickest? Where have I excelled base versus the population with regard to maybe cognitive test batteries? What sort of what's the way I look at the world? Where's that an edge? Where might I miss things actually? Where could that be dangerous? And the ultimate barometer is sort of, how you feel. And it's sort of, if you're getting that nagging feeling more than a few days in a row, or maybe more than a few weeks in a row, then it's perhaps the time to really look at the goals you're chasing and thinking, how could I tweak this so that I'm using more of my strengths? I'm working in a pattern that I feel comfortable with, and you know what? I'm working for something that I really find important. And for me, it isn't actually just all about money. Part of it might be to do with freedom, flexibility. Maybe it is status. Maybe, there's a million and one things you could look at when it comes to values.
Absolutely. Yeah. Yeah. No, all really helpful points. I think what would be cool to hear a bit more about is the traders you worked with. What are some of the principles you use to further develop their expertise? Okay, so guys who, they're not complete newbies, they've been trading, they're doing reasonably well. What are some of the principles you use, or some of the techniques you would try to help them further develop their expertise, to help them push their comfort zone, level up, and sort of take things up a notch?
Okay, so there was one sort of overarching tool that was quite useful, and we sort of called it like the kata approach, and it basically was a series of steps we'd go through with these guys, and to basically just keep them thinking about the next steps and improving. And it probably summarizes the culture at Mandara. I mean, I could talk you through that sort of process, but a lot of our traders found that really useful. I mean, the fact is markets don't stay the same. Specifically within oil, there's, it's OTC, voice brokered, but there is a change. More of it's moving to the screen. That changes the way things work. So something that might have worked, a strategy that might have worked a few years ago might be completely redundant now. So there was this need to not just, I've made it, I'm making money, I can just relax, turn up, and go home. Nor was that the nature of the individuals that we had there by virtue of the screening process. I'd describe them all as very sort of self-improving individuals. But the tool we found really useful was this sort of pattern of thinking we'd train the guys with. And some obviously took it further than others, but a few individuals sort of would probably attribute a lot of their growth and success to this approach. And the first step involves making sure on sort of the overarching goal or direction in which you're going to undertake. So another example, I keep using examples from sport, but I mean, does it make the boat go faster? Might be the question that the Olympic rowing team might ask themselves. That statement should almost drive every decision and every ounce of activity that you undertake as a performer. So within trading, you're going to have things along the lines of, does this, am I maximizing profit or am I mitigating a risk? They're the two things that you should really be focused on. If you're looking at this in the context of your own personal life, maybe you look, does it maximize pleasure, minimize pain? But that's the first thing to get clear on. And the second step there is to sort of know where you are now. So get crystal clear on your current condition. And with a real big focus on process. So what's my pattern of working? I come in the morning, I'm spending this much time doing this, then I do that, then I do A, B, C, D, E, F, then I go home. Okay, looking at that process, looking at people. So, look, okay, what team, what resources do I have here? How am I using those individuals? Maybe looking at the tools and equipment you have. Okay, how am I using technology? How am I set up here? And then looking at some core metrics, what are the results I'm actually producing here, and being crystal clear on where you are now. So this is the way, the process, the pattern of working I'm using to produce these metrics, and I'm using these equipment and tools, and I've got this access to these sorts of people or these expertise. And then the next step would be coming up with a real clear target condition. Okay, so what do I want things to look like? In an ideal world, how would this process look? What metrics would I be going for? What tweaks would I be making to my equipment, my tools? And when you've got a clear picture there, you can very easily compare, okay, well, where am I now? Where do I want to be? What's impeding me? And obstacles sort of become very clear. And from there, it's about identifying the biggest 1, 2, 3, and then sort of working on sort of hypothesis. And this was a sort of key thing for us. We sort of use the term experiment. I mean, one of the things that enabled us to produce pretty compelling results was the fact that, there was there was tolerance for failure. And we'd frame these experiments that, where there was a chance of things going tits up as experiments. And we would experiment around these big obstacles, and lots of little short experiments where it iterate quite quickly. And this is where that sort of fail fast and learn culture came in. And it sort of one experiment led to the next. And so there's almost never any time to just stop, because there was always an obstacle and there was always something to focus on and experiment around. And that process itself became quite addictive, in that people enjoyed sort of experimenting and trying to solve problems that sort of impeded their progress. And there was a tolerance for failure. And the other key thing that sort of pattern of thinking is, it gives you an advantage in that the human tendency is to sort of jump to solutions. Before we even really analyze the problem, a lot of the time we just want to feel like we're doing something about it. So we just start jumping to, we should just do this. And I'd really encourage that people to sort of spend a bit more time on that sort of second step, which is, knowing where you are now and working out your current condition. Because once you're clear on that and you're clear on what the obstacles really are, it becomes a lot easier to actually the right solution often just presents itself.
Right. So to get very clear on, your current situation, and that, like you described there, you said there you gave a whole bunch of questions that are worthwhile asking yourself. What's the best way to actually answer those questions? Like, is it to put pen to paper? Like, I presume you're not just trying to answer all those questions in your head and keep a mental note of everything. Is there a good way to kind of get that information out and have it in front of you that you can actually properly assess your situation?
Sure. And what we did was we'd undertake this process in groups, and we'd just dive in a meeting room. We'd have a whiteboard up. Okay, right. Let's recap from the beginning. Okay, what's the aim here? How do we make the boat go faster? Okay, where are we now? Okay, process, talk us through it. And we'd capture all this on a sort of whiteboard. Write it up. Okay, well, how do we want things looking? Okay, well, what are the obstacles? What's stopping us from things looking like this? And we'd just iteratively go through each step on the whiteboard. And then some people would go and type it up. Some people would just take the photos and keep on a website, on an email. So really it depends on the individual. I mean, some people had big whiteboards behind their desks with all this written up, and as and when they would do experiments, they would scrub one out. Okay, well, I learned this. So the plan was this. I did this, checked it. This didn't really work, but I did see that might be an opportunity. So my next step is to do this. And some people would write it down. I definitely would encourage writing these things down, whether that's privately in a notebook, whether that's on email, electronically. But I think it definitely helps to just draw these things out.
Okay, and by the way, I just want to say I really like, as simple as it sounded, I really like the way that you framed those two questions. Does it increase or maximize profit, and does it mitigate risk? I think those are two really cool questions just to always keep in the back of your mind, or maybe even write it on a post-it note and stick it on your screen. I think those are key questions. I mean, and they'll save you a lot of time from veering off the path and going down rabbit holes and, spending time on things that aren't contributing to those two things, which are really the only two things that matter as a trader, right?
I completely agree. It's so easy to sort of get lost and start solving problems that maybe aren't even the actual problem themselves, or start operating from a position you've just got sort of completely lost in. So the idea is that, I mean, I know that it was a real popular term and that every athlete in Team GB was sort of using this "does it make the boat go faster" analogy, because it's, if I have 4 or 5 beers tonight, does that make the boat go faster? Well, no, actually it doesn't. So, it helps you guide everything in every area. And if performance is your ultimate objective, then it's quite a nice, simple way of keeping you on track, which should keep you thinking in your activity, lean, focused, and sort of as the crow flies towards your target.
100%. One of the things I've heard you speaking about in the past is a thing called stretch targets. Now, I'm not sure if this is something you've come up with or if it's something that's maybe a little bit more widely known, but it sounds kind of interesting. I'd like to hear a little bit more about it. I mean, what are stretch targets and how are they used amongst the traders you've worked with?
Stretch targets, if you can imagine 3 zones. The first one would be your comfort zone, and that's the zone in which you know what you're doing. Okay, you don't learn anything or adapt or improve anything in your comfort zone. It's maintenance at best, although probably some entropy sets in when you stay there too long. And then the next zone would be your stretch zone. Essentially, the stretch zone is an area where you're having to switch on in order to sort of successfully operate or to perform in that area. And that's what that does, is it creates a gap between your current ability and the ability required in order to be successful in that moment. And it's that gap which causes your body, your brain or body, to make the changes physiologically and neurologically that will enable it to successfully complete that task. And then essentially what happens is your comfort zone expands, and what was initially stretch would become comfort. And that's the process of learning and growth. Beyond the stretch zone, you've got your panic zone, and that's when essentially you haven't got a clue and you're really shitting yourself, and it's just too much, and you just absolutely body's full of cortisol, adrenaline, and because of that, it's just too overwhelming that no learning occurs. And so it's really important to get that sort of steps you take in order to improve are small, iterative, and then you can progress as your confidence and resilience to deal with sort of more stretch increases.
I think where I heard you speaking about these stretch targets was a video that you created for Mandara. I'm just trying to think over the example you gave in the video, which was kind of cool. You said... Oh,
I think I know. Okay, so this comes back to... I think I know what you're talking about now. So this comes back to... So earlier we were talking about, when you're this sort of pattern of thinking whereby, okay, I'm crystal clear on my current condition. I know what everything's like, everything looks like. Then I've got my target condition over here, which is why I want things to look like. Now, where we talk about stretch targets there is that if we were to ask a guy at Mandara let's just for example say, okay, you made $1 million last year and we want you to make 1.2 this year. The problem with that is that the sort of solution that most people would jump to there is, okay, well, I'll just do a little bit more of what I'm doing now because I need to make a little bit more of what I'm doing now. Whereas if you sort of almost 10x that, you'd be like, okay, well, I want you to double that next year, and also I'm going to remove this resource from you. You're not allowed to do that. Also, I want you out the office by 4 every day because it's not sustainable the hours you work. That suddenly forces the individual to look at the problem in just a completely different way. And they've suddenly become a lot more creative, and their lateral thinking sort of goes through the roof.
What are some of the ways that you would encourage them to rethink things? I'm just trying to think, like if someone at home or someone who's listening to this wants to try and put in place some kind of stretch goal a stretch target for themselves, I mean, what might be a good way to think through that or actually try to apply this type of thing?
Starting off with a blank slate. So forget everything you're doing at the moment and just look, okay, this is the target. How do I do this? And then think about where you have leverage. Okay, so where can I leverage something in order to produce a new result? It could be, okay, so there's the classic ones, time and effort, which everyone sort of jumps to. The capacity, let's hire more people to do it. Then there's things like there's other areas which are sort of out of the box. So there might be things like, okay, well, what if I designed a new tool? What if I leveraged technology? What if I shared a resource here? What if I partnered with this individual? What if I, even looked in a completely different area? What if I started trading more products? What if I started trading new time zones? What if I automated half the stuff I'm actually doing? Because that is sort of taking up 60-70% of my time. So it's asking those sorts of questions, looking at every area. What if I sourced expertise from an individual here or there? Or what if I go and speak to someone who's had this problem before? But they're the sort of general questions, and that's where the sort of human ingenuity comes in, and that's what we're good at, really, brainstorming solutions. But again, it really helps doing that if you're crystal clear on what your process actually looks like, and actually get down on paper how you spend your days and how you actually engineer the results you currently are. I'd be absolutely gobsmacked if there wasn't some way you could sort of almost sort of significantly reduce the time spent in certain areas. We're not, I think, nearly half as efficient as we think we are.
Yeah, I feel that. James, I'd like to speak with you a little bit about some topics, I guess, aside from trading, but that apply to people's life and, of course, rolls on over into how they perform as a trader. So there's a few different things I'd like to bring up. I guess the first one would be routine. As a performance director and someone who really looks into people's performance and trying to make them, like you just mentioned, as efficient as possible, how do you feel about routine and that sort of thing? What are the first things that come to mind?
So I think like anything, that your routine is your strategy for producing results. So if you keep tweaking your strategy, or one day you're doing it this way, the other day you're doing it that, it's very hard to understand how effective it actually is, or actually, can you even can you sort of point causation at anything if that's the case? Also, humans generally, we're just habitual creatures. When we do have routine, we sort of start to automate things. Therefore, if you have 100 decision-making units a day, if you're not rethinking everything every day and spending those units, the more you have there for when you're coming up, for when it comes to solving sort of high priority problems that really sort of make the poke go faster, rather than, oh shit, what should I eat for breakfast today? Or if you're deciding what clothes to wear every morning, or what to eat for breakfast, or where to go for lunch, and I'm in on about those sorts of things, and you're just pissing away energy which could be invested in a lot more useful things. So I definitely advocate automating as much as possible and get into a routine. And the beautiful thing is, once you've got a routine, it doesn't work, tweak it. And that's obviously something that's pretty easy to do. I don't think we all have to be robots, by the way. Some people are more comfortable than others. But if it's something that resonates with you, if you're listening, when Aaron sort of posed that question, then it's definitely something that you should consider sort of writing down on paper. Having a clear process for things makes it easier. And the other beautiful thing is it gives you an opportunity for sort of success every day. Because, okay, I've got this routine, I've got this is my strategy for eating, for training, for working. And every time you execute it, it's sort of a tick in a box, pat on the back, well done, I've done this. Because the theory has to be that if I do execute this routine over time, it will sort of produce these results. So that's the other nice thing. I personally have my routine and process down for my sort of training, eating, and even actually sort of, what to wear. Everything just automates. I just don't even think about these things. And that's out of laziness, really.
Well, yes and no. I mean, it helps. It's funny you mention, your routine goes as far as what you're going to wear each day. I heard that's the reason why Mark Zuckerberg is always seen wearing pretty much the same getup, is because it uses energy to think about what you're going to put on for the day. So he just same thing every day.
Yeah. I mean, if you spend 15 minutes, searching through clothes, what am I going to wear here? And then again, at the end of the day, you also find yourself in, I don't know, in a grocery store, think, what am I going to eat tonight? Oh, should I have that? Should I have that? You end up umming and ahhing about everything, and it's just inefficient and wasteful. It's probably not the first thing I'd address with someone, but it's really important. But specifically with your pattern of working and how you go about producing results, like I think that's really important in the context of your work. How do I work? When am I at my most efficient? What environment do I perform well in? And then once you've got that routine down, just listen to it. If something doesn't feel right, then tweak it.
I need to do a better job of mapping out my routines. That's definitely something I'm going to put on my ever-growing to-do list. What are your thoughts around food and diet? I mean, I'm sure we could probably do an entire episode on this, knowing your background, but, what are just some quick tips or some maybe things to think about how traders might want to consider or better consider their diet and their food and what sort of things they're actually putting into their bodies? Because obviously that can have a big effect on how you perform as a trader, right?
Yeah, of course. I mean, if your brain's important to you in doing your job, then brain health becomes, part of the algorithm. Nutrition is key. It has huge effects on concentration, attention, mood. It affects some more than others, but in a nutshell, I would sort of advocate the paleo approach. So where possible, if you can imagine an inverted food pyramid with at the top meat and vegetables, nuts and seeds, fruit, and then some fats and a small starch. So the big thing for me would be avoiding as much as possible just refined sugar. That's the worst one. That's a game changer. If you can just remove that from your diet.
I guess while we're talking about general topics here, one thing I think would be good to ask is, what should we do if we find ourselves making excuses? Like, if we're not taking responsibility for things and we're making excuses, what's the best thing to do in that situation? Like, we know we should be doing better, or we know we should be, eating better. We know we should be spending more time on a certain something, but we just make excuses. What's something that can snap us out of that?
A slap? No. On a serious note, though, I think this is quite an important one. And I think the first thing is to accept that you're a human being and give yourself that permission to be human. There's no one on this planet who does all these things perfectly. And it's very easy to be sort of seduced by media and TV and this sort of movie version of success and how you should sort of be perfect in all areas of your life. And it's simply not something that can happen overnight. And I don't know many people that have mastered all areas. So I think you need to give yourself a break. It's, the top most disciplined people out there, most motivated people out there slip up from time to time, whether that's a couple of beers or falling off the wagon with their nutrition or maybe skipping a process here or there that they know they shouldn't with regard to their work. So that's the first thing. The worst thing to do is sort of beat yourself up about it. But then at the same time, you need to think, how serious you are about where you're going to go with stuff. And if you are, if you really do want the most out of yourself, then there can't be excuses, because you are responsible for everything. And it's as simple as that. You've got to take complete ownership for your performance. And rather than sort of pissing and moaning about why you didn't do it, you're much better thinking on, okay, why didn't I do this? Every human being is a fool for the path of least resistance. And I'd really encourage you to look at the things that you're perhaps struggling to do consistently and just try and break them down and be like, how do I make this the easiest option? Because if it's the easiest option for me to do, then there's a real high probability I'm going to do it. So whether if it's something simple like with nutrition, well, I'm just not going to buy the shit food that I know I shouldn't really eat. So if I do want it, then at least, you're going to have to walk down to the store, and, the impediment or the obstacle of walking to the store or having to drive to the grocery store reduces the probability of you actually doing it. So things like nutrition, just keep the good stuff in the fridge. If you do have some junk food in the house, then put it in a Tupperware box at the bottom of a cupboard. Silly little things like that will reduce the probability, again, of you endorsing in those behaviors. Things like social media, I've seen studies where you can, instead of, for instance, having the Facebook app or whatever apps you might be spending too much time on or excessive time on, delete the app from your phone so that maybe you have to at least go on to your sort of web browser and log in. Again, that's just the more steps there are between where you are now and actually getting the result you want. The less likely you're going to engage in the behavior, or, drag it into a screen so it's not on the sort of, the first page of your smartphone, hide it over the back in a box hidden somewhere. So it's not sort of, you're primed to do it every time you look at your phone. But I'd really encourage people to go root cause and just minimize, make things easy as possible. That should be your aim with everything, making everything that you want to do and the stuff that's going to move you forward. Once you know what that is, just make it as easy as possible.
Yeah, I really like that. And I think I might actually delete the Facebook app off my phone.
I would recommend it.
Yeah, I could definitely do without that.
It's an addictive habit, and it's chemical, It's what happens is, the way habits form, you've got this stimulus, then there's the sort of primes you to act, and once you've sort of done it so many times, you get this dopamine effect before you've even looked at it. So you just think of Facebook or you see the app, and then you get the reward before you even have pressed the button. And it's as addictive as sort of any sort of drug, really. But the beautiful thing about this whole process is you can do it for the good stuff. So you can make all the right things the habit. You can get addicted to going to the gym. You can get addicted to eating good food. You can hack your brain in those ways as well, and that's cool.
Do you subscribe to the idea of if you do something for 30 days in a row, it's sort of ingrained in you, but it really becomes a habit after 30 days?
I think that's very ballpark. Some things, again, it depends, again, why you're doing the things. I sort of come back to that, why you're doing the things you're trying to do. 30 days, it probably give or take, it's roundabout accurate. Again, for some things, it could be a lot easier depending on your system for adopting these things as habits. The better your system is for that, maybe the quicker it is you'll adopt them or break them or form them, because it obviously depends on whether we're talking about breaking bad habits or forming good habits.
All right, James. Well, like we mentioned way back at the beginning, you've since moved on from Mandara. So, tell us about your next move. What are you up to these days?
So I'm exploring some really exciting opportunities at the moment. One actually that I'm really interested to put out to you and your listeners is that I'm interested to hear from any traders out there who are perhaps, maybe they don't have a professional background in the corporate space, whether that's in banking or big trading houses, but that perhaps are looking to grow their business and that might want some help with capital, professionalizing their approach and trading full stop. I believe that there is a ton of talent out there in the retail space, and I've met some really interesting people lately who have produced some awesome results, who are highly motivated. And I've recently become aware of the obstacles some of these individuals have when it comes to raising capital and sort of maybe professionalizing their approach, but without jeopardizing their whole, lifestyle and having to move to a London or New York and pay tons of rent and work in a skyscraper from 7 a.m. till 7 p.m, 5 days a week, who perhaps want to retain their autonomy with the way they do their work, but would be interested in taking this to the next level. And I'm working with a company in the US that are really interested to sort of find some of these individuals and help them sort of professionalize what they're doing by, through improving their infrastructure, providing them with capital and support. But, at the end of the day, it's still their business, and that's that. So if there's anyone that's interested in or has any feedback for me on that sort of opportunity, I'd be really interested to hear from them.
Okay. And just to save you getting 1,000 emails, what's the sort of criteria? You want someone with a bit of a track record, I presume?
Yeah, we'd be interested to hear from people that have got a track record, that have perhaps produced some results that that would be motivated to perhaps take things to the next level with regard to managing more capital and perhaps improving their infrastructure. But at the same time, the point to re-emphasize there is that, it's still their thing.
Okay. And you're not too fussed on the types of strategies?
No, be interested to hear from anyone and everyone.
Okay. And markets is you're pretty open there as well?
Completely open, yeah.
Okay.
Yeah.
Cool, man.
It's a bit of an experiment at the moment. It's exciting, and
well, it's just early days.
I've been speaking to it's early days. We've spoken to some really exciting traders, and we've got some really good feedback on the idea, and we've got a few people actually looking to get going with. So it's quite exciting. And I think that what's interesting is that I think with regard to trading talent, if you look at what's happening in the industry, I think a lot of the banks for a while now, due to sort of red tape and regulation, they're not taking as much risk. So I think a lot of the talented risk takers in the future, will be coming from the retail space, and people will be looking at that way to source talent. I think there's a lot of talent out there, and I'm interested to see if I can find it, and then hopefully we could work together to create something cool.
Excellent, man. So if someone does want to reach out to you, how's the best way to do that?
Best way to do that would be via email. So if they were to email info@projectthor.co.uk. So that's info@projectthor.co.uk.
Right. And do you just want to spell that out?
Yep. So that's info@projectthor. So projectthor.co.uk.
Cool. All right, James. Well, let's leave it at that for now. I've really enjoyed having you on the podcast. I appreciate you coming on. I've definitely given me a lot to think about, and there's definitely some things I'm going to try to implement from this conversation. So I think it's been really valuable, obviously for myself, but I'm sure a lot of people who are listening to it. So yeah, once again, thank you very much for doing it.
Thanks for having me, Aaron. It's been wicked speaking with you.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, folks? I'm Aaron Fifield. This is Chat with Traders podcast, and I really do appreciate you for tuning in. Welcome. On this episode, I have a returning guest who first appeared on episode 53. His name is a mystery, but he goes by the handle BTC VIX. Now, episode 53, this was the first time I actually covered Bitcoin on the podcast, and that was at the very end of 2015. As you're probably aware, the cryptocurrency markets have evolved a lot since then. So my buddy BTC VIX is here to fill us in on what's been happening and potentially what lies ahead. We also cover how to acquire various cryptocurrencies, best practices for protecting your coins, is Bitcoin in a bubble, the frenzy surrounding ICOs, and much, much more. For context, I will mention this episode was recorded on the 21st of June 2017, and I also would like to let you know I have another Bitcoin episode coming out sometime soon, probably within the next few weeks, and this one is with Bobby Cho from DRW's Cumberland Mining, so stay tuned for that. But now, for episode 134, here is BTC VIX.
I actually was looking back to our last podcast, and I believe the price at the time was right around like $500 or $600.
Okay, I was going to ask you that actually. Like, how much was it last time we spoke? Because when we did the podcast initially, I think it was end of 2015.
Yeah, I'm pretty sure I think when you first asked me to come back on, I looked. I want to say it's right between 500 or 600. I can actually know. Let me just check 1 second right here. Yeah. Yep. That's about right.
Okay.
Actually 400. So December 20th, it was $462.
Okay. That's crazy.
That's crazy, isn't it? And just the space is blown up. I was actually going to try and meet up with you. You went and did that, what was it, like Traders and Beer or whatever in New York with Sanglucci?
Yeah. Are you in New York, are you?
I'm not actually. I'm over by Chicago, but I think it was a week or two later I was in New York, though, in Times Square for the Bitcoin conference.
Oh, okay.
I mean, about a little over 2 years ago now, I went to a Bitcoin conference in the same area, not the same one, but there's maybe 300-400 people there. This time there was over 5,000.
Full on.
So, and I mean, just to see the growth in the space over that period of time, and everybody now is doing some kind of project. And we'll get into that with the whole ICOs and stuff like that. But
how do you feel about that? I mean, do you like seeing this sort of thing, or did you kind of like it when it was a little bit more underground and sort of the general public wasn't quite so aware about it?
I mean, I'm honestly happy. I'm maybe a little bit less cypherpunk than some of the people that were kind of originally in Bitcoin for those reasons. Kind of the same community that kind of birthed the internet. Are they really happy with where the internet went from there? I don't know, but I mean, it serves a lot of people today and makes their life better, and I don't think we could live without it. So I think Bitcoin is, certainly being part of the internet revolution and the money of the internet. So yeah, I'm happy about it.
So what was that conference like? I mean, who were the sort of people who were speaking there?
Well, that's what's interesting too, is when I went there about 2 years ago, it was kind of, it was you still could feel that Bitcoin was small, right? It was a lot of very Bitcoin-centric companies, like some company that was, doing Bitcoin ARB and, a couple wallet companies. This time, though, I mean, the names that were there and that were speaking, Deloitte, the CME group that runs the Chicago Mercantile Exchange, Fidelity was there. Citigroup was there. These are big names that everybody knows. So I think that was the real big difference between the conference of 2 years ago and this one is, wow, how far have we come? We have, very household names that are interested in the space and involved in it too.
Yeah. Actually, it's just come back to me, something I was going to ask you just before. You know how you said when we spoke, what was it, like back in 2015, towards the end there, Bitcoin was about $460, give or take. Do you recall people saying that was really expensive then? Was there any talk like that?
It's interesting because that time we talked, we had just broken out after almost a 9-month downtrend into a sideways where we were basically stuck between $200 and $300. So a lot of us, at least in the community that had survived the bear market, we thought like, wow, like, Bitcoin just doubled, at that time that we were talking. I don't know if we thought it was expensive and stuff, but we weren't getting the kind of publicity that we're getting now. And I can only kind of look at that a little bit in hindsight and compare it to the bubble prior that we fell from. But, the space had just kind of been left for dead for quite a while.
Yeah, the only reason I asked that is because I kind of get the vibe from different bits and pieces you read and headlines that pop up. There's certainly that idea that Bitcoin is very much overpriced and very expensive at the moment. How much is it right now?
As we sit here right now, it's 2660, call it. I mean, there's some variation in the exchanges, but 2600. It's interesting you bring that up, and we can definitely go into that in the podcast because I think this adoption wave has spawned what I call miss the boat syndrome type people. People basically that have heard of Bitcoin. They, maybe they read a few articles on it. Maybe they even bought, some just to see what it was about. But they were kind of more or less just observers, and they thought it was cool, it was neat. Only to watch it go from, say, 400 or 500 up to almost, touch 3,000 at one point. A lot of those people, I think, are almost like mentally or psychologically, predispositioned to not want to buy it now because they remember when it was $500. So then now the wave is, a lot of them bought Ether and a lot of these ICO projects that are coming out. So, I actually have friends that they know I've talked about Bitcoin forever. Some have even bought Bitcoin and sold it quickly, or they just didn't buy much. And now they like talk to me about Ether like it's the second coming of Christ.
And do you tend to agree or not quite?
I mean, I will say I underestimated Ether. I have to be very fair about that. Definitely a lot of potential that I missed. I just think Ether is more of an app-centric project, and there's a lot of potential that could far exceed anything that Bitcoin can do. Bitcoin transfers value really well. Ether can make a lot of these projects into incredible things, but that comes at a risk too. I mean, the DAO hack was a product of a missed bug in the code, basically. And I mean, yeah, they fixed it, but what's to say when we get to these complex projects and code that they're trying to put into Ether? It sounds really good right now, but let's see it actually play out. So I'm cautiously optimistic. After being a pretty big Ether skeptic, I've come around to appreciate it a lot more.
Okay. Well, I mean, we'll definitely talk about that a little more as we get into things. Just before we do, let's sort of, I guess, just go over some basics. I was having dinner the other night with my girlfriend and one of her friends, and somehow Bitcoin came up. I obviously brought it up. And my girlfriend's friend had never heard of it. And she's like, well, what is it? And I was kind of a little bit stuck on how to explain it. I was like, well, it's this decentralized kind of digital currency. She's like, okay, but like, what can you buy with it? Like, how can you use it? And I didn't really know what to say. So, I mean, I want to ask you, how do you explain Bitcoin to people outside of finance?
Yeah, and I'm glad you brought this up because I was looking down the list of questions and I felt pretty comfortable. And then I was even asking some of the people in my group, like, what do you do with this question? Because it's certainly been asked to me before. And I don't ever think I've mastered the way of actually explaining it. In short, I usually say it's digital cash or digital money. And, to kind of go further than that, you have to understand that, the internet prior to Bitcoin existing was, if I said I had a file on my computer, I could copy, paste, and send it to you, and you have the same file. So there is no such thing as digital scarcity. Bitcoin basically is one of the crowning achievements of it is it introduced a way to prove scarcity. And now you have a digital asset that has value and can be transferred, and there's no way that I can copy paste that to your bin and you can have that same value. That's where the blockchain comes in and where that ledger is verified. I don't know. Is that a good way to explain it? I don't know how deep you want me to go with it.
I think it is. Like, it certainly hits on the technology behind Bitcoin, but I think a lot of the confusion from people who are certainly outside of finance, and maybe even quite a few people inside of finance, are like, but where can you actually use it? Like, you can't really buy anything with it. I mean, there's the odd sort of site around that accepts Bitcoin, but for the most part, like, there's no real way for you to actually spend Bitcoin, is there, and actually use it to buy something?
Well, I would say that the dark markets would have, they would have a strong contention to that point because, whether it be ransomware related, drugs online, or actually one of the bigger spaces that's been growing and one that I'm a part of, the online gambling scene, has been adopting, Bitcoin as a funding mechanism. So, obviously you're not going to Chipotle and paying for your Chipotle, but between the dark market and then there are actually a lot of gift card companies. It's just an app on your phone, Amazon, Target, Caribou, Whole Foods. Like, I can basically pay for all the stuff that I use almost daily with Bitcoin. But, there's a proxy there. I don't know if that's something you want me to explain because, still Bitcoin is best used for a lot of the nefarious things.
Well, tell us a little bit about that proxy. I mean, feel free to go into that if you like.
Well, the original, one of the first use cases of Bitcoin was on the Silk Road. And the Silk Road is this online drug bazaar that, they didn't take credit cards or Western Union or anything. They took Bitcoin because it has, when the transaction occurs, you have the asset. It's irreversible. There's no chargebacks. So, that's why it became really prominent in the drug space. And there is certainly, some people thought it was anonymous. There's kind of a confusion that Bitcoin is anonymous and untrackable, which is not true. And now we're actually seeing, we have Monero and we have Zcash that are trying to basically put that element of anonymous transactions to the final, the final place that Bitcoin couldn't get to. So, the dark markets are adopting those currencies as well.
Yeah. So, it's this sort of thing, you've just given a few examples of where you can use Bitcoin. Some of them are obviously household names, but then for a large part, it's still widely accepted and the main currency used on the dark web for buying things which you maybe shouldn't be buying. I don't really think that does any favors for people's perception of Bitcoin, does it, when they hear that sort of thing?
No, it doesn't. And then my second part would probably be that its largest use case right now is still speculation. If you're not using it to buy such things as that, you're probably buying Bitcoin because you believe that, this fulfills a missing part of the internet. Credit cards aren't native to the internet. They have lots of issues. Bitcoin is kind of that next step, or more so, cryptocurrencies are the next step. So I think the kind of belief in the technology is going towards, the blockchain stuff. And that's kind of where a lot of people, I think, that have been critical of Bitcoin specifically are saying, well, no, I believe in the blockchain. But Bitcoin, I don't really know if it itself needs to have value. It's just, as we sit here today, it has the largest network effect. It's the most secure cryptocurrency on Earth currently, and that, conduces a lot of value.
Yeah. So you said that just before that the transactions are not completely anonymous like a lot of people think they are. I mean, what parts of the transaction are not anonymous? Like how trackable is it?
Well, there's a couple different ways that they can actually pinpoint to you directly. Say you decide to buy your Bitcoins on an exchange where you have to provide, know your customer information, like a bank account. So if you go and buy Bitcoins on, say, Coinbase, and you send them somewhere, they know where you're sending them. Now, it could be that you send it to your personal wallet and you sell it to somebody on the street and it gets lost in there, but they actually, now know an identity in that chain. Also, there's, your IP address, depending where you send it from, can be tracked. I think that's why a lot of people that try and be anonymous with Bitcoin use the Tor network.
Okay, so is it always been that way, or is this something which has come about with more regulation and etc.?
It's always been that way. It's just the tools that law enforcement or those wanting to track transactions has improved quite greatly. And some of it's not just law enforcement. I mean, during the whole Mt. Gox hack and plenty of exchange hacks, people try and track where those coins have gone. Doesn't always necessarily mean they know who has them. I mean, they can see on the blockchain that's public and everybody can look at it. They know where those coins are sitting. It just depends if they end up interacting with somebody that can then identify them, or they leak their IP address or something to that effect.
Okay, right. So let's talk a bit about actually getting set up. I guess just for a bit of context here, I'm probably fall into that category of the boat which you described earlier, the people who, what was the analogy you used? Wasn't fear of missing out.
It's kind of FOMO, but I actually call it now the missed boat syndrome people.
Right, yeah. So, I've been saying for probably the last 12 months, I really should buy some Bitcoin. I don't have no intentions of trading it. I just want to put some money into it, and just sit on it for a while and see what happens. The way I look at it, if I put a few $1,000s into it and it goes nowhere or it loses value, no big deal. It's not going to change my life. But if it continues on the path that it has been, then, it seems like a pretty good bet. So I was like, okay, I'll buy some Bitcoin, I'll buy some Ethereum. But when I actually came to do it, I didn't really know what was going on. I was a little bit confused by it because it's very different from opening a brokerage account and funding a brokerage account, isn't it? So do you just want to describe to us a little bit about how you'd actually go about opening an account if you wanted to buy, let's just stick with Bitcoin for this example?
Sure. And some of it is certainly dependent upon where you live, but I'll come at it from my perspective of being in the U.S. So as we stand right now, there's really two prominent avenues, I would say, that somebody in the U.S. would go about trying to get Bitcoins. Actually three, but I'll gloss over one of them. Well-known company, Coinbase. It's Andreessen Horowitz, venture capital-backed company. They're out of San Francisco, and it acts much like setting up a PayPal account. You end up basically buying Bitcoin through an ACH transfer. I'm not entirely sure on the fees. I think it's 2%. Certainly a bit of fees there. Another avenue, I know you had Benjamin Small from Gemini on. You could wire money into Gemini, go on their exchange, buy Bitcoin that way. They also have a way to trade it directly. Coinbase does have an exchange. It's just not available in all states. So, we'll stop right there as far as obtaining Bitcoin. Now, trading Bitcoin is another page to turn that we can go down, but is that kind of the answer you're looking for?
Yeah. Okay. So essentially what you need to do is you need to open a wallet, don't you? You need to open a wallet or create a wallet, and then you need to put your fiat currency into that wallet, which is, in this case, a Bitcoin wallet. Is that correct?
Not totally. I mean, if you're using Coinbase or Gemini, you're effectively funding a wallet that they're in custody of. So you don't necessarily need to have a personal wallet if that's what you're going to do. Now, you can go down that path.
Even if it's on Coinbase, though, it is a wallet in some sense, isn't it? Like it's your wallet on Coinbase. Am I understanding that right?
Yes, but when you open an account, you're effectively opening up a wallet that's in their custody. Kind of similar to opening a bank account, right?
Okay. And so what's the alternative to that? Having a wallet that's actually sits on your computer, on your hard drive?
That is one option. I would say that many people now are going towards what we call a hardware wallet. Basically, is a jump drive. You plug it into your computer, you get it all set up. There's a PIN number on it, and now basically your entire computer can be infected with malware. But since you have the hardware piece that doesn't cross the barrier between your computer and it, other than to sign the transaction, you're no longer at risk of basically there being keyloggers or some kind of virus on your computer that would swipe your keys.
Right. And so, I mean, that sounds a little bit tricky to set up. I mean, how difficult is it?
Actually, it's not too bad, other than the hardware wallets are on back order till like September. It's really not bad at all. They give you pretty step-by-step instructions. They actually tried to make it kind of idiot-proof to some degree. And literally, it's just a jump drive you essentially plug into your USB port. And you can... I know they have Ether support on there as well as Bitcoin, so you don't need two jump drives for different currencies. I think they're actually bringing on support for some other ones. I haven't been following it too closely, but that's certainly one way you can store it. Now, you could store it on your own computer. You could store it at other exchanges.
So these jump drives you're talking about, I mean, how much do they set you back roughly?
Like under $70.
Oh, okay.
So not bad, yeah.
Right. I was sort of wondering if that was maybe something that you should consider when you start getting a bit more serious about it and you have a fair whack of cash in, or not cash, but a fair amount of Bitcoin. But, for $70, I mean, that's pretty minimal.
Yeah, I think a lot of people thought that, and that's why, after this largest price rise, we've seen, them back ordered till, I think it's September. I'm not quite sure, but I know they were sold out for the last time I asked somebody if they were getting it.
Okay. So you touched on fees before when you go from fiat currency into Bitcoin on, let's say, Coinbase as an example. Where else do you pay fees? Like, do you pay fees every time you send Bitcoin to another wallet or onto an exchange? Or are there any transactions that are done without fees?
It's kind of interesting you bring that up, because the Bitcoin network, one of the big criticisms and source of a lot of political wrangling, is the scalability of Bitcoin. Satoshi, way back in the day, put the 1 megabyte cap on blocks. Now, we've been running up against that, and we've seen the need to actually apply a higher transaction fee to send Bitcoin across the network to get picked up in a block. When this basically backlog of transactions happens, called the mempool, you now need to adjust your fee upward to get it into a block and have it confirmed. So, I mean, if I was sending Bitcoin to you, if we wanted to basically confirm within 10 minutes, we're probably paying, somewhere between 50 cents to $1 now, depending on the size of the transaction and some other factors. So it's interesting that Bitcoin actually has become kind of expensive now to move across borders. when it used to be, half a penny. So those are things that are, is kind of coming to a head here within the next couple months of whether there will be a scaling solution and agreement on it or not. They'll make probably interesting tradable event, but there's fees there, as well as when you go on exchange and you're going to, buy and sell Bitcoin, depending on the exchanges, you're paying fees on that. It's usually, though, quite a bit less than what you pay at a typical broker. I suppose that's a little bit dependent upon the size you're trading as well, but, some of the fees are quite minimal.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Yeah, would you mind expanding on the scalability issues a little bit more and paying extra fees to get your transactions across quicker? Could you just go into that a little further?
Yeah, so, a long time ago when Bitcoin was just a technical experiment, Satoshi ended up putting in that the block size, which means is how many transactions can fit into each individual block, would be 1 megabyte. Back then, it was they just put that in there just as kind of a placeholder. Now we've come multiple years, and now Bitcoin is a $40 billion currency, and people want to scale that. Now, the miners that want transaction fees, they're not wanting to go along with this because they want to collect more transaction fees as long as they can. And there's a tremendous amount of politics that are going on between the different users of Bitcoin, whether it be the miners, whether it be the actual users of it, the wallets, the exchanges, and then the people developing the code, the core developers. So basically, we've run into a situation where the network is processing so many transactions that now you're having to raise the fee to get into these blocks. And if you don't raise if you try and send a transaction with 0 fees, it's possible it might not confirm for days. And depending if there ends up being a pretty big backlog of transactions that have fees in front of you, you just keep going to the end of the line. So I've never actually had that happen. I know some people have gone about doing services to try and get it accelerated and paying basically mining pools to mine that block for quite a very large fee that they now want to get through the blockchain. So, these are issues that are coming up as far as the scalability of Bitcoin. And it's been a lot of the other currencies, including Ether, have been trying to kind of say, hey, we're we're cheaper now and our network can handle the scalability, which is funny because today, or really yesterday, during one of the ICOs, we actually saw the Ethereum network have scalability issues as far as getting transactions in, and the network was really backlogged. So it's not quite as cheap to send Bitcoin anymore unless we get some of these scalability issues in place, and more than anything, that there's consensus for it.
Okay, but how do you actually decide how much you're willing to pay in fees? Like, do you have any say in that, or does it depend on?
So the wallets you use, they actually are pretty good now, where it's kind of dynamic, and they'll tell you like, if you pay this fee, you should be in the next block. If you pay this fee, it's usually they'll change it into a dollar amount for you too, and tell you you'll be in the next 3 blocks, so 30 minutes. So it has gotten to the point where they'll kind of, they're estimating about what fee you pay, you should be able to get into the next block or so. So it's not quite, you aren't just picking something out of the sky. And even the exchanges that do transactions regularly adjust those and give you kind of a suggested fee so that your transaction would actually go through. So does that make some sense?
Yeah, it does. Just I'm going to fire another question your way around that. When you talk about the block, and I have a feeling we may have spoken about this when we did the last podcast, but what is the block actually referring to?
The block is basically, there's a period of time between this really difficult puzzle being solved. And during that time, basically, the transactions that are coming in are getting assorted based upon highest to lowest fee. And as we get up to the 1 megabyte cap, those are the transactions that are going to go through the block. And then when the block is solved, which is this complex math problem, they now are fully put into the blockchain, and you get one confirmation then. Your transaction's now confirmed, your transaction's in the blockchain officially, and then the miners just move on to solving the next problem, and the next block is basically compiled the same way.
Okay, so how many transactions, I don't know if this is the right way to ask the question, but how many transactions would it take to fill up a block of 1 megabyte?
I actually don't even know the answer to that question.
Like, I presume it would be thousands and thousands, right?
Yeah, and it's also dependent upon, like, how complex your wallet is. Like if you sent one transaction to your wallet and there's, say, 10 Bitcoins there, and you send it once, your transaction is actually smaller in bytes, as well as you'll require less of a fee to get it into the blockchain. But if, say, you sent 3 Bitcoins in from, I don't know, let's say Bitfinex, and then 3 Bitcoins in from Poloniex, and 4 from, another exchange, and then you try and send that, the fact that they're actually needing to go back and look at where those transactions have come from now means that your transaction has more size to it. So it's going to cost you more. Does that make some sense?
Yeah, I think so. Just a question around the mining of Bitcoin, and I have a feeling this is maybe also something I asked you last time, but is it possible for all coins to be mined? Like, is that ever going to happen, or is it set up in a way that there will always be more coins to continue mining?
Yeah, it's an asymptote, so it approaches, but it can never actually reach the 21 million in existence, at least in as far as Bitcoin goes. So there'll always be some block reward. It'll just, I think it's every 4 years. It's actually based upon how many blocks, but it takes about every 4 years. The block reward, the mining reward for solving blocks halves. So, as you can imagine, it started at 50, it went down to 25, 12 and a half, 6.75. It's just going to keep going until, it can never actually reach 0. So there'll always be new coins entering the system, it'll just kind of grind to a halt, though.
A little bit earlier, we kind of spoke about how to turn your fiat currency into Bitcoin, for example. Let's say someone wants to buy, let's say Ripple, just as an example, one of the lesser known but somewhat becoming increasingly popular cryptocurrencies. How do you actually buy Ripple? Like, how do you go about that? Do you need to be holding Bitcoin and then convert that Bitcoin into Ripple, or can you go straight from fiat currency into Ripple like you can from fiat currency to Bitcoin with something like Coinbase? Or what's the process of doing something like that?
There might be, I'm not quite familiar if there's any, I'm sure there's some exchanges that are allowing Ripple to USD pairs. So if there's a way you can fund those accounts with US dollars, you'd be able to go about doing it that way. But I would say probably the most common way of doing it is to first buy Bitcoin and then go to an exchange that has a Bitcoin Ripple pair. Coinbase doesn't have it, Gemini doesn't have it, but Poloniex does. They are US based. They have a lot of the, I guess, altcoins or other digital assets there. So, the gateway usually ends up being Bitcoin. It's not the only one. There's, Litecoin and Ethereum both seem to have fiat gateways that have kind of come about, especially in this last bubble or adoption push. The most common way to access those other currencies is probably going to be to first buy Bitcoin. Okay.
So let's say someone just wanted to hold Ripple. I'm not saying you should, but let's just, as an example, if someone wanted to do that, they would essentially, if they were to do it through, Poloniex, they would essentially be holding all their Ripple on an exchange, wouldn't they?
Yes. Yep. If they keep it there, they have the counterparty risk of the exchange as their risk.
Okay. And is that, like, generally speaking, is that a smart thing to do, or is that something you'd probably advise against doing, is actually holding your money on an exchange if you can avoid it?
The issue is even though Bitcoin might be a really fantastic vehicle to send across the earth and to use when you're in possession of it, when you have a third party, whether like an exchange that now has custody of your, they're holding the private keys. So when you ask them to send Ripple somewhere, they're obliged to do it. They could say no, they could get hacked. There could be plenty of different factors where those coins on there are no longer, they're not yours until you send them to your own wallet. But more so, there's the risk of that counterparty, losing the coins, getting hacked, or something to that effect. That's why, for traders, we do have to have some coins on exchange. But if you have a large holding, you should either diversify at minimum or look to some kind of wallet solutions that you hold the private keys. So, that Ledger wallet, that hardware wallet I was talking about is one solution. There are a number of other ones.
When you say diversify, in what way are you talking about diversifying? Like diversifying your holdings across multiple exchanges?
A lot of these exchanges trade the same asset. I'll use an example. I know you're using Ripple, but I'll use Ethereum. Outside of Bitcoin, I would say Ethereum or Litecoin is probably the most popular. So, Ethereum trades on Poloniex, it trades on Gemini, trades on Bitfinex, trades on, Chinese exchanges. So if you put all of your coins on one exchange and that exchange goes down, whether it be, temporary or otherwise, you don't have access to those coins, or it's possible you could lose all of them. So I would suggest at minimum, you shouldn't hold all of them in one place, whether it be on other exchanges, or probably the more prudent thing to do would be to actually have a hardware wallet where you keep the majority of them in your possession.
Okay, sure. Since we last spoke, I think one of the major hacks which has happened, and feel free to correct me on this, was the Bitfinex hack. Can you tell us a little bit about actually what happened there, and maybe we can go into that a little bit?
I mean, the Bitfinex hack, definitely not the largest, but one of the largest. It was 120,000 Bitcoins at the time. I don't know, I can't really do the math in my head, but that's
a lot of money.
Yes, it's a lot of money. The interesting thing about the Bitfinex hack is they were using a implementation of BitGo, which BitGo, they sell themselves as a software as solution company, even though some may say their website doesn't really look like that. And basically, they were auto signing these transactions. It was 120,000 Bitcoins left Bitfinex in under, I think it was like 40 minutes. And there's multiple signatures involved. Bitfinex was one of them. Bitfinex has another one in cold storage that wasn't used, but the other signee was BitGo. Since then, Bitfinex introduced basically a debt token. They've since paid all of that back to their debtors and retired the token in under a year. So it's kind of a successful failure in a way. I don't really know how to describe it. Certainly people that received the debt token and took, I think it was a 33% haircut or a 36% haircut at the time, did not receive all of the funds that they originally had on that exchange. Others that waited maybe did.
So what's a debt token? Is that like an IOU or something?
Yeah, I mean, that's pretty much what they did is they introduced called the BFX token, Bitfinex BFX. They issued the same amount in dollars that they owed to each person because the haircut of losing 120,000 Bitcoins was, I'm not 100% sure, it was either 33 or 36% across all people on the exchange. So you had $100,000 there. Basically, they took, $33,000 from you, and they gave you the same amount in debt tokens. The debt tokens traded all the way down to, it's supposed to be $1 per debt token, but I think it went all the way down to like 30 cents or 20 cents, especially after the hack, and people dumped their tokens. Eventually, it was redeemed for $1. They retired the entire outstanding debt that they had.
Right. So the people who were responsible for the hack, were they ever caught? Does anyone have any idea who was behind it?
I know there's still some investigations going on, but I have no idea. I've not really heard much from that. Bitfinex, not long after the hack, did kind of put out a press release saying, hey, hacker, if you want to spend some of your Bitcoins faster, how about let's arrange a deal where you give some back and we'll give you a more anonymous currency like Monero. It was an interesting gesture. I'm pretty sure they did not get any response from that.
Okay. So who actually investigates this sort of thing? Like, who steps in there?
I can only say from what Bitfinex has said. I think they listed a number of the authorities. That includes the FBI. I think maybe some of the British authorities as well. That outside of that, I really don't know who investigates that.
Yeah. No, I was just wondering because, I mean, a lot of these exchanges aren't as regulated, obviously, as, your stock exchanges, your futures exchanges, etc. So I was just wondering, like, how much authorities really were concerned about these type of events, if at all.
I mean, I do think it was a very high-profile hack. It got quite a bit of coverage from Bloomberg and other mainstream financial news services. So I certainly think they're involved. I just don't know to what degree and who all the parties were. I mean, Bitfinex still hasn't been that forthcoming as far as all the stuff going into that. And it's been a criticism of them. I don't really know.
Okay. So, obviously this hack which we've been talking about is quite a high profile hack. Are there smaller hacks which are happening much more frequently, which perhaps don't get as much coverage? Like, is that something which is taking place quite frequently still?
I'm just trying to think if I've actually heard of any hack recently. I don't know if I really have There have been issues where, I mean, Ethereum not too long ago cost an exchange, I think it was upwards of 10 million, and it was more of an issue of how they implemented to take Ethereum as far as deposit and withdraw. So, I mean, it wasn't really a hack per se, but it was some kind of exploit that did cost the exchange money. And those things, you know, they are real. I know they still do happen. We just tend to hear about the biggest ones.
How about DDoS, like DOS attacks? Are they something which take place from time to time?
Yeah, exchanges are a very high profile, or a very ripe target for DDoS because it induces a lot of panic. A lot of them are web-based. So the stability of a web-based platform is far less than whether it's standalone or API driven. So these people, you know, they may DDoS the exchange, but still be able to access it through API. So they're able to, you know, create panic and, you know, take advantage of those things. It also, you know, it seems when some of the coins, especially on Poloniex, which has probably been one of the biggest issues as far as DDoS or just downtime in general, coins will be, you know, rallying, and the DDoS pretty much so stops that rally from continuing. It, you know, taints sentiment, and people are no longer that willing to trade it or just be involved in something that they don't know if they're going to have access to the platform.
Yeah. So, I mean, with all of this being said, like, how do you decide who's trustworthy? Because, like you said, like, this is very real. Like, these things do take place. You know, no one wants to be having thousands and thousands of dollars somewhere and sort of be overly concerned about the possibility that they might lose all that money through no fault of their own, you know. Like, how do you decide who you can trust? I mean, are there any red flags for, I guess, like signs for exchanges or wallet providers who you should stay away from?
I mean, the one good thing about the Bitcoin community is all these exchanges are essentially startups. So they're usually pretty small teams. They're not really large organizations, and these people that are running them or, you know, representatives from them are very accessible. So one of the really good things that has come about after, you know, the Mt. Gox hack and fall of Mt. Gox some years ago is the exchanges actually, many of them we do talk to quite regularly. I mean, daily, with many of them. So some of that is these people are here present in our community. We talk to them a lot. We definitely give them a lot of flack, rightfully so, when things aren't going right. We see how they kind of handle under that pressure. Do they just shut down and not want to hear us, or do they take that criticism, make their platform better, and stuff like that? So all of that kind of goes into a trust element, where if you're going to trade Bitcoin, you have to have some element of trust to put your money on these exchanges. Thankfully, the double-edged sword of leverage has actually made the ability to trade Bitcoin more so, because you no longer need to put as much on exchange to have the ability to trade as much as you would have before. Certainly there's other risk associated with that, but leverage is actually one that mitigates some of your exposure risk to putting more coins on that exchange.
Okay. Yeah, that's actually a really good point you bring up. What sort of leverage is typically available?
Depending on the platform. I mean, I think Poloniex and Bitfinex are in the like 3 to 5x range. Kraken as well, and then you can get on to some of the derivative instruments. BitMEX has all the way up to 50x, maybe even 100x. I know they scaled that back a while ago. Some of the Chinese platforms, 20x. So, I mean, there's a pretty wide spectrum there as far as the amount of leverage you want to play with.
Yeah. Okay. All right. I'm just thinking about what we should tackle next.
You brought up before I think your first question was how would somebody get Bitcoin? But as long as we were talking about leverage, the next point would be, trading Bitcoin, right? It's not as intuitive as people think, especially people that have been accustomed to, setting up maybe a brokerage account and, trading Forex to stocks to, commodities. Bitcoin is not, it doesn't have as much. It has a very minimal exposure to the legacy system that people are used to trading. Now, I say that because there is an instrument called GBTC. It is Barry Silbert. He was the creator of Second Market, which was famous for offering shares of Facebook in private before they went public. And there's a bunch of other tech companies in there, but he actually is the only one that has a Bitcoin related entity that trades on, I think it's NASDAQ OTC. It's a closed end fund. So people that say, want to go through Fidelity and never want to touch Coinbase or buy Bitcoins and deal with the custody aspects that we were describing before, they could go on to, their TD Ameritrade platform and trade the ticker GBTC. It's the Bitcoin Investment Trust. Now, there's like a lot of funds, there's fees involved. And right now, the most interesting thing is it's trading at about a 90% premium. I mean, it's at like $4,400 right now. So, it's a 90% premium to net asset value of Bitcoin that it's supposed to track. So you have that. You have the constraints of the typical stock market hours. So it does close. But, that is one element of where if somebody wanted to trade Bitcoin, they could do it through that vehicle.
So what do you mean by it has a 90% premium?
Yeah, so, right now Bitcoin, as we said, is at $2,600. So the Bitcoin Investment Trust is supposed to buy and sell Bitcoins and keep their share price, the share of GBTC, in line with roughly what the Bitcoin price is. Due to a number of things, probably being a lot of the interest in Bitcoin, as well as people maybe not wanting to go to Coinbase and deal with the security and storing Bitcoins, it's trading currently at about a 90% premium. So the GBTC price is $4,400 right now compared to the $2,600 that's sitting on all the Bitcoin exchanges. So it's inflated quite significantly.
Okay. So it is meant to track the price of Bitcoin fairly closely then, but obviously it's not right now.
Yeah. It's supposed to be, but currently it's quite disconnected from the price.
Okay. This isn't in any way similar to the ETF which the Winklevoss brothers were trying to put together, is it? Or is that totally different?
No, it came quite a bit before the Winklevoss. I'm not a securities lawyer, so I don't know how they got it through onto the OTC market. But basically, the Winklevoss were trying to launch on, I think they went to BATS finally, but they were trying to launch a full ETF on there, not a closed-end fund like GBTC. So it has kind of similarity to it, but largely it's not an ETF. It's just a closed-end fund that GBTC is. So it doesn't quite behave the same as what an ETF would. And obviously, we can see some of the downsides is, the premium has kind of run away in GBTC. Personally, I don't know how people could trade it, but I'm coming from kind of a Bitcoin-centric place that I've traded Bitcoin for years, though.
Of course. And that ETF that the Winklevoss brothers were trying to get off the ground, what was that ETF going to consist of? Like, what was it supposed to consist of?
Well, my understanding is the Winklevoss have quite a large holding of Bitcoins as well, and that was supposed to be their net asset value. The ETF, though, was supposed to go about buying and selling Bitcoins to try and keep that in line with an index price. Actually, it was a closing price that the Gemini exchange has been recording for probably like about a year now, maybe a little bit longer. So there were definitely steps to turn it into, a full-fledged ETF. And I think that was the idea behind it. What ended up happening is the SEC basically ruled that the Bitcoin market is too unregulated. And they couldn't see offering an ETF on a market so unregulated, which a lot of us have kind of taken to mean like, well, he kind of shot down all ETFs because it's not like the Bitcoin market suddenly going to become regulated within the next couple months. So that, they appealed the decision, but I don't know if anything good is really going to come of that, because it seems like the SEC has determined that the Bitcoin market is just too not out of their purview to want to bring a product onto exchange like that.
All right, so let's, I think what might be interesting to go into, I know we kind of maybe hit on it a little bit earlier, but is actually talking about Bitcoin as a bubble. What are your thoughts? Is that something you want to get into?
Yeah, one of the interesting things about Bitcoin being a bubble versus is Bitcoin in a bubble. So I feel like a lot of this has been dispelled, but I still see, just even last week, people calling it beanie babies and tulips. And it just kind of like we go through these cycles and people suddenly want to throw away that Bitcoin is a really awesome technology, a real quantum leap in technology, and just look at the price and say, oh, that's got to be, it is a bubble, it's a Ponzi scheme, it's yada, yada, yada. But, the internet, the .com bubble, there was a lot of companies that pets.com and such like that. But the internet survived the .com bubble, and I think we all realize the utility that came of the internet. There was a bubble in those stocks and what was riding on the internet technology, kind of the same way that I feel like we're in now with Bitcoin. I do think the market is exhibiting bubble-like symptoms. We see a hype cycle. We see a lot of people coming out that wouldn't otherwise, track Bitcoin. We're seeing a lot of that through the media. The massive influx into a lot of the social forums, whether it be Reddit, the Telegram. I mean, we maxed out the Telegram channel in like less than a month. There's lots of things going on that feels like a bubble. And as I was saying, I was at this New York conference, and it's every other person has some project they're working on. This on the blockchain, that on the blockchain, and we can get into it a little bit later about the ICO market, but it feels really frothy.
Okay. I guess this is probably a good question to ask. Like, what is a bubble? Like, everyone seems to be very keen to just dismiss this and just call it a bubble. But, I mean, what exactly does that mean? Does that just mean that they think it's overvalued, it's too expensive?
Yeah, and I think the kind of the surrounding things that go into it, kind of the mania and the emotion, kind of give people this feeling that if it's too good to be true, it can't be true kind of thing. And, the unfortunate thing is a lot of people, especially, this is the fourth or fifth bubble that Bitcoin has been in. They've dismissed Bitcoin as a technology and the utility it serves, and never really decided to get interested in Bitcoin because they said, oh, well, it's a bubble, and the bubble has negative connotations, and they couldn't take it seriously because of that.
I mean, what are your views on it? Like, if we zoom out and look at the big picture, I mean, is there any reason why Bitcoin couldn't be worth, I mean, I don't want to name a price, but let's just do it anyway. Let's say like $10,000 within the next 5 years. I mean, there's no ceiling on how high it can go, though, is there?
Some people have tried to quantify it based upon, market caps of, say, companies. Some have said it on, what if Bitcoin could capture 10% of the gold market? kind of from a commodity perspective. Some people have also looked at it from, where does Bitcoin rate in the world currencies? And I haven't looked recently, but I think we're at probably over all of the African countries and some other ones. So there's a different perspective on people trying to quantify how high it can go. It's interesting, but I don't know if there's really a correct answer.
Because to me, it seems like people just want to call it a bubble because they think it's too expensive. But I don't know. I don't see why it can't go as high as it wants to go. Like, I don't see there being a ceiling, although I obviously know a lot less about it than you and a lot of other people. But anyway, just from that's my 2 cents. A buddy of mine actually has this theory, and I'm interested to get your take on it, that younger generations, like quote unquote millennials or whatever you want to refer to them as, don't trust the stock market for investing purposes. And he has this idea that a lot of them are going to gravitate towards putting their money into Bitcoin or Ethereum or some other cryptocurrency. It just sort of seems like more the thing that they would get into. What do you think about that?
I tend to agree. I mean, I'm a millennial. I might be on the kind of outer edge of being a millennial and what it means to be millennial. But one of the big things that led me to Bitcoin and a lot of the interest in it was I used to be a gold bug. I used to be very philosophically sound money, hard money leaning. But as a millennial that carries, like we all do, cell phones around and you're zipping emails, I always thought it was kind of strange that holding this physical gold is what I aspire money to be. And, Bitcoin filled that missing piece of the full digital version of that. And I think millennials as well, not just their distrust into the stock market, but I think they're coming to realize that, money doesn't have to be this physical gold thing. It doesn't have to be a physical bill, so they've actually already separated that bias that I think older generations have a harder time dealing with, but they've just accepted it now.
Yeah, no, it's an interesting thought. I mean, I tend to agree. I mean, I think it's certainly possible. Let's get into this ICO topic. I don't even know what an ICO stands for, and I only heard of it like literally about a month ago for the first time. Do you mind explaining to me and I presume probably a lot of the people listening, what is an ICO?
So first of all, ICO stands for Initial Coin Offering. Now, it sounds to the people listening a lot like something called an IPO. And there are similarities to an IPO as well as crowdfunding. So what happens now is a lot of the big projects that have been coming out, to name a few, some of these projects that are using the Ethereum blockchain, I don't endorse these projects. I just want to give some color to what's going on in the space. Patientory, which is trying to put medical records into these Ethereum contracts. There's Wager that's trying to do sports betting through Ethereum contracts. And then there's Civic, which is trying to break identity verification to the blockchain. Now, I don't want to go into those projects. I just wanted to give some color to what's going on. But when these projects come about, basically, some of them have very well-known people that have been in the space for a long time. They're eventually going to do one of these ICOs. What's interesting is there's some kind of, I'm not a securities lawyer, but in the crowdfunding that goes on like Indiegogo and the crowdfunder, they can't actually sell equity of the company to just, Joe Blow down the street. They need to get accredited investor status, and there's a very long process. But what they'll do is those companies have been kind of confined to a lot of like widget companies that, you can buy some widgets that they're going to make. And some of them are cool. I've looked at a few of them. But what is going on in the ICO market is basically you're buying the token that this project is going to ride on. So this project, for example, Patientory, they're doing all this medical records on their Patientory token. So they're initially selling off these tokens, and the value of that token will be traded on exchanges, or so the token will be traded on the exchanges, and the value will fluctuate based upon how they're progressing with the project. So, that's what's going on right now, and there's incredible demand for these projects. I think I kind of told you about what I call it, missed boat syndrome. I think a lot of that is going on in this ICO market. People maybe made some money in Ethereum, and now they're looking to put it into other projects. They're raising tens of millions of dollars, sometimes in seconds, minutes to seconds. It's another kind of sign to me that this market is just, it feels frothy from people trying to seek out more yield in, whatever's kind of new on the block. Does that make some sense?
Yeah, okay. So how do they actually buy an ICO? Like who's able to buy an ICO in a company that's offering these?
So most of these projects are using some kind of Ether contract. So you're sending your Ether to this address. From that, the address processes and will eventually give you the tokens for this project. So some of it's open to anybody that has Ether. And I think one of the big reasons Ether has appreciated so much over the last several months is these projects pretty much so require that you have Ether and use Ether, and they get locked up into these projects for some period of time. So some of them don't do any KYC at all. So, it's open to anybody that basically has Ether.
Essentially, why these companies are doing these ICOs is it's like a sneaky way of raising capital in some ways.
Yeah, it's pretty much so. It's a way to raise capital to get their project going as fast as possible. So they take in these funds, and many of them are at least somewhat transparent about what they're using the funds for. 5%. Each project has its own kind of stipulations, but the idea is they can take this money and start working on stuff of value that will add value to the platform as a whole, which will result in appreciation of that token.
So each token is almost like a little piece of equity of that company?
Well, I want to be careful because I don't think they would describe it that, namely because if it was some part of the company, then it's equity, and probably talking about the SEC getting involved. And that's kind of another story because they may very well get involved at some point, but the idea is basically they have a project, they've launched a token, the value of the token fluctuate based upon their progress in the project. So you have basically a piece of the potential of what the project can yield.
Well said. Very diplomatic. And how long have these ICOs been taking place for? Like, is this a very new thing? Like I said, I only just heard about it no more than a few weeks ago. How long has this been going on for?
I would say that the real kind of craze with the ICOs has been, this is something that's been maybe like a six month kind of heat wave. There have been a number of ICOs that have occurred before that of lesser known coins, but Ethereum itself had an ICO. That's basically the way they launched their project. So people that bought the ICO for Ethereum back in 2014, they basically got one Ether was roughly 30 cents. So now, as we sit here today, Ether is sitting around the $300 range. So you're talking, what is that? 1000x?
Let's run with that. Yeah.
Yeah. So, I mean, basically, I think a lot of that is set a standard where people think, okay, I want to get in right away, kind of at the ground floor. And then, the development on this project will cause the tokens that I bought to appreciate, some of it being staggeringly high as far as Ethereum and some other success stories. So there's where the appeal to speculators has come. And that's why I believe it's almost at the point of being, frenetic. The frenzy that's around some of these ICOs is incredible. Even yesterday, the status ICO, I don't really know what the project is about, but there was literally so many transactions sent into this to get a piece of this ICO that it basically froze the Ethereum blockchain. Like there was such a backlog of transactions that they couldn't process new incoming transactions. Like it was hours to get a transaction through. So, I mean, to give you some sense of the demand that is there, I just kind of put my finger up in the air, and feel the wind, and I'm just like, wow,
Have you yourself taken part in any of these ICOs?
I actually am kind of ICO adverse, mainly because I don't like the idea of locking up capital for any period of time that I can't immediately trade out of it. There's certainly projects that I may invest in or am interested in. I have a pretty strong appetite for sports betting, so Wager being one of those projects that I think is interesting. I still have to do quite a bit more due diligence, and this is by no means a recommendation for it. I think the projects out there that are going on are quite interesting.
Okay, right. Now, just one last thing I want to, I guess, briefly talk about, and then we should probably think about wrapping this up. And I know a lot of people asked me to ask you this question. I mentioned that I was going to be having you back on in the Chat with Traders Facebook group. Obviously, Ethereum has gained quite a lot of popularity. What is the big difference between Ethereum and Bitcoin? Like, how is it different, and is it superior in any way?
There's some very deep technical related things, but what I can tell you is think of what Bitcoin does really good is it transfers value. What it doesn't really do, it's kind of dumb though. I mean, it transfers value really well, but it can't do a lot of other things. Ethereum is kind of the king of applications. So when you talk about taking the technological advance that is blockchain and moving it to much more advanced things, whether it be doing sports betting or, those medical records and all those kind of things, Ethereum has what's known as a Turing-complete programmable code in it. And basically what that means, I'm not a tech guy, so I hope I don't get any hate mail, is it gives it the ability to do more complex things. That those things, now when you ask if it's superior, I think the jury is still out. I'm going to be trying neutral on this. I initially was skeptical of Ethereum. I've since shed a lot of that and do have a lot of interest in it. But those complexities, as far as the code you can put into Ethereum and how to do a lot more things, means there's more moving pieces and for more things to go wrong as well. So, it comes at a cost. And we still don't, a lot of these projects that are coming out now, even some that have come out for a couple years, don't really have a lot to show for it. They're still just an idea. And until those ideas turn into something where we're actually seeing what was promised done, that's where we'll see if Ethereum really is, I guess, superior.
Okay. Time will tell. All right, man. Well, let's leave it at that for now. Is there anything else you want to add, or are we good for the time being?
I'm just looking over my notes. I think that's pretty good. Yeah.
Okay, cool. Well, I appreciate you coming back on. It's an absolute pleasure to have you on the podcast again. So thank you very much. Where's the best place for listeners to go to either find out more about you? And I don't know, I'm sure that people are probably going to have a few questions after having listened to this. Are they best to just maybe hit you up on Twitter, or do you have another suggestion?
Yeah, I'm extremely active on Twitter, still at BTCVix. Also, our Telegram groups have been exploding. We've actually, several of the groups, we've reached the 5,000 user max, but we have the crypto groups Telegram channel actually provides all of the channels that are in our family. And that goes for anything from, Ethereum to Bitcoin to Ripple to a whole other, subset of currencies. So you can go on the Telegram channel, type in @crypto groups, and that will direct you to whatever channel that you want to engage in.
Okay. Oh, that sounds pretty simple. So that's all they got to do.
Yep.
Very good. All right. Once again, man, thank you for doing the podcast.
Thanks, Aaron.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey there, what's good, team? Thanks very much for plugging into episode 135. Now, featuring on this episode is Sheila Kolhatkar. Sheila is a writer at The New Yorker, who was previously a journalist at Bloomberg Businessweek, and prior to that, a hedge fund analyst. But the reason I asked Sheila to come on the podcast is because she's also the author of the New York Times bestseller titled Black Edge, which has the tagline, "Inside Information, Dirty Money, and the Quest to Bring Down the Most Wanted Man on Wall Street." Of course, the most wanted man being referred to is hedge fund legend Stephen Cohen of SAC Capital Advisors, someone who Sheila has become very familiar with through much of her own strenuous and tireless research. So from this conversation I had with Sheila, you'll learn about where Stephen started out in life and how he became an ultra-wealthy multi-billionaire with an elaborate art collection, might I add, how SAC became the target of one of history's greatest insider trading investigations, and ultimately how it all played out. I do hope you'll find this episode interesting. And if you'd like more on the subject, you can grab a copy of Sheila's book, Black Edge, by going to chatwithtraders.com/Black Edge. That will redirect you straight to Black Edge on Amazon. With that being said, I'm your host, Aaron Fifield, and coming to you from New York City, here is Sheila Kolhatkar. Tell me a little bit about your background prior to doing this book. You used to be a hedge fund analyst, correct?
I was, yes. I was a risk arbitrage analyst for 5 years at two small hedge funds. I was not terribly happy doing that, but it was a very interesting, sort of stretch of my career. But I kind of fell into it by accident, and but that did teach me about hedge funds. I mean, I came to completely understand that industry through my job of trying to just research arbitrage opportunities for these two small funds, and that way, it was fascinating. It was sort of an anthropological experience.
So why were you not particularly happy doing that role?
Well, I think that I am just temperamentally not well suited to the kinds of quick decision making that you really have to do when you're a hedge fund trader and analyst, especially doing the kind of investing that we were doing. Often sort of something would get announced or some piece of news would come out and you'd have to make a trading decision pretty quickly. And I'm the kind of person who likes to study and read books and talk to people before I make a big decision.
Yeah.
I am not good at just sort of doing a quick scan of the market and then going with my gut and just going for it. It's just not at all my personality. So, and I just found it extremely stressful because you're investing with other people's money, your investors' money. And if you lose your investors' money, that's a terrible thing. And I just didn't like the responsibility of that.
Sure. I can understand that.
Yeah. Yeah. But obviously some people enjoy that and they enjoy the risk taking and they find it thrilling. But it did not thrill me. It made me very anxious.
So you worked at these two hedge funds as an analyst for a little while. What happened between there and you actually writing this book, which we're going to spend a lot of time talking about, Black Edge? What actually happened in between and what actually inspired you to write this book?
Well, if you fast forward a few years, so I left the hedge fund world and I went into journalism and ended up in 2012 and 2013 working at Bloomberg Business Week, which was a weekly business magazine owned by Bloomberg. And that was a very fun, interesting job. And, the government had started investigating this big insider trading ring and they were making arrests, periodically, and it would be in the news and the Wall Street Journal and CNBC would kind of cover it. But then at the end of 2012, there was sort of a break in the case and some FBI agents went down to Florida and they arrested a former portfolio manager named Matthew Martoma who had worked for Steve Cohen. And that was kind of a big deal because Steve Cohen's hedge fund, SAC Capital, is one of the biggest, most well-known hedge funds in the world. He was someone who was really widely, I don't know if admired is quite the right word, but there was a lot of envy of his success on Wall Street. He was just a famous, well-known, very wealthy investor. So when the government went and arrested this former employee of his, they filed papers indicting this employee, accusing him of insider trading. And it was really clear from the government's filing and what they disclosed about the case that they were kind of interested in Steve Cohen himself. Actually, my editor, Business Week, said to me, Sheila, this is going to be a really big story and an interesting, dramatic story, and you should kind of get on this right now. It's perfect for you. It's about hedge funds. There's a lot of drama, controversy, all things that I like. And, I was reluctant at first because it seemed really hard and like it would be really difficult to kind of find anything out and to get inside it. But I started to follow the story and it just got more and more interesting, I thought.
Well, that's one of the things I was going to ask you is that, doing this, it must have been a really huge task to do all the research to actually be able to put this book together. I imagine that there would have been a lot of people who probably didn't really want to speak to you about this particular case. Am I right?
Yes, that's absolutely correct.
So who were some of the people you were able to interview for the book?
Well, I have a sort of disclaimer in the book where I describe my reporting process, and most of the people I spoke to, I agreed not to identify them as sources in the book. A lot of nonfiction books are kind of written this way because otherwise it's true people are nervous about talking to you. While the case was still going on, I went around to everyone on all sides of it, the hedge fund side, the legal side, the government side, and I explained to people, I'm doing this book. This is a long-term commitment. This is going to be a sort of an historical record of a really important series of cases that you are involved in. You know, we want to get it right, and I'm going to be fact-checking the book. I wrote letters to people. I begged people I knew for introductions. It's very painstaking process. You know, it's a painstaking process and takes a lot of time, and you run into a lot of dead ends. But over time, as I continued to work on it, people did start to agree to talk to me on this basis that I would not sort of reveal how I knew certain things. I would be using the information I got from people to kind of construct a narrative of what had happened. And there was also an enormous court docket about this case. I mean, there were deposition transcripts and trial transcripts and FBI notes. I mean, just voluminous filings from the government that really allowed you to, fill in a large part of the story. But then, yes, it was conversations and interviews with people, and those took a lot of work. I mean, I had to build trust with people and show them that I was really serious and that I wanted to tell the real story and not make mistakes, and that this would be the final account of what happened. And yeah, it's hard work, but worthwhile, fruitful.
Of course, yeah. And correct me if I'm wrong here, but you actually met Steve Cohen one time. Can you tell us how that played out?
Yes, well, I had been I knew it was very unlikely that he would agree to do an interview with me. I mean, he was under a tremendous amount of legal pressure. There was a possibility during most of the time I was working on this book that he might be charged or go to jail, possibly. I mean, I'm sure he was very nervous, and there's no way his lawyers would have allowed him to sort of sit down with this author and speak openly about what had happened. But even though he had been sort of saying no or just avoiding me, I felt that I had to kind of make a final pitch to him in person about the book and just sort of hear it directly from him that he didn't want to participate. So I knew that he was going to be at an art auction at Christie's auction house in Manhattan on a particular night. It was a very high profile auction. It was sort of one of the kind of big social events of the art world. And he's a big major art collector. He has one of the most well-known private art collections in the world. It's valued at over $1 billion. So it was known that he was going to be selling a painting at this particular auction. So I knew he would come. So I just waited for him in the lobby of Christie's auction house there. And I had my business card and like a little notepad. And I saw him come in, and I just sort of jumped right into his path, and I introduced myself. And as soon as he heard my name, he knew who I was, and he said, "Oh God, I can't talk to you." I said, well, listen, you have a really good story to tell. I want to hear your side, and I want to hear about how you're changing your firm and trying to, improve the culture of the company. And he said, "Oh, I'll think about it." And then he was sort of trying to get away from me as quickly as possible. And then I said, "Well, are you going to be buying art tonight or selling?" And he said, "Oh, selling. I'm selling." And I knew that he was selling this one piece. And then he kind of disappeared into the crowd. And then literally, 30 or 40 minutes later, he bought a Giacometti sculpture for $141 million, I think it was. So I just loved that my one face-to-face interaction with him involved him telling me he was there to sell, but he was in fact there to buy. And I thought that was just sort of perfect.
Yeah, I mean, not to mention he bought a $141 million sculpture. I mean, that's pretty badass.
Yeah, oh yeah, he wasn't messing around.
Yeah, wow. Okay, so many people have probably at least heard of Steve Cohen, mostly probably for the wrong reasons. But what many people probably don't know is that Steve was actually a really good trader in his early days. He was almost like a gun trader from the outset. I mean, what sort of background did Steve have before he actually got into trading? And then we'll talk a little bit about his early days. But, I mean, what sort of background did Steve Cohen come from? I mean, these days he's worth upwards of $10 billion or whatever it may be. I mean, did he come from a wealthy beginning? I mean, what was his childhood and upbringing like?
He came from a very, very middle-class family. He grew up in Great Neck, Long Island, which at the time was a fairly affluent kind of commuter town outside of New York City. And there was a lot of wealth there at the time. And there were 8 kids in his family. And they were not wealthy. I mean, they were very middle class. Money was a little bit tight at times. And I think Steve Cohen wanted to be rich from an early age. That was just a goal he had almost from childhood. And his brothers told me a funny story, which is included in the book, about how everyone in the family sort of felt that Steve would be, was special. Their mother, his brother remembered their mother cooking steak for little Steve and making hot dogs for all the other children. And I just thought that was very funny as sort of a memory that his brother had. Now, I find it hard to believe that any mother would treat her children so differently, but who knows? But just the fact that Steve Cohen's brother remembered this happening was really telling. I mean, there was a real sense that Steve was special. He was really smart. He was going to make a lot of money. And so he was treated a little differently. He started playing poker in high school. And then he went to the Wharton School at the University of Pennsylvania, which is a very famous business school. And that's where a lot of Wall Street titans go to college. And he went there and he finished a semester early and immediately rushed to get a job as a trader at a small brokerage firm. And that was his goal, to get onto Wall Street as quickly as possible.
Okay, so can you tell us a little bit more about his trading in those early days? Like, how did he perform? What sort of strategies he was trading? Where he worked? How he performed?
Yes. So his first job was at a small, not terribly well-respected brokerage firm. It was called Gruntle & Company, and it was located right close to the actual Wall Street in Lower Manhattan. It was the place where there were a lot of misfits. It wasn't sort of a slick establishment corporate environment. It was a little bit wild, and a lot of what was going on there consisted of brokers calling kind of individual investors and trying to sell them on different stock investments. But Steve was hired by a family friend who was also from Great Neck, who had started an options arbitrage desk at Gruntle. So this was 1978, and the options market was very new, and there weren't very many people trading options. I think a lot of people probably had no clue what they even were. Nothing was electronic or digital. So for people who did take the time to figure out the options market, there was actually a lot of opportunity to make money, because it was sort of what they might say was a relatively illiquid market. You just didn't have a lot of competition in doing options trades. And so Ron, who was Steve's boss at Gruntle, had devised an option strategy where you would either buy and sell options on different exchanges, different markets, or you would buy or sell options and buy or sell the underlying stock and basically lock in a spread based on the price differential between the two. And it was just sort of a simple mathematical calculation. You could just do it on a spreadsheet. And it was a no-risk trade, and most of the trades would be closed out at the end of the day. But, if they did this in high volume, they could, over the course of many days and weeks, accumulate all these tiny little spreads of 25 cents or whatever it was they were making on each of these. Over time that would accumulate into a decent profit. And considering that it was almost like a no-risk strategy, this was a remarkable thing. It was like free money. And so Steve joined this very small group of mostly guys from Long Island who Ron had assembled there to do this. And right from the very first few days he was there, he kind of said, listen, I want to just be trading. I don't want to do this option stuff. And gradually his bosses gave him more opportunities to just trade the market, almost like a day trader would do now. And he was incredibly good at this. He developed a reputation as a tape reader, someone who can look at the physical ticker tape, which is what they had back then. When trades were consummated, you would see it on a physical ticker tape running through the office. He could kind of look at the trades coming in and out of the market and just somehow be able to tell which way a stock price is going to move. And he started kind of day trading this way. And he was also very good at determining how pieces of news would affect stock prices. And he was very good at managing risk. He didn't get emotionally attached to his trades. He was very good about sort of pulling the plug and selling something if it just started to go against you. And, the kinds of situations where a lot of people will end up just losing more and more money because they don't want to acknowledge that they made a mistake. He was, according to everyone who worked with him at the time, he was very good at just being kind of dispassionate and analyzing risk in this very cool, detached way. And he just started to make, a lot of money, millions of dollars very quickly. He did this for several years, and it was interesting because a lot of his early period in the financial industry took place during the 1980s sort of stock market boom, when there was a lot of merger and acquisition activity. There was a lot of trading going on based on rumors of mergers and takeovers. There were a lot of kind of corporate raiders going after companies and building up stakes in companies and then trying to sell those stakes. Leveraged buyouts, all these things were going on at the time. So the market was just kind of shooting up, and stock prices were going up and down based on all these rumors. And this is the environment that he was immersed in, when he really learned the trade, as they say.
So at what point did he branch out onto his own to start SAC?
Well, he had a goal for a number of years to have his own fund, because he did eventually, as he became more and more profitable, he started to feel a bit resentful that he had to share his profits with Gruntle, because Gruntle was providing all his kind of his overhead and his office space and his back office services and all that. So he said, well, I don't want to share with them. They don't deserve it. I want to go out on my own. I want to be my own fund manager. In 1992, he cobbled together $24 to $25 million of his own money, and also of his sort of core group of traders who were going to be starting the fund with him, and just friends and family. And they started SAC Capital, his hedge fund. When it began, obviously it was just a tiny one-room operation. They had an office in Manhattan where they were all sitting in the same room, and they would all kind of day trade together. Steve would often kind of set the trading plan for the day, and all his traders who were sitting around him would just follow along whatever he was doing. Again, the market was less mature than it is now, and it was easier to make money doing this. And hedge funds just generally were a newer type of investment vehicle. There weren't so many hedge funds. There was a lot less competition for the good trades and the good ideas. But eventually, as SAC grew and he made more and more money, his reputation really grew on Wall Street, and people started to really watch what he was doing, because he was known to be somebody who was always on the right side of a trade. Traders I spoke with all had stories of hearing, about how a company would announce disappointing earnings and the stock would get killed, and it turned out Steve was short right before that earnings announcement. There were constantly things like this going on where it seemed like he somehow got in at the right time before some news event, moved a stock price. And so people started to try and copy him. And I think this was really frustrating to him, because obviously when everyone else is trying to do this, imitate your trades, that sort of makes it impossible for you to do the trades. All the profit you were hoping to scoop up for yourself gets consumed by all these other people imitating you. So he became very secretive and spent a lot of time trying to prevent the rest of the Wall Street community from imitating what he was doing. And but very quickly his fund grew to over $1 billion.
Just for a little context, can you tell us a bit about the performance of SAC? Like, how well did the fund actually perform?
It performed extremely well almost from the get-go. I mean, in the early years, the returns were higher than they tended to be later when the fund became so huge. I mean, at its peak, it had over $15 billion in assets under management. So that's a very large fund, and it's hard to post, kind of double-digit returns when you're managing that much money. But when he was small, yes, he was posting 50, 60, 70% returns easily every year. And over time, as people learned about this, investors would fight to get in. And eventually he started charging, he started charging higher fees than most other hedge funds. Instead of taking 20% of the profits, he would take 50%. But investors didn't mind paying because the returns were so good. You just couldn't find those returns anywhere else. And it was very consistent. I think in its entire lifetime, SAC Capital had only 1 year where it lost money, and that was 2008. Which was the year of the big financial crisis. And, everyone lost money that year, but it was really remarkable. Every single other year, the fund posted positive performance I mean, statistically, I think that is really difficult. I mean, people eventually started to become a bit suspicious about it because the chances that you can do that so consistently, beat the market, are very, very slim.
Yeah, well, let's speak about that. Okay, so the fund SAC became infamous for insider trading and using insider information. Was it always the case from the get-go?
That it became known for that, you mean?
Yeah, I mean, were they using inside information from the outset? Or was it something that they began seeking out, a few years into this venture?
Well, it depends on who you ask. Some people believe there was possibly illegal activity going on there from early on. There are others who believe it really became more of a problem in the later years when the fund got so big and started kind of expanding into other strategies that were more vulnerable to that type of thing. I mean, one thing I do admire about Steve Cohen was his ability to, he was a businessman. He was an entrepreneur. He was managing SEC as a business, and he was very good at anticipating changes in the hedge fund world and sort of adjusting what he was doing and changing SEC capital strategy to respond and to try and keep out a bit ahead of what the market was doing. And at one point in the early 2000s, he made the decision to become a much more research-intensive shop. And he did not want to rely on outside sources to get good research information about his stocks. And, to that point, they had been speaking to a lot of analysts at big banks. And he said, no, I want to have my own in-house team of analysts who are going to analyze all our investments. And especially as they started to make more investments in sort of biotech and technology stocks, it's very hard to understand all these industries. So he went on a real hiring spree, trying to hire very aggressive, ambitious, well-educated, well-pedigreed traders and analysts who could really understand and research and become experts in these different industries and these different stocks they were trading. During that period when the firm was sort of switching directions a little bit to move in this more research-intensive direction, I do think a lot of the people who got into trouble legally, a lot of them joined during this era. Although not all of them, but there was definitely an influx of new people who started to really look for edge in tech stocks in particular. And that led them into some activities that they weren't supposed to be involved in. So certainly the documented problems, tended to happen later. But there are people who had suspicions going all the way back.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Okay, so he hired a whole bunch of analysts. I mean, how were they getting their information?
Well, so they all had their different strategies, but just to give you a couple of examples, there was one portfolio manager in particular he hired named Matthew Martoma. He's the one who was arrested in 2012, who kind of piqued my interest in the story, who I mentioned earlier. So Martoma arrived, Ivy League educated, smart guy who was a sort of a biotech and pharmaceutical stock expert, and he'd been at another hedge fund in Boston. So he took a job at SEC Capital, and he was a very determined, aggressive, ambitious fellow, and he decided that he was going to pursue an investment in some drug companies which were developing a new Alzheimer's drug. And he knew a lot about Alzheimer's. He knew a lot about the human brain and how these different drugs were supposed to try and address Alzheimer's disease. There's no cure for Alzheimer's. So for the right company that figures out a treatment for this disease, there's obviously a lot of commercial potential. There's a lot of money to be made. So a lot of investors were tracking various Alzheimer's drug trials and trying to make investments so they could benefit if the drugs worked out. So Matthew Martoma, Steve Cohen's new hire, immediately started trying to learn everything he possibly could about these drug companies and about this particular drug and about Alzheimer's and the whole drug testing process. Martoma used an expert networking firm to try and help connect him to sources who would know about these drug stocks. Now, expert networking firms are sort of hard to, this was a type of business that had popped up to cater to hedge funds. And you would basically pay a fee to this company, and it would help connect a hedge fund investor to employees or experts in a particular company or industry who could kind of educate the hedge fund investor about this new company or industry. So Martoma used one of these to help connect him to a doctor who was helping to run the drug trial. This is all laid out in the government's case against Martoma, but according to the government, Martoma immediately started pressuring this doctor to disclose secret information about the drug trial. And the doctor was not supposed to discuss that type of information with him. He was only supposed to talk about publicly available information. However, over time, according to the government, Martoma sort of corrupted this doctor and ended up getting access to the drug trial results a week before they were announced publicly. And this is the basis of the largest of all the insider trading cases involving SAC Capital. And Matthew Martoma was alleged to have paid money to this doctor, gotten this information, then sold off almost $1 billion worth of these two drug stocks. And then in a collaboration with Steve Cohen, shorted the stocks. And then a week later, the trial results came out and the stocks plummeted. And SAC Capital was alleged to have made profits and avoided losses of $276 million. So the largest insider trading case ever filed here.
So the incentive for the doctor in this case, he was obviously being paid to supply the information. I mean, that was the only incentive for him.
That was one incentive, but I think honestly the doctor developed affection for Martoma, this kind of handsome young trader. I think they almost became friends. And eventually he wanted to help Martoma out, and he made a mistake. And he ended up cooperating with the government to testify against Martoma, and I think he really regretted it. It cost him his career. He could have gone to jail. He didn't. But I think he became personally kind of wrapped up with Martoma as their relationship became more friendly. And but the reasons why he did it are it's hard to believe, because he really gave up a lot. It was a really terrible error that he made.
Sure. So would SAC pay for all their sources of information, or was there, I mean, why would people give them information? Obviously, we've talked about this case, but just, I guess, speaking more broadly, why were people offering information to SAC? Like, what was in it for them?
Well, that's a good question. There are all different examples that have come up. I mean, in some cases, according to some of the cases the government filed, there were hedge fund analysts at different hedge funds who were each getting information through various means. Often it was through friends, people they'd known from college, a friend of a friend who worked at Intel or Dell or NVIDIA, some company that makes microchips for computers. The government had exposed one ring of hedge fund analysts at a whole bunch of different funds who were getting information and then sharing it with each other. So there was some trading going on of information. Sometimes people were friends and wanted to help their friend out. A lot of people were paid for the information. A lot of people said, I'll give you information if you kick me some of the profit you make back. There were all sorts of complicated reasons, but it was really a corruption. People became corrupted, and I think a big part of the reason is because of the money. There was so much money to be made, and there wasn't a lot of policing going on of this industry.
Right. Now, when they were doing this and when they were taking on this information, were they knowingly breaking the law at the time, or was this a bit of a grey area?
There's definitely some gray area in insider trading law. And my sense from the cases that I was able to study closely, there are signs that the people involved did know that what they were doing was wrong. They would try and hide it, for example. But many of them did argue that they didn't know for sure, or that the line wasn't entirely clear. And it's true that insider trading is a little complicated to prove. And you have to prove that not only that the person who traded the information, that they knew, the person who trades the information has to have known that it was leaked by somebody who was not supposed to be leaking it. This, usually it's a company insider who has a duty to keep that information confidential. So they have to leak it out, and then the person who gives out the information also needs to receive some kind of benefit for it. They can't just sort of share it as a gift. They need to receive something in return, either money or maybe another piece of inside information if they're trading information. But you have to kind of prove all these elements to really make a case in court that somebody knew. So a lot of people were able to avoid charges by saying, I didn't really know, the line was unclear. And I think in some cases that was true. There is some gray area in this. I guess the only other point I would make is that there were a lot of legal experts who said, listen, if you're a hedge fund manager of any reputation, you know it when you see it. If a piece of inside information, black edge, as I call it, comes your way, you know it when you see it, and you should know it if you're running a big hedge fund. And I think that's also a fair point.
Well, let's talk a little bit about when things actually began to fall apart. So on the legal side, who actually picked up that SAC were doing something they perhaps shouldn't be doing?
The government was in the middle of this big insider trading investigation that had led to the arrest of Raj Rajaratnam, who was another big tech hedge fund manager, not as well known as Steve Cohen, but he had been arrested and was waiting to go to trial. And they continued investigating, and they had developed a lot of sources, a lot of cooperators in that Rajaratnam case. And a lot of people were just reporting to the FBI and even to the SEC that they should look at SAC Capital. And they did. Then they started to sort of turn their attention to SAC, start to find people they could possibly flip and turn into cooperators. And some of the first, most fruitful tips that they got, though, arose right out of that Rajaratnam case. Then it was just painstaking work. At one point, the SEC gathered up all of the suspicious trading reports. Every time there's a suspicious trade and someone complains about it in the market, there's a regulator who gets sort of a letter saying, oh, this fund made a suspicious trade. At one point, the Securities and Exchange Commission, which is responsible for policing the markets, said, we're going to look at all of the referrals regarding SAC Capital. And this huge box arrived of just dozens of these referrals. They were just constantly raising red flags. And then they had to go and start piecing it all together through this very painstaking fashion. They'd have to look at each suspicious trade and figure out who made the trade, and is it possible they could have had inside information to make this trade. And that is how the Martoma case really came together. they figured out that SAC Capital had made this enormous profit 1 week before these drug trial results became public. And that looked very fishy. And then they started trying to figure out, okay, who works at SAC Capital might know someone who was involved in this drug trial, who would have had access to confidential information about these drug trials. And eventually, and I mean, literally this took a couple of years, they found the connection between the doctor and Matthew Martoma, the portfolio manager at SAC Capital. And even once they had those two names, they had to then go and try and find evidence to sort of use to encourage the doctor, for example, to cooperate. And eventually, after many, many months of pressure, the doctor agreed to flip and testify for them. And that was sort of a huge break in their case.
When SAC realised that they were being investigated, I mean, what were some of the things that they did to try and cover their tracks to avoid being caught? Because I remember when I watched the documentary, the Frontline documentary, How to Catch a Trader, which is mostly about Steve Cohen. I remember that, like, the opening scene, a guy talks about taking a computer hard drive, smashing it with a hammer, and then splitting it amongst 4 different rubbish bags and then walking around Manhattan, throwing it in different garbage trucks. Are there any other stories like this?
Well, yeah, I mean, yes, that was a pretty dramatic story. There were people who went and started shredding all their files. There was one guy in particular, he didn't work at SAC, but he was friends with some SAC traders, so they were all swapping information. And this particular hedge fund manager, he read a leak in the Wall Street Journal, like an article that sort of described that this case was going on, and he panicked because he knew he was guilty. And, he ordered one of his underlings to go and destroy all of their files in their office, and he tried to delete the hard drives in his computer. This other SAC Capital portfolio manager you just mentioned, yeah, he did destroy his, he had a bunch of thumb drives where he was keeping all his inside information. He smashed them up. That particular guy didn't even know it at the time, but his very good friend ended up wearing a wire and recording him and implicating him, and they both ended up being charged. It's hard to know. I mean, there's some things we don't know in terms of what happened. The government was very convinced that there was a lot of evidence being destroyed, and this prompted them in 2010 to actually go and raid a handful of hedge funds. They literally stormed into 3 different hedge funds. One of them had been started by, actually 2 of them had been started by former SAC Capital traders. So they were very closely connected to Steve Cohen, and I think the government felt that they would get evidence connected to Cohen from these 2 funds, although they never really did. But they literally walked in there with a warrant on a Monday morning and took out their hard drives and all their files. And this was a really big deal. Hedge funds were not very happy to see the FBI storming into their offices.
No, I can imagine.
And in the end, yeah, it was and in the end, it really was kind of an overreach. I mean, they didn't get anything that was very valuable. And those funds ended up shutting down because that was just so damaging to their reputations. So the government was criticized very heavily for being too heavy-handed with some aspects of this.
Right. So how did all of this play out? Like, was SAC ever prosecuted for these claims of insider trading?
Well, so there was a very dramatic moment in 2013 when, several years into this investigation, there was a lot of speculation that Steve Cohen was going to be charged. He was going to be indicted. He might go to jail. I know he was nervous about this. A lot of reports about his investors panicking and pulling their money out. So in the middle of all this, his team of defense lawyers, because of course he had the best lawyers money could buy, they went down to the U.S. Attorney's Office and they made a big presentation to try and convince the government not to charge Steve Cohen. And they were there for 4 hours. And they basically, they had some sense of what the evidence was that the government had amassed and that they were considering what to do with this evidence. So they walked the government through this evidence. And basically their argument came down to, Steve Cohen doesn't read his email. There were a couple of very damning emails that the government had found that seemed like they had made their way to Steve Cohen. And Steve Cohen's lawyer said, he doesn't read his email. There's no evidence he read this email. You don't have any witnesses to testify against him. You can't prove anything. You're going to lose in court. It's going to be humiliating. And he just sort of, scared them all. So they ended up deciding to indict Steve Cohen's firm, SAC Capital, instead of Steve Cohen himself. And they mandated that the hedge fund be shut down, which it was, and that Steve Cohen's company, which basically means Steve Cohen himself, had to pay $1.8 billion to resolve the criminal charges and also SEC charges. And of course, it was all very humiliating, and his reputation was tarnished, and I don't think Steve Cohen was very happy about it. But, it was not a very satisfying ending for a lot of people, because Steve Cohen himself did not go to jail or even have to go to trial. And in fact, he can start a new hedge fund in 2018 if he chooses, which strikes some people as unfair.
I had no idea that he never even went to trial. That's really incredible. Well, Sheila, I appreciate you coming on the podcast. I'm going to mention, if anyone wants to pick up a copy of Sheila's book titled Black Edge, I'm going to set up a link, chatwithtraders.com/Black Edge, and that'll redirect you directly to the book Black Edge on Amazon. Sheila, once again, thank you very much for coming on the podcast. If anyone wants to follow you on Twitter, what's your Twitter handle?
It is at Sheila K, which is SheeLahk. And it was a pleasure to be with you. Thanks.
Great. Thank you very much.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, everyone? I hope you're doing just fine. Thanks for tuning in. I'm Aaron Fifield, and I'm pumped to share this episode with you. And I also have something I'm pretty excited to tell you about. So let's tackle that first. I've just released a full range of Chat with Traders merchandise, and it's available right now at chatwithtraders.com/shop, SHOP. There's currently 5 designs. They're available as t-shirts and also sweatshirts in all sorts of colors. And something I'd love to mention is I worked with a brilliant designer on these. Someone who has previously designed merch for some really major bands. Bands you've probably heard of, like Goldfinger, Fall Out Boy, Silverstein, So I'm really pleased with how they've turned out. Please stop by the shop, check them out, and help to support this free podcast. chatwithtraders.com/shop, SHOP. Right, now on to my guest of this episode, Mike Agnew. So there's probably going to be roughly 100 listeners who are already very familiar with Mike, and that's because he's the trader who I did the live podcast with at the Chat with Traders event in New York City in May. So if you're one of these people, there may be a few moments of deja vu while you're listening, but for everyone else, Mike came into trading approximately 20 years ago. He started at Chicago prop firm Transmarket Group, which of course was founded by legendary trader Ray Kahneman, and that's where Mike spent a total of 12 years of his career. And over the course of his time there, he actually became one of their largest 30-year treasury basis traders, both in terms of volume and performance. And if anyone recalls Trader Monthly magazine, Mike was named one of the top 30 traders under 30 in 2005, which is certainly a noteworthy achievement. Nowadays, Mike is trading his own book and building out a track record with the aim of launching a hedge fund in the coming years. But you'll hear more about all of this, the things which have helped Mike get to where he is now, and how he trades bonds using a relative value strategy during this episode. Though just before we start, I do need to read out a very short disclaimer for compliance reasons, as Mike is affiliated with DV Trading. So please note that while Mike is a trader within a group at DV Trading, the views he expresses here are his own and do not reflect the views or opinions of the firm. Mike does not represent DV Trading in any capacity. All right, with that out of the way now, here is my guest, ladies and gents, Mike Agnew, coming at you from Chicago. Yeah, anyway, I'm sure we'll get to that in the podcast.
Yeah, I listened to your one just real quick on the your BTC VIX guy. I like that guy.
Yeah, okay. I know you've got I know you've written about Bitcoin a couple of times, haven't you?
Yeah. I've been trying to at least get some exposure to the people out there that don't have it, but are going to hear about it and start to question it, because it's, ever since it seems like Mt. Gox gave it a bad name, and I got burned in that too. But on any new innovation, you're going to have the bad actors, and you just got to weed them out.
Okay, so you have traded Bitcoin previously, have you? Or you owned some?
Yeah, I've been trading it. Yeah, probably for like 2 years at least.
Oh, I had no idea. Okay.
Yeah. I've been talking about it since like 2011, and people, everybody I talk to, everyone's a main like equity bond. They don't like to deviate off into the dark web like Bitcoins. And then I always try to explain it to them, like, you guys have no idea what you're talking about. Blockchain technology, that's going to take over, and Bitcoin is like the first out of the gate, and it's the token basically for blockchain. There's other, Ethereum and Litecoin, all those too, but but Bitcoin's the one that's made it out of the gate and has made it through, this whole time up and down. So, I think it's only got upside, but I think people generally don't understand the technology, and that's what deters them from wanting to even get involved. So, people are afraid of the unknown,
Yeah. I mean, I guess I kind of fall into that category of not fully understanding the technology, like what exactly the blockchain is.
Yeah.
Well,
you did a good job on that interview. Yeah, no, he was very good in explaining it like in general terms. So yeah, I appreciated that one. That was a good one.
Yeah, no, he's really great, and I'm sure he'll be on again at some point. It's a constantly evolving marketplace, that's for sure. And I think things are just getting warmed up.
Yeah, no, exactly. And now you got Goldman Sachs covering it too. So yeah, that's interesting in of itself.
For sure. Now, Mike, to you 20 years ago, what actually got you into trading? What piqued your interest?
So let's go back a little bit further, back to my childhood. So I was the youngest of 8 children. I had 5 older brothers. So there were a lot of learning lessons built into that. And one of the advantages was that I was introduced to like real world things at a young age, some good, some bad. But one of those things were financial futures markets.
one of my brothers worked on the CME trading floor as an ARB clerk, and a few of his friends did as well. So I was exposed at a pretty early age to that arena. My brother would leave these futures magazines laying around the house, and so I would look through them, and it really sparked my interest. I can't tell you what inside there did, or if it was the graphs or the, all that cool stuff, I can't really say for sure, but they basically told me, when I asked my brothers, like, what was all this stuff, was, well, if you could guess the price of something in the future, then you can make money. Obviously it's a bit more complicated than that, but to a 12-year-old kid, it was enough to pique my interest. It was like magic, and I loved magic, so it kind of reminded me of that. Yeah, so that was kind of my first real exposure, I think, at that early, I was probably 12 or 13. And then I can remember looking through like the Sun-Times Chicago newspaper here and going to the T-bills section where they used to list them in there. And I think they actually still do now, but, and then try to check back a week later to see if I was guess the price right, if it was higher or lower or whatever. So I think that's, for one reason or another, that probably intrigued me early on.
Okay. And then how did you actually get involved in trading? Like, when did you actually start to commit some money to this?
Well, I got my first real shot at trading in 1996 when I took a phone clerk job at Transmarket Group, which is a prop firm here in Chicago. So I spent, a lot of my time first learning about the financial interest rate markets, the U.S. Treasuries, to be exact. And that was the area that I would be responsible for. So I was lucky to get the job there. I always wanted to get on the trading floor or get a job down there. And usually you had to start out as a runner or something like that, and then work your way up to phone clerk and then possibly broker or trader. But I interviewed for this phone clerk job, and they, reluctantly took me on. So that was my first exposure, was at Transmarket Group. And basically my job was to answer the phone and enter orders into the futures pits for our treasury cash traders that were sitting up in an office.
Right. And how long did you do that for?
I was a phone clerk from, I think I started in March of 96 to the beginning of 98. And I worked for two separate cash traders. They traded the 3-year and the 5-year. That was their main trade. And so it got to the point for those guys where, and I was very fortunate to learn from these two individuals, Jeff Conrad and Mark St. Amand. They were very good traders. They knew the trade very well. They were very good at explaining it, all the, the new lingo that went involved with bond arbitrage and that. They didn't have a problem explaining their stuff to me, where, some guys like to hide their, their bread and butter, where these guys are basically, willing to, explain it to me so I got a better grasp and better understanding so I could do my job better. So that I really was, grateful for in the fact that they were willing to take time and make sure that I understood exactly what we were doing. And, obviously they benefited if I did well or got them a better fill. And so I did that for like a year and a half. And then it got to the point where I knew their trades so well that I would almost be telling them when to buy or sell, because I would watch the floor guys. And, not that you can do it now, but back then on the trading floor, you had, locals and, which were, the traders, the speculators and the big bond and brokers. And you knew who everyone was. You knew who everyone covered, whether they covered Morgan Stanley or Goldman Sachs or JP Morgan, you knew which guys to watch. So a lot of time, even though the cash market generally led the way, the futures market sometimes would, based upon whatever was going on. So I got to the point where I would lead these guys sometimes, hey, you better hit that cash or buy that cash up, because we're, the futures are going to go bid. And, so I made them a lot of extra money. So it got to the point, where I was like, hey, can you guys give me a shot at doing this? I understand this, maybe it's time. But I felt, I wasn't obligated to work for them at that point. I could trade, because there was other guys doing this. They were trading and clerking. So that's basically what I wanted to do. But it took some time for them to kind of let me at least do that.
Okay. So at this point, you'd gone from being a phone clerk to now swapping over to becoming a trader, and you ditched the phone clerking role?
Yeah, you can only do that if you found someone else to take over your job and did it well enough as you did. It's kind of like a pecking order, right? So basically, I had a phone clerk during the day and I could trade at night. So I kind of had both jobs at once. So it taught me that I could sleep a lot less than I really needed to.
Well, I was going to ask you, I mean, how many hours were you working a day?
I would probably work, well, at that time they had night bonds. So you would work from basically 7 to 2. And then the night bonds would open, at 5 o'clock and then be open, I think, till 10 p.m. So you could work that session. You could work from 7 a.m. till 10 p.m. Or I think in 98, they came out with the Project A system, which was a CBOT, the Chicago Board of Trades electronic system. And maybe it came out earlier, but I didn't have access to it. But then that allowed bonds to trade overnight on an electronic system, whereas the 5 to 9 p.m. session was still on the floor. So that was the trading floor. So basically I would work, from 7 to 10 on some days, if that's what I wanted to do. And that was your kind of progression. Transmarket was very big on you cutting your teeth and, working as a clerk and then working your way up to a trader if you picked up the skill set enough to where, they felt that you could do it. That's kind of how Ray Common ran his operation there. And he was very, I think he took a lot of traders under his wing, and he was very good about that. But he was also, he was instrumental in, I think, probably not only my trading skill set there, but in a lot of guys growing up through the ranks through Transmarket. So, but I knew that was the order that it would have to take, and I knew that I would have to do both of those things, and that was kind of just expected.
Now, these two traders who really helped you and kind of molded you into the trader who you were early on, what were some of the big things that you picked up from working so closely with these guys? I mean, you were clerking for them. What were some of the things that, is there anything that stands out which they really tried to instill in you?
Yeah. I think this was kind of the balancing act because Mark and Jeff were very disciplined traders. I think, not only on what trades they would actually do, but, I think on the risk side of it, being risk averse and knowing when to take risk, when not to, and not just putting something on just to put it on. Whereas Ray Common was kind of more like a risk taker. So they were the balance between that little bug in my ear, Ray Common, and saying, hey, take the risk and let's see what you can do. And then these guys were more of the, I don't want to say conservative because it's very hard to be a trader and be conservative, but they were disciplined. And I think one of the main things that they installed in me was discipline of knowing that you could put this trade on and it might not go your way. So then it's up to you what you do with it from there. Do you add on? Do you take the loss? Do you, just get out and reconfigure it and see why it's not working out? I think they were very good at installing that early on for me. Just that discipline of those choices and when to take them. Timing is everything. So you may have the right trade on, but if you put it on at the wrong time, then then you got to figure out where you go from there. And I think they were very good at that, the timing piece, structuring the trades and why they were doing it. They had good rationale. I understood their trade. So, they would explain to me why they were putting something on, whether it be for a repo play or a calendar roll play, something like that, which some guys in the industry, if you're not in the bond, market, you might not understand repo and that stuff, but that might be a topic for another day. But it's just stuff like that where on a bond arbitrage, as a bond arbitrage trader, you need to know those things, and learning from guys that can do it and do it well is I think highly advantageous for a young trader.
So you had quite an interesting path into actually becoming a trader. You started out as a phone clerk and then you graduated to becoming a trader ultimately. So you kind of had a different path into this than I guess what most traders do, especially nowadays anyway.
Sure. Yeah.
Were there still challenges for you when you did begin trading full time? Because you said, towards the end there when you were clerking, that you were almost kind of guiding these guys on what trades to make and how to manage certain positions. But when it actually came to it and you were trading for yourself, still at Transmarket, of course, were there any challenges that you still came up against?
Yeah, sure. I think the biggest challenge was getting over that hump of trusting that you know how to do it and you can actually do it. I'm never going to forget the feeling in your stomach when you put something on and you obviously you don't know it's going to go your way. It looks good, it feels good, but, it might not necessarily, go your way. And that's not for everybody. And I think that's what separates successful traders from guys that think that they can just do it, is the fact that you can handle certain types of risk. And you don't jump the gun, or you don't, do something irrational where your mentality kind of, dictate your profitability, or you may lose money, or, because you make a silly decision because you let your mind take over instead of letting your rationality take over. So, but I'll never forget that feeling of putting like one of my first, trades on, because I was always worried about Ray Common coming over and say, "Why'd you do that?" Well, especially if you were wrong, he loved you when you were right, but he really didn't like you if you were wrong. But that was part of how he did things. And I think it made you a better trader, because not only did he want you to put on risk and take the risk, but he wanted to see how you handled it. This isn't, that's why I don't really believe in paper trading, because it will never be able to supplant the real life experience of actually risking money and capital. And I think Transmarker was very instrumental in teaching that as well. They knew that it takes money to make money, and they know that not everybody's going to be a winner. But in order to find that winner, you have to take some risk and believe in some of these guys that come in. And I don't think your demographic or your background really mattered to any of these guys. It mattered whether or not, you could actually do it. And like I said, it's not for everybody. And I don't think many people like to take risk. I think a lot of people, take the safe route, and that's okay. And that might be for some people, but for some others, taking risks, I don't want to say it comes naturally, but it's just easier for some more than others.
Absolutely, yeah. How did you begin to build up your risk tolerance? I presume Ray was certainly a big influence on that, but I mean, can you kind of give us a bit of an idea on how you became, I don't know if more comfortable is the right word, but let's just run with it.
Yeah, no, I know exactly where you're going with it. And the simple answer is, you have to build up capital. He always said, having skin in the game will make you a better trader, because you have something to lose at that point. Yeah, everybody can come into a prop group and trade their money and risk whatever and walk away and maybe get a job somewhere else if it doesn't work out. But if you go into this thing with that mentality, forget it. You'll never do well, because you don't respect the capital. So that's one of the things Ray and Transmarket taught early on as well, is that you have to respect the capital, and you have to respect the fact that markets can stay irrational a lot longer than you can stay solvent. So that was one of their, key mantras there. And, I think it worked for me because it gave me the discipline, on the heels of, Mark and Jeff and what they taught me, to build up something before you actually take excessive risk, or maybe, move up in size, which you can make more money that way. Not only hold on to something longer, but you can create more alpha by adding on and building a bigger position. So, but the only way to do that is to, have successful runs and build capital up so that you can do that. I always felt more comfortable when I was doing well, that I could put on more size. And that's really what turned the tide for me in trading, was that I got very comfortable putting on risk as I was making more and more money. And that might not be the progression for everybody, but for me, I felt that with the capital behind me and I knew my risk, that I was very comfortable. And I think being comfortable is one of those stepping stones of being a successful trader.
In the process of doing so, did you experience any kind of setbacks? Like, were there any big hits that you did take by taking that path?
Yeah, I think one of my first early lessons going on the Project Day electronic system. And then for those that aren't familiar with this system, it was the Chicago Board of Trade's first fully electronic system where you could trade bond futures and in other futures that they had at the CBOT. But when I first got my shot at trading, and I was doing what was called 5-year basis. So I would buy and sell 5-year cash on the screen or with broker dealers in New York over the phone, and then I would have to do the futures on my electronic system. Well, I did this one trade in the 5-year, and it happened to be one of my bigger trades that I was doing at the time. And this was probably about a year in or so. And I needed to sell 500 5-year futures, which at the time was a lot, but it wasn't that big. I mean, the 5-year future was probably, 1,500 up. But I hesitated. And back then on the Project Day system, you knew who was trading with you on every site. Every trader had an acronym. Every house had a clearing number. And back overnights, it was me and another guy at Gelber, I think, that would battle in the 5-year space. And I bought up this cash and needed to sell the 5-year futures, and I didn't get them. And his acronym came up, my adversary from Gelber, and I was so pissed. And I missed a 500 lot, which, on every, half tick that adds up to some decent money. It's $31.25 a tick, so $31.25. So that right there, and you never forget your bad beats or bad losses. And I think I had to pay down another quarter or half tick to get those. But that, when you lose that kind of money as a new trader, it's going to sting you, and it's going to, you look back and you're like, well, why did that happen? But in trading, if you hesitate even just that little bit, it's the difference of turning a winning trade into a loser. And, so that point, not that was a setback, but that was a reality check to how quickly something could look so good and turn so bad. So, I don't hesitate even to this day now. If I get, I'm putting it on immediately, just because you don't know what's going to happen in that split second. Even now it's even faster. It's into the microseconds or whatever. But so that was an early lesson, for me to realize that you can turn something good into something bad relatively quickly. But, let me think if there was anything else that happened that I could, just things like that. I think the biggest keys early on for me was taking losses. I was very good at taking losses quickly, like getting out of something, not having a string of losses. Obviously every trader goes through that, but getting out of something when it wasn't going the way that it was supposed to or as expected. I think that made me a good trader as well, because I was very cognizant of my risk base and my risk capital. And I always looked at something like, if it took me more than a day to get back, and that was then I'm losing too much money. That's kind of how I looked at things. And I'm still the same trader today, even though the market's completely different, and the dynamics of the markets are completely different.
Yeah, of course. Now, you were at Transmarket for what was it? It was 12. Was it 12 years in total? I know you were there for quite a while. You left, came back.
Yeah, I was there from 96 to 2006, and then 2010 through 2011.
Okay. So for 8 of the years you worked at Transmarket, correct me if I'm wrong here, but you became one of their biggest, well, not one of, the biggest trader in terms of volume and in terms of performance.
I don't know if I was their biggest trader, but I was definitely one of their, in the bond 30-year space for sure, one of their larger traders, if not largest trader. At one point in time, I would do probably, I can't even tell you how many hundreds of million in a day. Even at one clip, I would do 50 to 100 million all at one shot. But the market allowed for that. Not always, because I do remember this one time I tried to buy 100 million. I got them, and it was stayed offered for like 200 more million. I knew I was in trouble. So, but once again, I knew that I was wrong, and I just got out of it. I knew I could make that back. That wasn't a big deal. But every market dynamic changes, so you have to change with the marketplace. But yeah, no, I was definitely probably one of, if not one of their largest 30-year basis traders there.
So how much capital did you start out with? Like, I'm just trying to get a bit of perspective around like where you started out and how you grew your capital to become one of the bigger traders there, like $50, $100 million at a time. Like that's no joke.
No, yeah. I mean, well, at the time the market, it allowed for it though. You got to realize you can't look at it in today's marketplace. So let's look at it back then. Let's just say it's 2003. I know I can sell or buy 1,000 bonds, and I might not even move the market, depending on what locals are offered down there. Whereas you can't do that now, but back then you could do it. So to answer your question, I think the biggest thing for me was having not a set amount, but knowing when to say when. So like on a given day, if I made X amount, I don't even want to put a nominal number on it. I was done, and it could be 9 a.m. And I would be, I would leave, and some of the other traders would be like, well, you're not going to stay the whole day? I go, but no, what's the point? What am I going to squeeze out of this for the next 5 hours while I've already made my money? The only thing I can do now between this and the close is lose money back. So that's kind of how I did it. Now, that's not how everyone was. I mean, obviously, there's a lot of guys that want to stick there and grind things out and watch it. Maybe something happens, maybe something doesn't. But I was very good on hitting my targets. And no matter if it was 7:45, 9:45, or whenever, I was done. And I would reevaluate for the next trade or the next time. And I would, generally go home flat, just for a clear head and clear conscience. Not always, because there was obviously in the bond there, like I said, there's repo situations or roll situations that you'd want to keep positions on. But I think what really turned the tide for me was building up a capital base so that you could actually take more risk and understand that you have the responsibility now. The success is riding on your shoulders of keeping this capital and growing this capital. Nothing more bugged me than like a debit or having some sort of debit, even on a trading day. That would annoy me. But you're not going to avoid those, right? You're going to have losing days and losing weeks and maybe even losing month, But generally, if you're a good trader, you should easily overcome those things and figure out how to overcome them and why and how to revamp your trading and retool it, as time goes on, because the market is dynamic and it's always changing. So the game is always changing. But yeah, just to answer your question, I think building the capital up to a point where, it allows you the comfortability of extending the risk in your trading. I think that was a big key for me.
Right. Yeah, it's interesting how you point out that if you reached a certain amount, you would call it quits for the day and leave it at that. Whereas some people those are the days where you really want to push harder and try and make it more. It's funny how everyone does things a bit differently.
Yes, for sure. And there's guys that were very good at that. But that was not my mentality. I didn't think that way. Now, that's not to say that they were wrong or I was right. It just wasn't for me. And I think that's another key thing that I try to install in people that are interested in trading is that everyone does everything differently. You can get from A to B in various ways, but they're going to be unique to you. Certainly there's styles you can emulate, but I often point out, after mentoring a bunch of traders, I can show two traders the same chart and they'll tell me to buy and one will tell me to buy, one will tell me to sell, because it's all based upon what our personal, background is. I think shapes you. I think what your personal experiences are, they shape you. It's trading's much akin to like a golf swing. It's very proprietary.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Now, I don't want to gloss over the fact that you were at Transmarket and you came up under the guidance of Ray Carman, because he's considered a bit of a legend there in Chicago and probably further widespread than there. But, one of the things you said that he really tried to push upon you was the willingness to take risk and build up your risk tolerance. Was there anything else which he tried to get across to you? Because, you know, when I think about even some of the traders who I've had on this podcast, when I see one of their names, I instantly think about a certain something they said, like they had this particular thing. It was something that they were really big on. Obviously, Ray Carmen was very big on taking risk. Was there anything else he was really big on?
He called risk stuff. It was always this weird word, like put on some stuff. And no matter what it was, he just wanted to be involved in the marketplace. I think one of the biggest takeaways is, you know, he's like a racehorse, right? I think he's still in the game now, to be honest. But I think what I saw early on was his passion for it. And I think that I already I thought I had a passion for it, but I really, until working at Transmarket, really couldn't grow that. And you really get involved with the dynamics of whatever it is you're trading. My focus was obviously the fixed income 30-year, 10-year, 5-year sector, but other people obviously trade other things. But I think one of the things that I got from him was his passion. He was so passionate about it, and he was so passionate on not only trying to drive you to be passionate about it, but making you figure out whether or not this was for you. He felt like that. I think he knew right away whether or not you were cut out for it, but he didn't want to say that to anybody. I mean, obviously, as you get to know him better and you get to, you know, people could take him. He was kind of an eccentric, so he comes at you from all different angles. And I think a lot of people were very intimidated by him, including me, being a young guy there. But as I got to know him, you know, we kind of build this working relationship, and you know, so I felt I can talk openly with him. You know, I could disagree with him, where other guys I think they never wanted to disagree with Ray. You know, basically because, you know, it's Ray. You know, so where I kind of took a different route. You know, I listened to a lot of what he had to say and take it all in, but formulate my own opinion. You know, I wasn't like I don't want to say a greasy wheel, but I definitely would let him know as our relationship grew, whether or not I disagreed with him or agreed with him. But I think when you want to say one word for like another, when you hear their name, passion definitely is Ray Carmen. There's no doubt about that. And he's very genuine. He's genuine. Like, he wants you to succeed, even though, you know, you might not know that. He definitely wanted his guys to succeed and be the best at whatever they were doing. That's for sure. That's the sort of person you want leading the team. Yeah, no, for sure. And like I said, maybe, you know, it's hard to describe the way he would come off. You wouldn't know where he was coming from, basically. But I knew there was a genuineness behind him in trying to install the passion into any one of his traders. And that's what really resonated with me. Have you seen that photo of Ray online where he's sitting on the side of his bed and he's got 6 monitors on a rig that's on a big swing arm mounted to the wall that swings over, and he can just sit in bed and have 6 monitors up in front of him? Well, you know, it was a lot of the guys. Now, Ray, he ran not only I don't think he ran the cash side per se, but he was more in charge of the yield curve futures guys. He was part of the cash group. Obviously, Transmarket Group was his company, but he would basically have interns work for him and have to go to his house and watch his screens and do all that. But I thankfully didn't have to do that. I was one that didn't have to do the internship with Ray Carmen. I was lucky enough to just work under Mark and Jeff and just hear about all the good stories of Ray yelling at you because you didn't press a button or do something else. But yeah, I saw that one. That was kind of funny. I think that was like in the mid-2000s or something that came out. Yeah, that's incredible. I'll dig up a link to that photo. I'll stick it in the show notes. So if anyone listening wants to see that and really see what passion looks like. Yeah, no, for sure. Well, I know you could see there's probably another photo online of him. He got into some biking because he likes to ride his bike into the work a lot. And I know somebody cut him off one time. He got all bruised up, came in, he was all cut up. And I think somebody snapped a picture of him or something. But yeah, that's the type of passion he has. He's got all this and he's still biking to work. Yeah. So what happened after you left Transmarket? Tell us a little bit about your experience at some of the other places you've traded for. So yeah, then I tried to go into the fixed income arbitrage space as a CTA, which is a commodity trading advisor. So I went off on my own in 2007, and I took me about 2 years to get the CTA designation, which I did. I passed all the FINRA and all the CFTC stuff to do that, but just had a hell of a time raising capital. Obviously it was a 2008 crisis back then and 2009, and everybody was on edge about where to put money and where to put capital. So I spent a ton of my money on trying to build that, and actually it ended up being costing me a lot more money than I thought. So then I'm like, I got to continue to trade and try to manage a business. I can't do both, really. So that's when I gave that up and went back to Transmarket Group. And then I only stayed there for another year and a half because they decided to change routes from the discretionary trader to the more algorithmic high frequency side. And I didn't really want to be a part of that. I never felt that high frequency trade was my bread and butter. Mine was more of a relative value, historical context trading, and which is somewhat systematic, but still I like the discretionary aspect of it. So I had to part ways from there, which was, it wasn't a big deal. That was fine. And then I took a job which was based in New York. And my job was to hire 5 or 6 traders and get them involved into fixed income arbitrage, which was the system that I had. So I spent 2 years building that out. Things went relatively well, except we couldn't raise the capital once again from their external hedge funds to back the trade even bigger, because it got to the point where you can either increase our trade and spend the money on technology, or kind of just keep it the way it is. But that's not, I don't need a company to back me for that kind of trading, It wasn't what I was, let's just say, promised to be, as opposed to, where I thought it could be if we spent the money and did it. But, it never got to that point. So.
Okay. So what's your situation today?
Oh, so now I still have Agni Asset, which I trade my relative value basis through. And I'm building basically a 4-year track record to open my own hedge fund. It's still viable, still makes money, still does everything that I think it can do. And I'm right now in the process of just banging away at the monthly track record to, hopefully attain enough capital to start a hedge fund, which, probably takes $25 to $50 million to do in today's market.
So why the 4-year track record? Is that just a good number?
Everybody I've talked to, they like the trading, they like the track record, but it's a matter of, how viable is it through different trading environments. So like, how did you do through, not that they'll use 2008 as an example, because that's, 8 years ago, but, some guys might want that. But it seems to me like the bigger capital wants at least 3 to 4, if not 5 years worth of actual real trading track record. At least that's from what I've been accustomed to seeing. Now I don't have the connections at Goldman Sachs or those guys to say where I've come from, Yale or Harvard. I could just, call a couple connections. I don't have that. So it's more of like, work your way in, show that it's viable in actuality, give them your statements, that kind of stuff, and then they'll listen to you.
Okay. And are you thinking more along the lines of a hedge fund structure or more of a CTA structure?
Yeah, no, I can't go the CTA route because of the U.S. Treasury cash. It seems too tough to having things if they're not underneath one roof, let's say. Here in the U.S., you can't trade U.S. Treasury cash and clear futures under the same roof. And then to take it to investors, it becomes very difficult for somebody to raise money for that, because now you got to house money in both whoever's clearing your cash, whatever investment bank is clearing your cash, and then you got to house capital in your futures clearing merchant. So you're putting up 2 fronts of margin capital for one actual trade. And with all the new Frank Dodd rules, they put everybody in the same category, whether you're trying to make $100,000 a year or $1 billion a year. You're the same trader. So in effect, you need I think the lowest amount you can have to offer this as like an investment is like 45 million or something. So there's rules and regulations that are a little bit of a deterrent, and just the niche side of it that it is. Now, if it was just futures and options that I was doing, I could do that CTA all day long, but that's not my trade. So I can't do it that way. I have to, abide by the rules and regs and market it, or not even market it. I don't want to use that word. It's until you get to that point where you have that minimum set of capital, I feel that it's not going to be viable.
Yeah. And what is it about going the hedge fund route which is appealing to you?
I just know that this trade is highly scalable. I know a lot of people don't do it, and I know that the track record is viable. I've done it. I think there's a lot of, false prophets out there in this money management world that claim that they can do certain things and, that they probably can't. So a lot of guys get into this business, let's say hedge fund or money management. They're in it for the fees. You raise 100 million. Yeah. 2 and 20, you can take 2 million home. I'm not in it for that. I'm in it because I know what I do is viable, and there's still a niche market for it. And, I think I could bring that to a lot of people that don't understand it. So I view money or capital, in terms of fee structure, is a byproduct of the success I would have in terms of delivering, alpha generation in a non-correlated way too. That's the thing about my trade. I'll make money whether or not the equity market goes up or down, or if the bond market goes up or down. I don't really care what direction it goes in, and I think that's advantageous to a lot of risk-averse players.
Yeah, well, I'm really keen to hear a bit more about your strategy, but I think before we do, a good primer to that might be just to talk about the Treasury bond market in general, and then we can maybe focus in a little more on your strategy.
Sure.
You're obviously the right person to ask about this, considering you've been trading it for however long now. It's not something we've really covered on the podcast before, in great depth at least. So I guess a few of these questions might be somewhat basic or sort of beginner questions, but I think it might be really helpful for many people listening. I'm going to assume that a lot of listeners don't know much about this market. I'm also going to put myself in with that bunch. I mean, I know next to nothing. So, let me just ask you, why do you trade the Treasury bond market? Is it just what you've always done, or is there a specific reason for why you like this type of market?
Well, I think, that's a big part of it. I mean, that's at Transmarket, that's what we were known for. So realistically, most of my exposure was to this market. So not only the futures side, but the cash side, which a very few people actually traded outside of, investment banks or banking sector players. But our proprietary group traded it. And I've always felt that was, it was kind of a cool club to get into. So the bond market, it's very big. It's very, it's larger than the equity market. You've got varying degrees of interest rate risk, duration risk. When I speak of duration, we could let's just say 1-year T-bills to 30-year bonds. You've got a long time frame in between there, and with those time frames, there's certain variance of interest rate and yield curve risk. So I thought the dynamics of it were very, very interesting. So that's always been one of the reasons that drew me to it. There was a lot of variables to it, but that I don't want to say that this market, I do trade other things. The fixed income market is my primary market, but I do trade index, S&P index, and that, and sometimes the euro currency in those. But the fixed income derivatives and the futures, options, and cash is my main market. Primarily, to answer your question, is because that's what Transmarket's big focus was.
Okay. And these days, what are you trading? Are you trading is it the 5 and 10 year?
Yeah, the 30-year. I mainly trade the 30-year and the 10-year cash against the futures. So that's when we talk about an arbitrage, it's taking one instrument, and let's say you're buying one instrument and you're selling another instrument, and you're just hoping for a variance in between the spread. It could cheapen or, get more expensive, and and you'll profit whether or not you're long or short that side of the spread. But I always tell people, when they talk about trading, you're a good trader, you can do this or do that. I'm like, no, that's not true. Cause I'm not a very good outright trader. I can't buy or sell bonds outright and do well. I don't think I was ever good at that. If I bought it, I guarantee it goes down. But if I do my spreads, I'm much more comfortable. So maybe that's the thing linking it all together, is the comfortability. because people will generally ask my opinion on rates and that kind of stuff. And I'll have my opinion. I'm very, I don't agree with what the Federal Reserve and the central banks are doing. And I don't agree with QE, and I don't agree with artificial props of financial markets, but that's the market we have. So it has changed my market somewhat because the central banks are kind of like the main buyers and everything. But that doesn't mean you can't, the niche is still there. And I still think a lot of people don't understand it and don't do it, especially nowadays. You get a lot of these engineered physics programming types. They don't understand the dynamics, I don't think, of the players involved in this market. They're just looking at two binary numbers and trying to see, if it's a buy or sell based upon the parameters. But I could be totally wrong about that, but I would highly doubt they understand the dynamics of the basis.
So a couple things based on that. First one, when you talk about the cash and the futures markets, I mean, can you just explain how they differ? Like, what's the cash market for and what's the futures market for, and why is there two markets there?
Okay, so the cash market is, when I talk about the cash market, I'm usually trading what's called the on the run, which is the most recently auctioned 10-year or 30-year, let's say. So they have like quarterly refunding auctions, February, May, August, and November. And so when I talk about the cash market, that's usually the instrument I'm buying or selling. Now, you'll hear other guys that do off the runs or old issues, and those are just old issues that were on the run, but their time passed and now they're off the run. And then you talk about the futures market. The futures market's the derivative off of that because it trades on, I don't want to get too far into the dynamics of the basis because then you'll start talking about what's called the cheapest to deliver and conversion factors. And that's what basically drives the basis pricing. When you're buying and selling the cash instruments and buying or selling the futures, that's the basis. And what drives that are the dynamics of the cheapest to deliver, if there's an ability for that cheapest to deliver issue to switch. Sometimes the calendar roll could have an effect on it, even on the future side. So there's a lot of dynamics that go into that I don't want to complicate your listeners with. But there's a lot of factors that could, that make the basis very interesting. And that's what I've always liked about it because it's every day is different.
And who are the major participants in bond markets?
Well, I think, obviously today the central banks, they own, I think, close to 40% of the entire float of all of them out there, but they're not in and out of the market every day. So you'll have, obviously the big high frequency guys that in there that, they might be doing some balance sheet stuff and keeping stuff on, but they might just go flat at the end of the day. So there's those type of players. There's obviously long-term insurers trying to match liabilities that are always in there, buying and selling based off of, their liability match and interest rate structure that they think is going to happen over the next course of whatever time duration they're trying to match. I think in today's market, it's primarily driven by high frequency groups that don't take balance sheet risk, that go flat at the end of each day. That drives the market and the pricing. And due to that, and due to, some places being able to warehouse trades, that means they can net a buy and sell inside their own firm. I think that presents a little bit of a mismatch in the outright market that we see currently, that the one that is displayed on the screens, because you don't see the entire market being put out for sale or for bid. So I trade on secondary markets, that are done through, let's say, BrokerTech or NASDAQ OMX or TradeWeb or Bloomberg. Those are the guys that provide the pricing for the U.S. Treasury market. And then I'll do the futures through other separate systems, which I don't know if I should mention their names or not, but.
If someone's interested, I guess they can reach out to you.
Yeah. Well, CQG will allow you to, as a trader for a third-party system, will allow you to have access to that market. CQG does it. Trading Technologies, TT does it. I think some of the other ones do too.
Right. Okay. Because that's something I was going to ask you, actually. Is for someone who's new, let's say someone's fairly new to trade and they're interested in potentially getting involved in the bond market, what barriers to entry are there?
Well, if you trade the cash, obviously the first one is capital with their new rules and regs. So you're going to have to either get a proprietary job at some firm that actually offers it, or get a partnership and enough capital and do it through that way, through another firm that has the balance sheet that can trade the U.S. cash. But if you're just talking about like fixed income futures and options, it's fairly easy to get involved in that on the, like I said, either through any FCM and whatever third-party vendor system you want. I think anybody offers that. And not only just the CQG or TT that I mentioned, but I think most of them offer access to it, to CBOT products. It's the cash market that's the real issue. It's I don't even know how you would get involved in that as a beginner now, to be honest. I don't even want to answer that clearly. Other than going to get a job at a prop group that already trades basis, something like that.
Okay. Well, let's leave that for now. What about ETFs? Because there's a lot of ETFs which are kind of spin-offs of different bond markets.
Yeah, like the TLT and the IEF, those guys, yeah.
Yeah, so you think they're a fairly reasonable...
Oh, in terms of participants? Yeah, definitely. I'm sorry I didn't mention that. I'm glad you brought that up. No, for sure. They're definitely a decent player in there now because of the size of them. But once again, I don't know if they're actively involved in there. They're probably just matching their NAV at the end of the day and adding or subtracting whatever their mix is at that point. I don't think they're actively, buying or selling the issues throughout the day. And once again, you might get an ETF expert on here that manages those. You might disagree, but and maybe they do. Maybe they are. But I don't. The size of the market that trades on the secondary screen compared to what it was back in 04 or 05 or 06 is nothing. It's minimal. And that's real. That's the real dynamic change of how our market or my market has changed is what you actually see on the screen compared to what you used to see. Back when I used to do 50 to 100 million in the 10-year, you'd be able to get those off on the screen. Now you can't really. You could probably get them, but you might move the market off of doing that. But as soon as the algos sniff out you want to buy or sell 500 10-years, they're going to front run you.
So why has that changed so much? Just because of
Because there isn't, the integrity of the bid and offer is different. Once high frequency came involved in these markets, they could both simultaneously be the bid and the offer at the same time. Whereas back in the pit, you couldn't do that. If you were 5 bid and somebody said sold, however many he wanted, you better take. So whereas now, if I see 5 bid on a screen and let's say there's 500 there and I go to sell 500, I might get 100 of those. Because if I don't have my own black box model, proprietary software, and I'm using like a second party or third party vendor, they're going to see my order before my order gets filled. Now, some people will say that that's illegal or that no, it's just a time delay. I'm delayed. If you're on a third party system, you're delayed, whether it's 6 milliseconds, 7 milliseconds, whatever that delay is, it's not actually what's on your screen. So that was one of the issues I kind of had when I was at this place, was when we were doing bigger size, I would never get the size I would need, and somebody would always get them before me somehow. And that's when I knew right then and there, and this was like 2011, that's when I knew that the only way to increase size is to increase your speed as well simultaneously. So, which will take, technology and infrastructure, obviously. But a lot of my stuff now, so that's what turned me away from trying to, do things a certain way. Whereas now, I'm doing more, based on historical, based on relative value, and I'm putting the position on. I don't care if I buy the offer necessarily, because I'm viewing my trade setup as correct. And I'm hoping that if I buy the offer, it becomes the bid and somebody else will buy the next offer because of my analysis. So it kind of makes my trading skill set a little bit deeper and more involved. And, whereas execution is not my precursor to success. It's based upon how my system works and where it tells me there's value and where it tells me something's cheap or expensive, in that respect.
Yeah, that certainly makes sense. Just before we get into a little bit about your strategy, just one more newbie question around trading the bond market. Is it preferable, from a trader's standpoint, for traders new to bonds to maybe choose either the 5-year over the 10-year over the 30-year? Like, are there any big characteristic differences between the different treasury bonds?
Yeah, there's more risk as you go further out the curve. So obviously there's more risk to a 30-year than there is to a 5-year. Not only because it's a longer holding period in the bond itself, but the price movement is larger. So the 5-year trades in a quarter tick increment, the 10-year trades in a half tick increment, and the 30-year trades in a full tick increment. So if you buy and sell one lot in the bond and you lose a tick, it's 31.25. Whereas if you go to the 10-year, it's half that, it's 15.6250. And if you go to the 5-year, it's down to a quarter tick. So if you're just starting out in the bond market, I would definitely start out more in the 5-year sector, probably futures wise, because it's quarter tick and it's a little safer. But most of the time, if you're starting out, you're probably a spreader of some sort. So you might want to spread like a 5-year against a 10-year, or even a 5-year against a 2-year, something to you understand the dynamics of what moves these markets. And right now it's kind of sketchy because you've got a central bank that's raising rates, which should affect the short end and should flatten that out. But we've had just nothing but steepening over the last month. And even though they're raising rates, because, obviously everyone's calling the Fed's bluff, saying you can only raise so much, you're going to have to eventually roll back down. And that's why the yields on 10 years are still below 2.3%. So you got those dynamics, which makes it very difficult for somebody new coming out. There's a lot coming at you. It's not just like buying like Google and waiting for an earnings to come out, and which I didn't think went too well for them today. But there's a lot to the bond market that you're going to have to figure out if you're coming into it. Not only, you got to figure out, what drives what components of fixed pricing and floating pricing and bond duration and all that. There's a ton into it. So I don't want to complicate it though. I don't want to dissuade somebody. Let's just say, I think you should probably read up a little bit about the bond market before you get involved into it, I think. But I would definitely start out in the shorter end sector.
Well, are there any resources or any material online maybe which you think's particularly good?
The CME group does a great job of providing free resources for any one of their markets. I think you could start out there for sure. I mean, there's so many, I think there's actually a few interactive ones on there too. That go into delve into the pricing mechanisms of it and, that kind of stuff. I think the CME group does a great job of that for sure. There's more than enough there for anyone to really want to dig into and, learn more about it. Because bonds are tough to a little bit understand, because they have a yield component to it. And if bonds are going up, yields are going down. So sometimes people have a hard time figuring out, well, yields are falling, that's good, if you're long, but because it's counterintuitive, something falling is good, So it's strange if you don't have any exposure to it once you're, getting into it. There's a few dynamics, things that you got to kind of figure out first.
Okay. Well, I mean, that sounds like a good starting point anyway for anyone who's interested. So, Mike, let's focus a little more on your strategy. So you've described your strategy as a relative value strategy. Can you just break that down in simple terms? What does that mean?
Yeah. Here, let me just think. Try to explain it simple. So yeah, like relative value. So I've got like historical pricing, on most of the bonds that I've traded for probably the last, 10 years. So through that, you build models on relationships, on each one of the, different sectors. So let's just use 5-year, 10-year, 30-year for that, this scenario. So now whether it's an interest rate hiking environment or, obviously we're in sort of a hike, but we're not, kind of thing. So you try to figure out how they reacted to a certain stimulus before and whether or not they're going to react the same way. And then what time frame are they going to react the same way? So when I talk of relative value, it's how is one performed relative to the other in a similar environment. Now it's not, obviously it's kind of like it sets the parameters for how I trade and it'll tell me whether or not something's rich or cheap, but that doesn't mean I always have to. This is the thing that's a little bit more dynamic than like just having a straight up black box model, I think, is that I will sometimes, not always discretionary, make a call whether or not I believe it or not. Sometimes it hurts me, sometimes it saves me, but I like to generally still have that control of whether or not I believe that based on historicals, based on this relationship that, yes, this thing's telling me it's cheap, but I think it can get cheaper based upon what players are involved now, based upon how it's been going over the last day or two, how I feel, those are those dynamics that aren't necessarily built into it, but are something that I take the discretion of utilizing. So if that kind of makes sense, where I'm using historical relationships against the current backdrop of trying to figure out whether or not one bond is relatively cheap or expensive to another.
Okay, so if you had to say how it is that you generate alpha, I mean, how would you answer that?
I would say that my trading generally describes a certain trade setup as either rich or cheap, and if I'll take either side of that in hopes that over the course of, it could be hours or days, or for that instance, let's just use that for example, hours or days. And throughout that course, either the trade's going to go my way based upon this, or the dynamics are going to change and my system's going to say, well, now something that was cheap is now fairly valued, and it might be time to exit it. So then I'll exit, something like that. But it's not always, I'm not looking to take a half tick or a tick. It might, it might not say that it's overvalued for 2 or 3 ticks. So it'll allow me to hold something as well, as opposed to just taking the half tick or tick out of it and going flat, let's just say. It allows me to have a general idea of richness or cheapness. And that allows me the flexibility to stay in a trade or, decide to take it off and see if it's the signal is still there.
Right. So I guess this question may seem fairly simple on the surface, but it might also be quite a complex question in some ways. How do you determine what's cheap and what's overpriced?
Yeah, well, I mean, there's obviously the market will decide that, right? I'm not deciding that. My system's not necessarily deciding that. The market's deciding that. So I have the parameters set up, and like I said, it'll say whether or not today or at this time, based upon these parameters, it's rich or cheap. Now I can, like I said, the part of my stuff is discretionary, is whether or not I listen to it or not, and whether or not I feel like that this is correct. A lot of times it'll say like, okay, this is cheap, but I'll look at it and I'll look at, maybe how it's been trading over the last hour or two and be like, well, I think these guys are getting long still and it could get cheaper based upon, the days moving on, and these guys might be stuck. So I'm going to wait. And sometimes it works, sometimes it doesn't. Sometimes the cheap turns into 1 tick strong and then I miss it. But, I'm willing to take that in an overall sense of on a risk side and say, all right, let's just say I'll put 1 unit on here. And if these guys do have to bail, then I'm going to put another unit on, something like that. But I don't have a set exact parameter for that to say like, well, you should do, some people's systems are set up differently. They'll put 1 unit on here, 1 unit here, or whatever, however they set it up. Whereas mine, I try to keep a little bit more flexibility on it and use a little bit more discretion of how I feel the market's trading at any given point. I think that's what separates from what I do from a lot of the black box models that are always kind of, I don't want to say static, but just do things on a repetitious manner.
I guess maybe a different way of asking the question, maybe to get at a different part of it. What are the relationships you're looking at to help you determine relative value?
Oh, well, I mean, like I said, a lot of it's just based upon, historical, occurrence and how one issue has reacted to another. Generally speaking, I guess a good way to describe it is if the Fed's in an interest rate hiking environment, the yield curve should roll down, roll over, or flatten, because obviously they're raising short rates, right? They can control the short rate. So when I mean short rates, I mean like, 0 to 2 years, let's just say. So if that's the rate they're raising, well, then obviously that rate has to rise. So normally they'll sell the front end, which is, like I said, the 0 to 2 year sector, and they're buying the longer end. So, but that doesn't mean that will always happen. Obviously if we're in this environment, my system will obviously say the 2 years are expensive and, relative to 30 year, but you got to look at from a contextual point of view at that given moment, because this environment that we're in today, people I think are now realizing that interest rate hikes are easing. They're not a hiking of rates the way they used to be, because now we pay interest on excess reserves. So every time the Fed hikes rates, they're not raising, conditions of borrowing. They're actually lessening the condition because they're paying the banks, $30 billion a year in free money. So the higher the interest rate goes, the more money the banks get. That's an easing of conditions. That's not making, conditions harder. So that's why I think everyone's off guard here. And I think that's why everyone, I think in the last month they bought the yield curve, because they realize that hiking rates is no longer what it used to mean. The conditions aren't tightening. They're actually giving the banking system more money. So when you talk about my thing, yeah, obviously it'll say in a hiking rate environment that just on a general sense, now there, and I'm being very generalistic, you should own 30 years over 2 years. But, I know that hiking doesn't mean what it used to mean. So I generally would say that, we should steepen, not flatten. And you can make money off of that, because obviously every big player out there looks at that. If you look at your big insurers that have their PhD economists out there saying, oh, look at the curve's going to flatten out and rates are going to be past 3 or 4%. I've been hearing that for 10 years now. It's not going to happen. This market, this debt can only go higher, and the interest rates can only move lower because of the mathematics behind what they've created. So they have to jawbone and talk a big game, when in reality, yeah, I know they can't raise rates the way they used to.
Well, we're talking about some pretty big picture stuff here. I'm just curious, what's the average duration of your trades?
You mean now? Okay, so in my world, duration, it could mean, am I trading a 30-year bond or a 5-year, or do you mean how long do I hold it?
Exactly. How long are you holding for?
1 day generally.
Okay.
1 day.
So how do these big picture, like you're very interested, and you place a lot of emphasis on understanding the fundamentals of this market as well, and economic influences. How does that affect your short-term trading? Because one day to the next can not necessarily be in line with.
For sure. Yeah. Sometimes it doesn't, sometimes it jades my long-term view, sometimes jades my short-term approach. And that's where I got to balance it, because I generally want to know where things are going in the long run, but it might not be the case in the short run. So how do I structure the trade accordingly? That's why when I say interest rates are, in my opinion, should move lower, but they may pop, because you got a lot of big players out there with a lot of smarter guys than me out there saying that interest rates are going to rise, and they're going to put their money on that. So I can't fight that. If PIMCO or Double Line or those guys are in the market saying the rates are going to move up. But for what I do, I'm not necessarily, my holding period is so short that I'm mindful of the long-term fundamental reason and where I believe things are going to be. But I know in the short term, the market can trade anywhere. It's one of those things that, like back in the transmarket days, I know that, just because I have this belief doesn't mean the market can't go there. And that's why I kind of take over my relative value, because it'll tell me one thing, but I might not believe in it, So, but I have to really convince myself of why I don't believe something is rich or cheap. But you're right. I think it keeps me knowing, or at least having a opinion allows me the flexibility of at least keeping a general idea of whether or not I want to be long or short. And I think from what you're trying to say is how, does that dissuade me on a short-term level of putting something on? And the answer is yes, it probably does. And a lot of times it does save me, but some of the times it does hurt me from actually putting on a trade that, even though I think yields are falling, yields might pop. So I'm not gonna be long yield or shorted in price, let's just say, because I still believe bond prices are going higher, so I won't sell it. So a lot of times, yeah, it does affect, whether or not I put a trade on or not. But more too often than not, I'm putting something on. And, that's the good thing about spreads is, you're just hoping the variance in one or the other moves faster than the other. You can always get out and reevaluate. And that's the good thing, too, that I don't get married to this stuff. I can always get out and get back in. I've got no problem of, let's just say selling threes and then buying threes back, just as an example.
Well, Mike, the one last thing I'd like to ask you about, and it's not necessarily directly related to your strategy, but just in general. I know there's a certain line that you I don't know if you live by it, but it's something that you quote from time to time, and you say, if you take care of the short term, the long term will take care of itself. Do you mind just expanding on why you use this as a mantra?
I think once again, that goes to my trans market days of growing up and having to generate capital before you took on a lot of risk. It always seemed like, and also going back to where if I made my net goal for the day and it was 7:45 in the morning, I was done, because I felt like on a mental level in this game, in this arena, if you're not at your best, if you're not at your cleanest mental state, I think you're putting yourself at a huge disadvantage. So I always felt I traded better, that if I always took care of the short term, which was like, I'm done for the day, then I know tomorrow I'm going to start out fresh. I'm not going to have an opinion necessarily, and I'll have a clear conscience of what I need to do. And, obviously the goal of a trader is to make money. I don't care what market you're trading, what you're trading, or whatever you're investing in. Nobody likes to take losses. And I think the hardest thing to do is to take a loss. And I think it's much easier to do on a clear conscience than it is, otherwise. And, I think that's just one of those things that I've learned from the beginning, and that's always stayed with me. And so I figured, that mantra of always taking care of the short term, yeah, it's conservative, but in the world of trading, sometimes conservative kind of buys you longevity, and it allows you the dynamics of, altering your trading state through as the market changes, because, today's market's not the market as it was 10 years ago. And that's hard for a lot of people to adjust to. I've mentored a lot of traders, and I've seen a lot of, different backgrounds, different, guys come from money, guys that don't come from money, guys that, had a great education, guys that didn't. And I don't really think much of that matters. I think it's I think the trading skill is innate, and it's very proprietary to the nature of the person. And I think understanding yourself is one of the biggest facets of success, I think, in this arena.
Well, on that note, let's wrap things up here. So Neil, who introduced us and who was also on, I think it was episode 127, who spoke about starting a CTA, a commodity trading advisor, how you would go about that. I presume we're allowed to speak about this, but you ghostwrite their newsletter.
Yes.
Now, Neil asked what she do. She set up a page so that if anyone wants to get that newsletter, which you, Mike, write, you can do so. So I'll set up that link. If you go chatwithtraders.com/Mike, M-I-K-E, that'll redirect you to a page where you can actually subscribe to a free newsletter that goes out. I think it's once a week, where Mike, well, you tell them what's in the newsletter, Mike.
Yeah, well, we try to speak about, obviously I cover mostly bond and equity stuff, futures, cash options types of trading. But I also like to cover, whatever happens on a global macro environment. The goal of it is to educate not only CTG's clients, but anybody that reads the newsletter on other things that are out there in the alternative investing space. So, it's really more of an educational tool as much as it is like an informative tool on trading, let's just say. But my idea is to bring what the research that I do in my own trading and, out to anybody that's willing to read it, and I try not to get too highly specialized. I try not to inundate people with anything that they probably couldn't understand, even if they're coming outside of the financial arena. So my goal is to actually educate people on understanding the current marketplace, why things move, how it might affect you and your investing, and understand that there's a bigger picture in what's going on here, and try to provide some clarity in understanding these markets, as especially nowadays, Aaron, with everyone calling these things a bubble, and this is a bubble, and that equities are a bubble, bonds are in a bubble, and Bitcoin's in a bubble. I go, it's crazy to say these things because we really don't know how long things can last, and we don't, unless we get underneath the hood and see what's driving the pricing of stuff. Then we can understand it. And if we kind of, collaborate and send these ideas out there, and people are free to comment or to send in something, if they want something to, be looked at, then I'd be willing to write about it for sure. because I'm all in for the collaborative effect of spreading knowledge to people, not only in the trading environment, but investing in global economics as well.
I mean, I certainly encourage anyone who's interested in that type of thing to join up.
And it's free.
Yeah, it's free once a week, quality research. No, it's really good, man. I've read several editions of it.
Oh, thank you.
You're also on Twitter, and I think do you have a website of your own or a blog of your own which you'd like to mention?
I do, put the stuff I ghostwrite for Capital Trading Group on there a couple weeks after I put it on my own blog, which is econemotions.com. So you can find it on there as well. If, you don't want to sign up for it, I usually put it up there later on, a couple weeks after. So I'm doing that, and that's the blog. And then I'm on Twitter as well. Yeah, Basis Arb at Magni1313.
That's not your handle, though, is it? It's just Agni1313.
Is that how you?
Yeah.
Is it?
Yeah, it is.
So you'll have to edit that out, Aaron. So what does it come up as? I don't even know, actually.
So your name is Basis Arb, but your actual handle where people can find you is at.
Oh, it's at Magni1313.
Yeah. So Agne1313.
Okay, so maybe you could send that. So you could say that part then.
Yeah, just did. There we go. So and just a reminder, if you want to get the free research, chatwithtraders.com/Mike. That'll redirect you to Capital Trading Group page where you can get the free newsletter. So let's close it out here. Mike, thank you for coming on the podcast. Absolute pleasure to speak with you again. I appreciate it, man.
All right, thanks so much, Aaron. Appreciate it.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, crew? Welcome back. So last week I announced Chat with Traders merch is now available on the website, and of course it is still available. You can check it out at chatwithtraders.com/shop. But this week I have another announcement. This announcement is mostly relevant to my Australian listeners, and more specifically folks who are in Sydney, because on Tuesday, the 29th of August, I'll be doing a live podcast in Sydney at one of the WeWork locations. It's a really cool venue. This event will also double as a bit of a meetup, hangout type of thing, because I'll be putting on beers and pizza beforehand too. Now, the two traders who I'll be interviewing are Bryce Edwards and also Nick Fabrio. Nick, I apologise if I pronounce that incorrectly. These guys are both Australian equity traders and both very good at what they do. I can promise you that. For more info and to get a ticket, please visit chatwithtraders.com/Sydney. Tickets are dirt cheap. They're just $15. So again, chatwithtraders.com/Sydney. Now, on the podcast this week, I've got a very interesting character for you. The gentleman's name is Dr. William Zimba. William is an academic, a practitioner, gambler, trader, and an author. He's worked with and consulted to many well-respected names in the field, such as Edward Thorpe, Blair Hull, and the very successful horse bettor, Bill Bentor. In the beginning, horse betting was actually William's field of expertise. He even published a book titled Beat the Racetrack. And in many ways, for William, horse betting worked as a gateway to trading financial markets, which he's been doing since around 1983. In 2015, William won the futures division of trading competition Battle of the Quants. And now in current times, William manages a fund, Alpha Z Advisors, which has outperformed the S&P 500 by a long shot. The fund started in July 2013, and as of May 2017, it's returned 527%. Much of Williams' trading revolves around calendar anomalies, arbitrage strategies, and behavioral biases. We spend a good amount of time discussing these few things, plus William shares one anomaly he's been trading himself for many years. In the later part of this episode, we also talk about position sizing and the Kelly criterion, and finally, we close things out with some discussion about horse racing. All right, so let's cut to the interview now. Just a final reminder, if you want to come along to the live podcast in Sydney, chatwithtraders.com/Sydney. Go there, grab yourself a ticket. Thanks very much for listening, guys. Please enjoy this episode.
Racing I've done for years and years, which is sort of how I learned the stuff I do in the stock market, basically. I think of it as like racing. The only thing is, the only difference, Aaron, is that in the stock market, futures market, you can stop the race when your horse is ahead. That's one of the differences. And the race ends. That's the other thing. In the financial markets, the race never ends. It's always going. So those are a couple of the differences.
Yeah, I mean, that's something I'd really like to get into with you, actually. But, I mean, just for starters, William, I know that you wear a lot of hats, or you certainly have done over your career. You know, you've been an academic, like we were just talking about sports.
I think of myself as an academic, and I do the trading as part of it. I learned from the books, and I paste them together. And when I talk to people, and maybe your audience, I have sort of 7 of them that each has certain ideas, and I sort of combine the ideas. And then I do the trading discretionary. You have to make fast decisions, and it's a judgment call as to what to do. So that's there, and you have to be basically very careful and watch your risk control and not overbet. Overbetting is very tricky because you can be in a situation where you're not overbet, and all of a sudden the market changes a little bit, and then now all of a sudden you are overbet. So you have to adjust it. So and it's constant work. So you have to really pay attention. If you try to just do it fully computerized, there are people who do that successfully. But for me, I have to do it, with a lot of work. It's like a job. You have to work at it.
So how come that's the case? I mean, how come your trading isn't fully computerized?
Because you have to make fast decisions on things. Like, for example, in the Trump election, the market assumed that if Trump got elected, it's going to fall. And in fact, when he started winning, the market started out ahead. Then as he started winning, the market fell dramatically, 800 points on the Dow Jones. But there are two Trumps. There's the guy who fires people, who tells the French leader that his wife has a beautiful body, the guy who insults people, the guy who cheats people, doesn't pay his bills. There's that guy. Then there's a guy who calmly reads a speech written by somebody else and does it carefully. That guy, that Trump, is very bullish. So the minute that he, in fact, started the election speech after he had won, the first thing that came out of his mouth was not that Hillary is going to be locked up in jail and all this business. He said, Hillary's a great person. I really respect her. I knew the market had to fly. So you go along. So you have like 5 seconds or 10 seconds to decide what to do. So I don't know if your computer could really do that. You may be able to program it to do this thing, but I kind of doubt it. And I had to do the same thing in the French election. I had to do the same thing in the Brexit. And I feel fortunate that I won in all of them. And even in February 12, when the big decline of February of 2012 occurred, on the 12th, the VIX, volatility index, finally turned. So it turned lower. And then the S&P rallied, and one went monotone down, the VIX, and one went monotonely up, the S&P. So that was a good one. So you have to sort of, for me at least, have to make these fast decisions. So Ken Griffiths, the famous Chicago trader, he's good enough to buy $80 million Picassos. So things of that sort. His way of thinking is very similar to the way I think, which is you have to understand the theory, you read the stuff, and then in the end, it's a judgment call as to what to do and the size of the thing. And so you have to sort of know in advance how many positions to have and what kind, etc. Now, of course, Thorpe and I and Len McLean did this book on the Kelly criteria. I've been doing papers on Kelly criteria for 30, 40 years. They go back to my 1975 book, Stochastic Optimization Models in Finance. And so they go back. So it's a long time. So you do that. But what I do is, after a while, you sort of get a feel for the size of the bets that you can make that are reasonable. So I do that. Of course, you can do calculations, and you can do them in advance, thinking about what's going to happen. So you just try to prepare yourself. But the thing is, you have to actually be ready. So when the event occurs, because it can go either way. In the French election, what was interesting was there were 10 candidates. 5 were for staying in, and 5 for what's called Frexit, which is French exiting. Now, of the 5, there's only one that's the top candidate. That's Marine Le Pen, who's a master debater. And so it was a threat. And of course, if she had won, that would have been very, very bad for the U.S. markets as well as the Europeans. But the minute that Macron won, and she won, because there was 2 that did the runoff, but the third place person went with Macron, that was my signal that, well, Le Pen's not going to win, therefore it's not going to crash, so the other option is it's going to rally. So I did that. In fact, that's the greatest day of trading I ever had in my life. We made 5% in the fund that night.
That is a good day. So these couple examples you gave, these were mostly around presidential elections. I mean, is that where the bulk of your trading is done? I mean, what about in between those?
No. I think that's one thing. I think what it is for 9 years, first of all, I went to Japan in at the time when they were essentially accumulating most of the world's money. So that was 87, 88, 89. In 87, we had a giant stock market crash in the United States. So when I got an invitation to interview to be the first Yamishi professor, Yamishi was the fourth biggest brokerage firm in Japan, sixth biggest in the world. Now, in Japan, stockbrokers are, in the status of the society, rated lower than garbage collectors. Kabuki dancers, potters, these are the people that are respected by people. So the economics departments have brilliant people trained at the top U.S. universities, as well as Cambridge and Oxford, et cetera, as well as the University of Tokyo. So in economics, it's very good. In math, it's very good. But there's nothing really in the business school and finance. So the brokerage firms wanted to kind of change this. So they gave a 5-year professorship to the University of Tsukuba, National University, to kind of develop that. And I interviewed to be the first one. And it was quite good because my wife got a very nice job. She's quite smart. And I was delighted that she got a job. And it's the same pay, men or women. It's based on age, basically, is the pay. And then my daughter was 9 years old and went to public school, red hair and all. And I had two things. I had teaching at the university, which was about 60 kilometers north of Tokyo. And I had nice classes, and people from the brokerage firm would come up, as well as people from the university. And then I had two projects. I had stock market anomalies, and I was one of the first to actually study that stuff in Japan. And then the other was crashes. And so I came up with a model based on the 87 crash for the crash part. And it worked very nice. And what we did is we made the model, which is basically stocks and bonds fighting for the money. So when bond prices are such that the interest rates are high, bonds get more of the money. And in the other case, when it's low, then the stocks get more of the money. So based on that, they had a crash measure, which explains the crash of 87. It also was, in fact, the basis of finding the model. So I had to find a place to test it out of sample. So I tested it out of sample with the past in Japan, because we're now in Japan. So I did 1948 to 88, 40 years of data. And it turned out the way the model works is you get a signal, and then usually the market continues to go a bit higher, and then it falls, and it falls 10% below the starting price. So that's so forth. So anyway, so in my recent book, which is in printing now, on stock market crashes, we test that model against Bob Shiller's high PE and also by itself. So we discuss with that and so forth. So anyway, what happened was we tested it out of sample in Japan, and there were 12 times that the model went in the danger zone, and every time it fell, so no misses. And then at the end of 89, when you had the final push up, it was so far into the danger zone. So what I did is I sent the fellow who had worked with me, who had studied at Yale University for his master's, and also in Japan, and to talk to the executive to say that there's danger, they should do something. So what happened was they were the same people who had invited me for fugu, the fish, for golf, had taken us to dinner, had me give big lectures. But deep down, they really didn't believe that a foreign professor could understand their markets. Their markets were, in quotes, different. Well, in fact, they weren't different. The ideas that I knew from the U.S. study were basically the same. There's a turn-of-the-month effect. There's a monthly effect. There's holidays. There's all that sort of stuff. And in the book I did called Calendar Anomalies and Arbitrage, I have all the papers from Japan, and I do the U.S. case in Chapter 1, all the U.S. anomalies, which I use in trading a lot. So what I try to do with the books is everything in paperback so people can use the books. I don't care about the money. I just want people to use the stuff. And I use it myself. So that's the thing. So anyway, Yamishi wouldn't listen to Ishii and so forth, and told him, well, we like Professor Zimba, but can he really understand our markets? Well, in fact, they made a huge mistake, because 5 years later, Yamishi was bankrupt, the entire firm, and a few years later after that, they ceased to exist. So that was an incredible call, but they didn't listen. So anyway, that's discussed a lot in this new book on stock market crashes.
Okay, well, you've mentioned a few things which I'd like to dig into a little further. I guess one of those being calendar anomalies. So, when you talk about calendar anomalies, and I know this takes up a large chunk of your trading, what are you actually referring to when you talk about a calendar anomaly? Like, what exactly is that?
Let me give you an example from Japan. In the United States, we found that two things. If you take the 70-year period, 70 years from around 1920 to about 2000, somewhere around there, you find that in the single month of January, the lowest decile stocks beat the highest decile stocks by 10.3% on average, year by year. And if you plot a graph, year by year, you find that almost every year, the small caps outperform. And if they don't outperform, they underperform by just a little bit, et cetera. So the question is, how can you bet on this? So in 87, I did a paper that's reprinted in this calendar analysis book where you bet on that. And the idea was you go long a stock market index future, at the time called the value line, which was equally weighted. And then you short the S&P 500, which is value weighted, large cap. And you do this from about the period January 15th to about December 15th to about January 15th. Okay, so the effect was actually in January, but it's anticipated in the futures market earlier. Okay, so that I played, and I did that for many years, and I did it for 14 years, and I managed to win each year. But it changes a little bit each year, and you got to have confidence in it that's actually going to work. It's like a horse race, whereas I learned my trading from, and the thing is, the only difference is you can stop the horse race. So if you're ahead, you just say, I'm getting out, stop the race, I'm out, etc. So you can do that. So that was fine. That was a good one. Now in Japan, we go back to Japan. In Japan, I did the turn of the month effect. Now in the U.S., you had the following results. If you take the -1 day, that's the last trading day of the previous month, and the next 4 trading days of the next month, that is, on average, was getting about 2/3 of the gains of the whole month. And the rest of the gains were in the second week. And the third and fourth weeks are essentially giving you nothing. Okay, so you have -1 to +4. So I go to Japan, and it's a society that is supposedly male-dominated. So the salary man goes off to work, etc. The wife cooks and so forth and so forth. She's not allowed to go to dinner when the husband has guests, etc. However, one thing was interesting. The women have the unimportant jobs of deciding where the children go to school, where the money is invested, where they live, what kind of car they have, and things of this sort. And the men have the extremely important job of deciding what kind of sandwich they take to work. So once I discovered that the women control the money, then I said, well, when do the women get the money? It turns out they get it on the -5 day. And guess what? The brokerage firms know this. So they are sending people on the -5 day, knocking on the door, because the wife is there during the day, the salaryman's working. He's already given his check to the wife, and then she invests the money. So then the stock market turn of the month effect is -5 to +2, which is interesting. So you get the effect of behavior. So behavior is very important. So there's economics, and there's behavior, and there's flows of money, what I'll call institutional practices, etc. So that was interesting. So the women control the money. So that's clear, even more so than in lots of other countries. So it's so forth. So it's very interesting. Japan has a lot of different characteristics that are different than Western society. But very nice. We had a lovely time, the three of us there. And it was a nice time in our life. We really enjoyed it. And I wound up doing 3 books, of which you probably can buy them on Amazon for $3 if you want. One's called Invest Japan, which I thought was a good one, and one's called Power Japan, and one was a more academic kind of a book of collective works. So that was a turning point for me. I enjoyed it. I learned a lot. And if I just say one thing, Aaron, one thing I did, which was funny in the anomalies, there was a guy called Mr. Okada who didn't speak English, and I didn't speak Japanese. I'm not good at languages. And we would sit facing each other with a translator, and we would talk for hours. And he would talk about the Japanese market. I would talk about the U.S. market. And we learned from each other. And it was very good to do that. And then when I was doing the books, I could relate to that. The books are basically done after the stay. I stayed with the family for 1 year, and then I consulted on a factor model of how to predict the best stocks to the worst in the Tokyo Stock Exchange. Basically, the way the model works is every month you get new data, and then you get things like earnings surprise, PE ratio, price to book, size of the stock, things of that sort. So I have 30 of these, and then basically you make the model, and then once a year we re-update it, and so forth. And what it does is it picks you the very best stocks each month, and then you rotate out of them the next month. So I could have a portfolio of the best 50, the best 100, etc. And it did work. And what happened was I published the book, and we don't get much as authors from the book. We get a little pleasure out of it. And a hedge fund called Buchanan in London bought a copy of the book out of the bookstore in London, and they discovered that I had a better model in the book than they were using. So I did consult with them for a few years after that, which was good because they used the model in a period when the Japanese market was falling versus estimated when it was going up. It just had minus signs in the coefficients.
Yeah, I would like to speak with you about some of the people who you have consulted with, because I know you've certainly worked with some really big names.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including zero commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I just want to go back to that first example you gave when talking about the first example of stocks in January. Now, you said that you go long you're looking for the lowest decile and the highest, but how are you defining the lowest and the highest? Like,
lowest decile are the small stockets, Universal Widgets, such and such, and the highest decile are Microsoft, Apple Computer, these sort of things.
So you're looking at market cap?
Market cap, exactly. Market cap. We know at the moment, Apple is extremely high market cap, and Microsoft's had a very good year, a resurgence under the new president, and so forth. Now, you can't actually get the lowest decile. It's not traded as this thing. So the value line was equally weighted, which meant that Universal Widgets and Microsoft count the same. Now, so if they all count the same, then you have an emphasis toward the small stocks. Now, the reason that a monkey can beat the market by throwing darts at the newspaper is that it spreads it around and he gets more small caps, which on average, if you hold them, do better. Okay, they're a little bit more risky, but they generally have higher returns in terms of that. So that's one effect that's strong. Now, another effect that's strong is presidential elections.
Hold on, just before we move on to that, let me just ask you another question around this. So this particular trade of these stocks in January, the lowest decile outperforming the highest decile.
Buy the stock.
Yeah, no, I understand that. But that's kind of the premise or the theory for the strategy. So you're actually entering into a position in December and exiting in January. Do I understand that correctly?
Yes, you do. Now, the only thing, Aaron, that's very interesting is that in the beginning, we did this in 1983, 4, 5, 6, 7, when we did the first paper. And then later I did other papers. They reprinted them all in this Calendar Anomalies book. But it moved because as traders and people look at this, first of all, when you study anomalies, it's a very hard sell. Very few people are willing to do it or interested as well. The people who've made a lot of money trading often do this, and they do sort of work, but you have to sort of believe in it in terms of things. Now, over time, the market changed a bit. And if you look at, and I have year by years in the book Calendar Anomalies, every year is shown there. What happened was it moved in such a way that it got anticipated more and more. So nowadays, the entire January effect occurs in the month of December. It's not even in January anymore because it's moved forward. People anticipate that it's going to happen. So it's moved there. So if you do the trade these days, you do it somewhere around the middle of December, and you're basically out at the end of December. So then you're finished. And what's happened historically with me is I won the first 14 times, and then I taught it to Morgan Stanley, hoping to get consulting in New York. And it was a nice visit. I was paid well. It was a lot of fun. But the thing is, they had a lot more money than me. Morgan Stanley's a big outfit. And there was a fellow who had just joined, and he brought in 7 professors to give strategy ideas. I was one of them. So we did that. So I realized that the jig was up. I'm not going to be able to compete with these guys. They have more money, and there's more of them as well. But there was another thing. The volume was drying up. I was, as a professor part-time, I was 7% of the value line, which is really a lot to have. So then I stopped doing it for a bunch of years. And then Blair Hull, who you mentioned, gave me a consulting contract, and I studied anomalies in the U.S. with I have a fellow who helps me, Constantine, and so Constantine helped with the calculations, and I was doing calculations, and we've done some papers together. So I basically relooked at all the different anomalies. So then I found that the Russell small cap had taken over for the value line, but it's value weighted. And because it's value weighted, the bigger stocks push it up. So it's essentially the 4th decile, not the 1st. But it did work pretty well in the simulations in the years I didn't do it. And then I started doing it with real money, and I did it 6 years, and I did win each year. And then I was 20 for 20. You're in Australia, by the way. I'm a student of undefeated horses. There's a horse in Australia called Black Caviar with 25 races, won them all. And we had a great female in the U.S. called Zenyatta. She was 19 for 19, but lost number 20. So anyway, I'm going for 21. And what happened was Yellen, who's the head of the Fed, she is, of course, instrumental in deciding the interest rates. They raised interest rates by a quarter point, which was not much in December 2015. But in December 2015, there was a lot of threat of many more increases, which did not occur. But that messed up the trade. So basically, we lost. It just didn't work. So anyway, it's a little sad to lose, but not everything is perfect. And the other thing that's important is you cannot expect everything to be perfect. One of my good friends is a racing expert called Steve Roman, and he's a tremendous expert what's called dosage, which is the breeding of a horse. Can they win the races like the Kentucky Derby? And for a period from 1929 to the 90s, every single year, a horse that had too much speed and not enough stamina could not win the race. And there's a score, and if you were above 4, the higher the number is, the more it's speed-oriented. And that's based on the parents. So what happened was Steve got a lot of bad publicity because people felt that this was infallible. And if he ever misses one, it's terrible. But the thing is, it's not terrible. I mean, if you get 9 out of 10, that's pretty good. If you get 9 out of 10 in baseball, you're the greatest hitter in the history of the world. 3 out of 10 is pretty good. So in any event, we have the same thing with anomalies. You win most of the time, but not quite all of the time. And the other thing is that if it doesn't quite materialize when it's supposed to, like many of the effects are that the small caps have bigger effects, they're longer, and they often move on the -3 day, the 3 days before the event. So if it does not occur, then there's trouble and the market often falls. So you get a sort of a signal in there that there's trouble in the market as well. So for me, I do the turn of the month, turn of the year, little stuff on holidays, presidential election effects, and so forth. And in the fund, which you mentioned, I do mispriced anomalies, and it's very similar biases to horse racing, extremely similar, and it's helpful in my thinking because I do both. And a mean reversion, prices go up and down and so forth. Huge mean reversion in NFL football, with prices going up and down.
Just before we get into the mean reversion stuff, that is something I would like to speak with you about. Just on the anomalies, you mentioned a little earlier that you'd done some research with Blair Hull and some consulting with him.
Yes.
I'd just be interested to hear a little bit about how you actually conduct your research for finding these anomalies. Like, can you just walk us through that process and sort of keep in mind that if someone at home is listening to this and they are thinking that they might want to try and see if they can find some sort of anomaly which they can exploit?
Well, first of all, you're coming from Australia, and we have the Australian stock market, we have the Canadian stock market, et cetera. Basically, what's the best is to postulate a theory of what you think will happen. And a lot of it has to do with how the money flows. What do institutions have to do? One of the reasons that the turn of month effect occurs is that at the beginning of the month, people are receiving money from their pay. So then they put it in the stock market, some of it. So it's around that period. So that sort of thing. So basically, you sort of look at the data and just see what actually happened. And I like to dance around the issue, sort of think about it, talk to people. What are people doing? What are they betting on? Et cetera. So then you get sort of an idea of that. And then, of course, there is literature. There's a standard literature in the United States of January effect. There's a couple of Januaries. There's one that we mentioned of the small stocks outperforming. That's one thing. But there's a second one where the performance of January of all the stocks is a forecast as to what's going to happen the rest of the year. So you have the January forecast, and also you have the first 5 days of January forecast. So we have those. And that's called also in the trade January barometer in terms of that. And the result basically is if January is very positive, the rest of the year is usually more positive. If January is negative, the rest of the year is up or down about 50-50. And if it's wrong, then if your signal is good, it'll be less wrong. And if your signal is negative January and it's wrong, it'll be more wrong, if you understand that in terms of things. I have in the calendar anomalies book graphs of this sort of stuff.
From a few of the things I've read, which you've published and written about, and just from listening to you speak, it sounds as though you like to look at how things perform. So you're looking at things from when a signal occurs and then a number of days forward. Is that something you look at a lot? And not so much in terms of like trying to hit a price target as such. It's more about where does the market go N days after this event?
Aaron, I think you're on the right track there. It's not exactly a price target. It's where is it trying to go? And what's really good at trading is if you can be ahead of the game. So if you think it's going to go up, then you go more long. If you think it's going to go down, you hedge or go short. So try to get your thinking about that. And the other thing that's very important is corrective action and not overbetting. So if you're wrong, how fast can you correct it? So forth. So in terms of what I do in trading, constantly tinkering, it's moving a little, et cetera, et cetera. And it requires more work, but it does seem to work in terms of doing it.
Okay. And one of the things you said earlier, and I think your daughter, Rachel, may have actually said something along the same lines. I know she's very involved with, I think it's the fund. You said something along the lines, and so did she, anomalies are poorly understood and not used much. I mean, why is that the case, and how are they poorly understood?
If you take 100 people doing the stock market, there's only 3 who actually use anomalies, or very few. I think most people, especially those who go through MBA programs, even at the very best schools, are taught that the market is essentially an efficient market. You can't beat the market, and so forth. And the journals are controlled by people who live in a world where they believe that you can't beat the market. And it's unfortunate because over time they've had poor performance. But the thing is, they seem to have more of the money. They've accumulated more of the money, and they do. So the vast majority of the people actually don't do anomalies. Some people think they don't exist. I was at Princeton University recently, and the king of anomalies not existing is Burton Malkiel. He's made a fortune over a book that he's done on random walk down Wall Street. It's very good, but it's a certain extreme point of view. And I was pleased that I'm very aggressive in question period, and I had said a bunch of things, and he had done racing things, so he knew me. So he came up and bought me lunch, which I thought was nice. So he doesn't do the things that I do, but he at least appreciates it, and believes that we can in fact do it. And there's a lot of different camps in the stock market, different views that people have, et cetera. I try to write that up. One of the books is called Investing in the Modern Age, and that one, we talk about what I call the 5 camps. There's efficient markets. There's risk premium. Efficient markets is the prices are correct except for transactions cost. Risk premium is you can make more money, but only if you take more risk. Then there's a category, efficient markets. Efficient markets are hogwash, and that's Warren Buffett's view that he'd like to endow chairs in efficient markets at all the top universities so he can beat them all, et cetera. And then there's the Paul Samuelson idea. Well, there are great traders out there, but it's hard to find them. For every 20 traders that you find that are there, only one's good. And then the last category are the people like myself who do research, look at things, postulate theories, do statistical tests of that sort.
Now, I cut you off earlier when you were starting to talk about your mean reversion trading, so I'd be interested to hear a little bit more about that. I mean, I know it's something you compare a lot to betting on the NFL. I mean, would you mind expanding on that type of thing?
Yeah, actually, if anyone's interested, there's 3 years of the NFL in the book, Investing in the Modern Age, which is paperback. It's not expensive. And I do 3 years of it. And there's games in there that have the following characteristic. In the last 3 or 4 minutes, there's 4 lead changes. So they go up and down the field, and the prices are going up and down like a yo-yo. And so the way you do that is you have to have an account like Betfair in London, or something like that, where you can go long and short. And then you watch it on TV and see it moves with the teams play. So there's one famous game I called the Game for the Ages, and that was San Francisco 49ers playing New Orleans with Drew Brees, the quarterback. And they were up and down the field 4 times in the last 3 minutes. Prices or so forth. Now, the stock market is not as violent with that. Now, my favorite teams, I have 2 favorite teams in football. I have the Seattle team, which is close to where I live in Vancouver, and then New England, which is where I grew up. Now, New England very often starts the game slow. So they're very often behind, but they're a very good team. They very often are behind the first quarter, maybe the first half, but by the third quarter they start rolling, and usually they win. They've got a phenomenal record, and I think it's just the way they do. So with them, you can do the strategies where you try to do an A/B trade. This is like what Thorpe does a lot of this. This is sort of his stuff, which is you want to bet on A with certain odds, and then you want to get a bet on B at really good odds in such a way that A times B is greater than 1, and that gives you an arbitrage. In other words, you can't lose. It's a risk arbitrage because you put on A, you might not find B as well. So Thorpe and I did one on Nikkei puts. Basically, I was the junior player, so I had to do most of the work at that time. And he was the senior player, and we had another fellow, Shaw from Gordon Capital in Toronto, who did this. And we had a good experience of looking at these Nikkei puts that were basically trading for too high a price. If you price them out with Block-Scholes or something of that sort model, they're worth, they cost a lot more. So we did that as well. It works out okay.
What you just described there, is that more of a spread trade than a mean reversion trade, though?
Well, spread is usually A minus B, and in mean reversion you can go long something that's behind, so it's just an A kind of thing, just one part. So I mean, there's a bit to what you're saying, of course, but I think the major idea is that the spread is like March versus June. Okay, that's a spread. Or small caps versus large caps. That's a spread. And the mean reversion is more like, well, the stock market is going down a lot, so I'll assume that it's going to bounce and go higher. So I just do one thing. I just go long the thing. So it's a little bit different with it's one thing versus two things, I think.
Okay, and what sort of mean reversion strategies are you using today, like in the Alpha Z fund? I mean, are these based on anomalies, or are these a sort of a different category of trades?
No, I think it's based on the way the prices are in relation to historical. So if you think you're in a trading range and it's not moving much, then as you get to the bottom part of the range, you could buy. You get to the top part of the range, you sell. Okay, so that's a standard thing you can do. It's not the most powerful technique, but it's useful on occasion. Usually what happens is you do it 3 or 4 times, and then the 5th time, it goes one of the directions. So you have to account for that and make sure that in total you're ahead.
Now, William, I want to ask you, I kind of have to ask you a little bit about position sizing. You know, you and Edward Thorpe and one other gentleman all co-authored a book on the Kelly criterion. So how do you think about position sizing with your trades? Are you using Kelly criterion? Are you using a fraction of it? I mean, How do you think about position sizing?
Yeah, I mean, that's a super important point. Now, when you get into trades, the easiest thing is entering. The hardest thing is exiting, how to get out. If you're very careful, you sort of have a plan for getting out, which you may or may not actually execute. Now, in terms of size, it's all related to the volatility. So it's VIX related in terms of that. Now, full Kelly has a lot of beautiful property. The long run growth is the highest almost surely over a long period. You're ahead in the first draw on average. You're ahead after so many. But you have one problem. The Aeroprat risk aversion index is minus the second derivative over the first derivative. That's essentially zero for log, which means that it's a very risky utility function with violent swings. So that's why often people will use fractional Kelly somewhere around a half. Half is the utility function minus 1 over W. Okay, so that's there. Now, with regard to the Kelly, you can have a hard and fast rule and can do calculations on the computer of how much to bet on different things. It's basically a nonlinear programming problem. It's not a one-dimensional problem. One dimension is the edge over the odds. But in multiple dimensions, you have to solve a nonlinear program. But you can judge the fraction that seems to work for you. We have a simulation paper comparing them. It's reprinted in this book, Great Investment Ideas, which I love. It's got a lot of nice papers. It's lovely. So it's reprinted in there. And what we did is we looked at quarter Kelly, eighth and three quarters, and so forth, all these numbers, and did compare, how it evolves over time. And that's good. A very typical good choice is half Kelly. It has a fairly good characteristic. Full Kelly is useful for cases like this. Horse racing, when you're making a lot of bets similar over time, essentially an infinite sequence of similar bets. Those high-frequency traders who are doing long trades of 8 seconds, like Renaissance Medallion, they are good for the Kelly. So that's the main case when you do. In horse racing, we use full Kelly because you're making a sequence of bets. They're all kind of similar. That's the idea. If you want a large sequence of bets and they're kind of similar, then it's pretty good. It's not guaranteed to give you the exact maximum, but usually it does most of the time. And that's the crux of the letters that Paul Samuelson wrote to me, which I was very flattered. He's the top economist of the last century. And he took an interest in that. He was always very friendly to me, absolutely brilliant guy. And the most brilliant person I believe I ever had dealings with is Kenneth Arrow, who also died. He died this year. And they were both around 95. They're both absolute giants. And I was pleased to know both of them personally, which was great, and so forth. And we've lived in a period, those of us who are a little bit older, of actually knowing a lot of these people who, contributed to the field. So.
I can't remember if your name was in it, but I know Ed Thorpe and Claude Shannon and a few of those other guys from around that from that era. There's a really good book, Fortune's Formula. I mean, I'm sure you're familiar with it, and it speaks about Kelly.
I did talk to him. We talked on the phone 3 times. He's a very good writer. It's a very good book, but he doesn't understand that when you have more than one asset, you have to solve the nonlinear program to get the weights, the proper weights. But other than that, he did a very nice job, etc. Now, because of that book, Motley Fool and Morningstar, they give Kelly weights, but they're incorrect. They say one stock and tell you how much weight to give into it, and they give you another stock how much weight, but you can't actually do them one by one. You have to do it together. But other than that, it's a wonderful story, and he did a good job. He's a very good writer, and he did talk to a lot of the major players in the subject. And 3 times he called me up. We talked a bit.
That's William Poundstone you're referring to, right?
Yes, and it's another cheap paperback. What we try to do is for the people, like to read. My wife is a very good reader. Is have the books paperback, and they're not expensive, so people can get them. That's what I try to do with all the books for me.
Now, so is the Kelly criterion, is that something you use to determine your position sizing today? Like that's something you're actually implementing?
Yeah, but I'm doing it sort of in my head. See, I've been doing this for many years. I'm sort of approximating it how I feel it's going, because there's a lot of things going on. One example that Thorpe found was there's a guy called Monish Parabek, and he had the following bet with a small probability you lose all the money. With a high probability you double the money. And then with a medium probability, you more or less break even. So the question is, what's the optimal Kelly bet? Now, when you do the calculation, it's around 98% of your fortune, because the way the Kelly works is the more attractive the bet is, the more you bet. So you really pound it hard if it's good. Now, the trouble with that is if you're wrong, you lose a lot. So that's why it's so violent if you do the path. That's why a lot of people like doing half Kelly. And what's half Kelly is half of the full Kelly, and then the rest is cash. So it's a toned down version. But you don't get the great long run growth, but you get a lot more security. And McLean and I have worked a lot on that, these trade-offs between growth and security. It's just like mean variance, Harry Markowitz's trade-offs in mean variance analysis.
Well, William, just for this last part, I'd like to speak with you a little bit about your experiences in horse racing. I think that'd be really interesting to hear a bit more about. You were, just so I get the order right, you were into horse racing prior to trading, weren't you? That's where you started out.
Yes, I grew up near Saratoga Racetrack, which is one of the major. It's a track of extreme tradition, and it was near where I grew up in it's upstate New York. I grew up in the Berkshire section of Massachusetts, and I went and I started studying, and actually, I started trying to do. Picking the best horse. But then I ran into Mark Rubenstein, who, he's portfolio insurance fame, and who I knew, and we started working together, and he pushed me in the direction of looking at it like a stock market. So then, and what happened was we worked together a little bit. He did co-author one of our papers, but Don Hosh and I basically did most of it. And he went on to do other things as well. Very smart guy, and so forth. But in any event, the idea that we did in the Beat the Racetrack book, some of the books are sort of out of print, but I keep redoing parts of them, like my new book, Adventures. I have a picture book with travel all around the world, and the publisher let me have color pictures of everything. And then I talk about all the consulting and working with a variety of very interesting people over time. But anyway, the idea of the place at show system is you get probabilities from the win market, and those are correct, except they're a little bit biased. So you're correct for the bias. And then you use those probabilities for a more complex market, place and show. So you do that. And then we've expanded that to all the other kind of bets. So you basically price the bets. And I have a book on that, but I haven't finished it. I've been doing it. It's hard to finish all the books as it is. I got 2 in print just recently, the Crashes book, which I love it. It's got great stuff. And this picture book, I love it even more because it's got traveling in Afghanistan and Petra and Egypt and all sorts of places, which we were able to do as professors. It was nice. It was good. And so that was called Adventures of a Modern Renaissance Academic in Investing and Gambling. That's the official title. And the Crashes one I did with 2 other fellows. They helped me. One is in Reims, France, REIMS, which is in the Champagne district with Sebastian Leo. And the other one is Mikhail. And Mikhail's in Moscow. And I ran into Mikhail when I was giving Kelly lectures, actually, at the University of Manchester in England. He's very smart. And what Mikhail and I were working on was, you think you have a bubble. Can you get out of the bubble at a good price and a good time? So we applied this to Apple Computer, to golf courses in Japan. By the way, I once gave a talk in your lovely Australia, and they said, "Why are you interested in golf courses?" And I said, "Well, it's a small market, but it's bigger than the Australian stock market." So that kind of calmed them down, etc. But anyway, the golf courses were incredible in Japan. It was a bigger crash than even the stock market. And then we did crash of 29, crash of 87, and this sort of thing. And it's quite nice. The model sort of ascends as the bubble starts forming, and then it tops off, and then it comes down. So we did that. And the other thing we do in the book that's interesting is how many crashes are there, and how many crashes do people expect? And it turns out they expect a lot more than actually occur. A lot of brokerage firms now are giving people trouble by saying, if you have a position and if it drops 20% tomorrow, you'd be in trouble, so you can't have so many positions, or 30%. And it turns out in the history of the United States, there's only one day where it fell over 20%, and there's only 3 days where it fell 10% or more, only 3 in 117 years. So the public expects more crashes than actually occur. That's the thing. So anyway, I'm very happy with those two things. I'm glad to be done on them. And then for me, I learn a lot from the books and just go on to the next project.
And while we're talking about horse racing, with him, you've, of course, worked with one of the great names in horse racing, Bill Banter. How did you come to meet Bill, and what was that experience like?
First of all, the teams that are professional teams, and I'm actually working now to develop our own with a group of people, and it's hard, and it's a lot of work, even with a lot of human capital. Now, Banter came in. He's a former blackjack player. Many successful people in hedge funds and so forth came from a gambling background. So for me, I did horse racing. Thorpe and Blair Hull and Mick Pike, who's a guy I worked with in Nassau, and Banter, they all came from blackjack training. And so did Bill Gross, the famous bond trader. What it does is it teaches you the risks better, and taking risks and dealing with them, et cetera, because the risk is super important. Now, Banter started out and he had trouble for a couple of years. He did talk to us a bunch on the phone, and we did. And he had new ideas that he did, and he worked hard at it, and it's paid off. He's a very wealthy man. And I didn't have a lot of contact recently. His only paper that he really published, we put in our book called Efficiency of Racetrack Betting Markets, and it became a sort of a cult item. Actually, some of the copies were selling for $20,000. I didn't sell them for $20,000. I sold one to somebody in Sydney for $1,400, which is the highest I got. But anyway, but then as an academic, we like to have it used by people. So we did a second edition, and it's $70 or something. It's from World Scientific as well. So in any event, Benter did a paper in there, and he discovered certain things and got it to work. Recently, he recommended me to be in a court case. So I'm representing a fellow who paid for a good model, and it was basically stolen by somebody else. And the somebody else claims that it's a different model, but we showed that it's actually the same. So that's still continuing, and these court cases seem to last forever. It's been going for about 4 years. So I'm doing that as a witness, and Mentor was involved with that. And he, of course, made major contributions. He showed that you could take a sport like horse racing, where it's tough, and come from a different country and make it successful. So he did that. At the moment, there's about 8 or 10 teams around the world. The most important and successful one is actually in Australia, in Sydney.
Who's that?
It's Jelko.
Oh, okay.
He's a well-known guy. There are two of them. There's the fellow who wrote the programs. His name is Walsh. And apparently there's a huge museum that they built in Tasmania.
That's right, yeah.
From this. And he was very important in writing the programs. And I have met with him. And there's a lot of betting in Australia. Very, very serious bettors. And rather good at it. So, he's a top team. And they bet a lot of money, and they win this consistently, and they're all over the world.
Do you think it's easier to make money in things such as horse racing or NFL compared to financial markets?
The stock markets are easier, definitely.
How come?
Well, the transactions costs are lowest. You trade a futures contract, and you do it, and you collect the $100,000 worth of money, and it costs you $10 to make the transaction. In the horse racing, you have to pay like 10 or 15%, even with the rebate. We have rebate now where you get some of the money back. So instead of having like a 15% commission transaction cost, it's more like 10 or 11 or 12. So it's lower, but it's still, it's tougher. So these teams, to be successful, usually require about $1 million worth of research and a couple of years or longer to get going. So it's a major impact, and you need a lot of different things. And there's also competition because the different teams are competing against each other, making bets at the last minute. The racing is a lot of fun. It's a lot of fun, and the teams have been able to be successful and win, but it's work. It's harder, certainly harder.
Why are you talking about these people in terms of teams? Like, is it not possible for someone to do this as an individual? Does that make it even more difficult?
It's pretty hard as an individual because there's a lot of aspects. You have the computer program. You have the execution. You have collection of the data. You have watching the horses. There's lots of different features. Now, in Hong Kong, they have mostly Australian geldings. So it's a kind of a homogeneous group of the same horses running all the time. And the Hong Kong Jockey Club is very sophisticated and keeps a lot of records and a lot of information. Now, if you go to other places, like, for example, the United States, you have a race, say, at Belmont. It's a mile race. So horse number 1 is running 6 furlong races. He's now doing 1 mile. Horse number 2 is shipped from France and has never run on, say it's a grass race, never run on the grass. Horse number 3 is shipping from California and so forth, you know. So they're coming from different places and different things, and it's very hard to evaluate all of them. Like this year in the United States, in the Triple Crown races, the 3-year-olds, there's about 8 horses that would rate as B- quality. Nobody's an A or nobody's an A+. They're just, you know, any of the 8 could win any given race. And we saw that this week. We had a race called the Jim Dandy, and then we had a race called the Haskell. And horses that were not expected to win did win. So it's tricky. It's harder. It's certainly harder. It has a lot of charm to it, though, and there is a lot of computerized work. We have programs for all the bets, so we have that, and other people have them as well. You know, to calculate the sizing, as you mentioned, Kelly, and then also how to generate probabilities and things of that sort.
One of the things that strikes me is why it could possibly be easier to make money in sports betting or bet on horse races or whatever it may be compared to financial markets is, you know, the exact kind of payout and exact risk going into, you know, any bet. And I think you kind of mentioned this actually when we first started speaking. You know, financial markets are continually moving, whereas a race has a definitive start and finish point, and you know the exact payout odds. So I feel like the math for it would possibly be a bit easier to work out. But, I mean, is there any merit to that?
Well, yes. But so the way I'd sort of argue it, Aaron, is that in sports betting, you have a more sophisticated group of bettors. Like in the stock market, the vast majority are really not thinking about it, don't know much about it, and are just playing around. Okay. In sports betting, basically everybody who does it is pretty serious. So the quality of the competition is tougher in those things. So, but I mean, certain areas of the stock market, there's a high level of expertise, like, you know, different kinds of program trading or fast trading, this sort of thing. You mentioned other people like Blair Hull and these people. Some of them are doing very fast trading. I did talk with Jim Simons, who was the head of the Renaissance Medallion, which is the number one hedge fund ever. Phenomenal record. And for them, a long trade was 8 seconds, you know. So they're, you know, doing constantly fast trades. So that's where Kelly is actually very valuable to using that situation. But the rank and file in the stock market is not as sophisticated as the sports bettors. At least my opinion. No, somebody can argue against that, but that's what I think.
I mean, I was always had the kind of assumption that it was much the other way around, because, you know, you hear about all these firms these days which are hiring PhDs and that sort of thing, and then I think about some of my mates who are betting on sports and just pretty much just throwing their money away. It's kind of silly.
Well, I have to tell you, in terms of that. See, for me, I got to be rated the number one futures trader in the U.S., and I am traveling around the world, giving lectures, giving trades on the phone. I'm not sitting in an office 24 hours a day at a computer with a computerized model as people are. But the thing is, Aaron, I taught part-time at Oxford for 9 years. Now, I was a fellow the first year, and then I taught after. The thing was that you had at Oxford is really smart kids. They're really smart, but they don't have much experience in the know-how of the markets. So I like to think that they're so smart they can lose money intelligently. These firms are filled with these kinds of guys, and these are very high quality kids. They're not kids; they're master students, but they're very talented, and some of them I'm sure are great traders, but on average, maybe not so much. So my experience is that people like to give the money to these big firms because it sounds like there's more sophisticated, but in fact, they have actually poorer records than even people like myself. But then I have to work harder at it, though. I work pretty hard to do it. I have people who help me. It's not just me. So they help me, et cetera. But I can do it, et cetera. But the thing is, I've actually written the books and studied them, in terms of understanding things. Whereas a lot of the people are just, they've been indoctrinated that you can't beat the market or something like that. And, it sort of hurts their performance. So just because it's a big firm with a big name, don't necessarily think that they're going to have top people running your portfolio. They may have top people running somebody's portfolio, but it may not be yours. So you have to be careful about that.
Yeah, that's a fair point. Actually, that's a good point.
Yeah,
and not to mention you're also a smart guy yourself, William.
Yeah.
So anyway, let's cut this off here. I know you've got to run in a minute. Absolute pleasure speaking with you. Thanks a lot for doing this.
Yeah, thank you very much. Nice to talk. Good luck with all your activities and so forth. So the only thing I'd recommend to people, or what I do, is study and then start doing it, but with small amounts of money, very small. You can do trading with a very small amount of money and get your feet wet and sort of thinking about things and study the books. And I mean, I have the books and so forth. There's about 6 or 7 for me. They'll be on Amazon or World Scientific Web, their paper, and other people have things, and find things that you like that are useful and try it and get your own thing, and be very careful of not over betting. To always try to not over bet, because it's very easy to get in the situation where you have done it and all of a sudden the ratios change and you're over betting. Very good. Thanks, Aaron, for having me on. That sounds great.
Now, William, just one last thing. You have a website as well. If anyone wants to find your books, you mentioned they're on Amazon, but yeah, also on your website.
It's www.williamtzimba.com, my name. And that lists papers and books and talks and things of that sort. And I do the horse racing, which I like a lot. And then the stock market stuff and sports betting, etc. And I've been actually getting now into buying racehorses, which is part of it, which is another game that's very interesting.
Well, we might have to save that conversation for another day. But William, it's been an absolute pleasure speaking with you. Thank you very much for doing this.
Very good. Very good.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, traders and investors from all around the globe? Thank you very much for plugging in to this episode of Chat with Traders podcast, or more specifically, episode 138. Now, with me on this episode, I have Kevin Muir. Now, I was first made aware of Kevin thanks to my buddy Ari Pine, who, of course, was on the podcast for episode 61. So Ari is a reader of Kevin's blog, The Macro Tourist. And Ari has suggested to me numerous times that I should try to get Kevin on the podcast. I guess I've been a little bit resistant to the idea because Kevin is, of course, a global macro trader. And I feel as though I perhaps struggle to ask the right questions when it comes to global macro because it's something I'm quite disconnected from. But Ari had also mentioned to me that Kevin is quite a short-term trader also. So that makes Kevin unique in many ways. The fact that on one hand, he's a very short-term day trader, and on the other, he's a long-term, big-picture global macro trader. Anyway, I reached out to Kevin and we set up a call the other week just to have a quick chat. And it didn't take long for me to realize that I absolutely had to get Kevin on the podcast. I knew he would make a brilliant guest, and I'm sure you'll agree with me after having heard this episode out. So anyway, we set it up and we made it happen, and here we are. So a little bit of background about Kevin is he was a proprietary derivatives trader for RBC, which is a bank in Canada. And that was his role for a few years during the 90s. And then ever since then, he did that for a number of years, but then ever since, he's been out trading on his own as an independent trader. And one of the things I admire about Kevin and I have a respect for is the fact that he doesn't specialize in one particular thing. And he kind of goes against the grain in that regard because it's very counter to what many people advise or what many traders would advise to upcoming traders. And what I mean by that is, Kevin says that he never knows next year where he's going to make his money. And he describes it as he's constantly in search of the next great trade. And just as an example, you'll hear him say during this episode is that he's done everything from risk arbitrage to mining Bitcoin to convertible bonds to day trading the S&P. So that's something we spend quite a bit of time discussing. In addition to that, we also talk about a few of the key lessons he learned from his time as a prop trader on the RBC desk. Obviously, he learned a lot during that time, so you'll hear about some of the things he picked up there. We talk about how he balances between being an intraday trader and also being a global macro trader. And to close things out, Kevin actually shares a tale about the discovery of oil in Norway. Now, I can appreciate that might sound a little bit strange, but I think you'll really enjoy it. I think the story brilliantly encapsulates the mindset of a great trader, so stick around for that. Now, I do also want to mention that on the 29th of August, which is a Tuesday in the evening, I'll be doing a live podcast in Sydney. Okay, so if you're in Sydney or you're in the area, I hope to see you there because it's going to be a really great evening. I'll also be putting on beers and pizza for everyone. And it's going to be a lot of fun. Tickets are only $15. They're very cheap, and that's made possible thanks to the support of our sponsor, Trading Technologies. TradingTechnologies.com if you want to find out more about them. They obviously are the masters behind the widely popular futures trading platform. So, check them out. But tickets are available at chatwithtraders.com/Sydney. Okay. All the details about the event, including the two traders who I'll be interviewing. You can find out more information about them there. chatwithtraders.com/Sydney. All right, let's cut to the conversation I had with Kevin Muir now. Please enjoy it. Here we go. I was actually watching a documentary over the weekend, and I thought of you, funny enough. It was a documentary called Betting on Zero. Have you heard of it?
No, I haven't. What's it about?
It's on Netflix at the moment. It's the story of Herbalife, about Bill Ackman taking a massive short position on Herbalife, ideally wanting to see the price of the stock fall. And at one point, Carl Icahn steps in and takes a massive long position, purely because the two have beef with each other. Although Carl says he loves the company, Bill says he hates it. So it was it was an interesting documentary.
It sounds like a great one. You know what? I'll put it on my Netflix list.
For sure. I mean, you would have heard of that whole saga before, right?
Oh, for sure. Yeah. No, it was, and even before Herbalife, I believe the two of them got on a fight on CNBC. And it was kind of like 5 minutes of them just yelling at each other. And it was kind of the craziest financial TV that you've ever seen.
I'm going to have to look that up. I'm sure there's a video of that online somewhere.
Yeah. Well, I'll send it to you afterwards. It's unbelievable. And it's just, maybe it was just at the start of that, but you are correct that they had bad blood about a previous transaction that they had done.
Yeah, they covered that in the documentary. I can't remember which way it went, but one of them sued the other for something like $10 million over an investment that they were somewhat, I think, partners in. I might have that wrong, but anyway, something happened between the two and they had a big falling out, and then one tried to sue the other, and it got pretty messy. But it was just pretty funny. I mean, it was just like these two billionaire fund managers pretty much just playing games.
Oh, yeah. And they're two of the biggest jerks around, basically. I'm not sure who's the bigger jerk. Like, it's a tough call.
Right. So, Kevin, let's talk a bit about your backstory. I know that there's a few interesting things we can get into there. So tell us about some of the things you did leading up to the point before you actually became a trader. So you became a trader on an institutional desk, but I know you did a few different things prior to that. Do you mind stepping us through those?
Yeah, sure. So when I was going to university, I had always been interested in the markets. So when I was looking for a job to pick up a little extra money, I got a job at an investor line, which is a discount stock brokerage division of Bank of Montreal. And this was kind of in the early 90s, and they needed someone to answer the phones at night and give people quotes, because back then there was no other ways to get quotes. And so I started working kind of 4 to 8 every night. And then things got busy, and next thing I knew, they asked me if I could come in during the day, and I started rearranging my timetable for school so that I could work during the day and go to school at night. And one thing led to another, and kind of before I knew it, I was the manager, of this little investor line, this stock brokerage, this discount stock brokerage division that was kind of growing by leaps and bounds. And I was going through there, and I was proceeding. I got my manager designation and stuff, and I realized that this isn't really what I wanted. So I actually quit, and I picked up and I got a job in Chicago in the pits because, I'd always dreamed about working down in the pits and, how romantic it was, screaming out bids and offers all day. And I got down there and unfortunately, although I love Chicago and it's a terrific city and stuff, I just did not like working in the pits. It just wasn't for me. So I quickly packed up and actually quit that job and came back to Toronto. And when I was in Toronto, I basically went and decided that I wanted to be on an institutional desk. And so what I did was I picked the 5 best banks, or it was actually 4 banks and 1 broker. And I put together my resume and I sent them off to the head trader of each of them. And I followed up with a phone call and, a couple of them were nice and spoke to me. One of them hung up on my face. And then another one asked me to come in and for an interview. And sure enough, it was RBC Dominion Securities, which was generally considered the best bank at the time. And I got in and I got a job on the institutional desk. And the reason I got the job was because although there was a lot of traders who had more experience than me, and there was a lot of computer guys that had more experience than me, there was very few people at the time that had kind of a mixture of both. And this was just at the forefront of kind of computerized trading. And what RBC Dominion Securities needed was, a younger person that could actually handle their program trading. So I was kind of lucky in that I was given an opportunity from a very young age. I still hadn't got my degree and, I hadn't finished university. And there I was already on the institutional desk handling institutional orders because basically it was a new environment that not many people kind of had seen. So we were making it up as we went along. And, a young guy was the perfect fit.
And just so we can put a little bit of context around this, what year was that when you got that job, roughly?
So I got that job in 93, I think. I got it in the early 90s. So it was just maybe it was 94, but it was early 90s. And at the time, it was kind of funny because there was still a floor. Guys were still trading by hand. There was in Canada, we were a little more automated than the US, but a lot of the transactions were still, written out, tickets time stamped, and it was executed that way. And these baskets that we started trading using the machine, they were something that the other traders kind of didn't like necessarily at first. So there was a fair amount of friction as, these baskets would come rifling down the pipe and, execute kind of 35 or 100 or 300 orders at a time. And these traders had never seen anything like this. So it was kind of it was an exciting time to be, working on the institutional desk.
Do you recall what it was that made you want to become a trader in the first place?
Yeah. My mom always wanted me to be a lawyer, and my dad always laughed. I was lucky enough. My dad actually was a research director, so I kind of grew up learning about stocks, talking about stocks at the dinner table. And although he was a research director, he kind of made me laugh because he actually traded a lot of penny stocks, Vancouver penny stocks, and he was quite a risk taker. But he always kind of laughed and said that he knew I was going to be a trader, even from when I was younger, because I would bring up the board games and go play game. All I wanted to do was play games. So I, had the typical kind of experiences that a lot of young traders did. I decided that I was going to count cards, and I flew down to, Atlantic City to go become my card counter. And I used to have I had stint, going to the racetrack and, trying the handicapping and stuff. So I've always liked games, and it was just kind of something that I knew I wanted to do. So for me, it was kind of never in doubt that that's what I wanted to do.
Did you have much success counting cards and betting on horses?
So the counting cards, unfortunately, you got to count a lot of cards and flying down after kind of work for the night and then trying to, catch the red eye or, not even the red eye, the early morning flight back home and then working. You really have to be living there. So I think I kind of broke even, but, after all the expenses and the time, it really wasn't worth it. The horses, it was probably a little volatile if I had to say, as most kind of young traders or gamblers of any sort, you always take too much risk and you don't really understand. So I can't remember any specifics, but it was just once I figured out that there was a better game out there, meaning trading, I kind of put all those other ones to the side and kind of focused on that.
Okay. Now, as we're talking about your first job as a trader specifically, I'm pretty sure you have an interesting story which you might be able to share. A story which kind of took place within the first couple of weeks of you picking up this job. Birds for the bill. Does that sound familiar?
Oh yeah. So my birds for the bill. Yeah. So when I got my job, the fellows asked me how much I wanted to make, and I, like I said, I knew it was a great opportunity working for this firm, and I just said, I don't care as long as I'm paid when I contribute. So they immediately signed me up. I think I was making $24,000. So I wasn't making very much. And, I got on the desk and it's a lot of fun and I'm having a great time. And a couple weeks in, my boss says to me, you want to go drinking? And I said, of course I want to go drinking. Let's go. So we head down to the bar down below and we're there and we're drinking all night. And there's a whole cast of characters. There's some pre-bond kind of broker guys. There's some guys from the bond desk. There's all these kind of exciting institutional guys there. And I'm just like a pig in crap, like having a great time of my life. And kind of, towards the end of the night, some guy decides he's going to go home and he hands my boss kind of like $60 for his share of drinking. And my boss says, no, birds for the bill. And everyone's like, oh, okay. And he says, Kevin, are you in? I go, of course I'm in. Not knowing what birds for the bill is, but this is my boss and I don't want to disappoint him. So he then proceeds to explain the game to me, and basically what it is, it's kind of a version of liar's poker, but it's you put anywhere from 0 to 3 coins in your hand, and then you commit to that, and you put your fist over it so nobody knows how many coins you have in your hand, and everyone puts them out into the center, and then everyone collectively takes a turn on guessing how many coins in total the group has. If you get the number right, you're out, and therefore you don't have to pay the bill. So I have a look at this, and the bill I can't remember what the number was, but it was a big number for me. I think it was more than my paycheck for the 2 weeks that I had already worked. And the really scary thing was that I don't think I had enough in my bank account to cover it at the time. So I kind of laughed, but I looked around. I said, "There's 8 guys. What are the chances I'm going to lose this? I'm going to get the number and I'll be able to get out." And so we go along, I do one guy goes out, another guy goes out, another guy goes out. Next thing you know, we're down and there's like 4 of us and I'm thinking, oh geez, I'm sweating a little and stuff. And then all of a sudden we get down and it's just me and my boss. And I'm like, holy smokes. So either I'm going to beat my boss and I'm going to have to pay this bill that I, can't afford and I'm going to be embarrassed and have to ask it, or I'm going to basically stuck him with the bill. So luckily for me, I actually won and my boss picked up the bill and he was a nice guy about it and he kind of laughed, but sure, it was a lot of sweating for me as a young kid.
Close call. Did you ever play again after that?
Oh yeah, it became kind of a staple, and as in liar's poker, you start to get better at bluffing and double bluffing, and it's not quite as complicated as the liar's poker because there's obviously a lot more digits in terms of when you're using dollar bills, but there's still a lot of strategy. And the only thing that we kind of laugh about is it seems like whoever was the one who actually recommended or said let's play birds for the bill, that was always the person who ended up losing. So it was kind of we were always kind of quiet. Nobody wanted to say play birds for the bill because it was always kind of like a bad luck omen. Like you wanted to gamble too much and the market gods would punish you by sticking you with the bill.
That's funny. So I want to go back to a point you made earlier when you were talking about how you were almost in some ways at the forefront of technology coming into the Canadian marketplace. So how did you find the other traders dealt with this? Like for you, you were just new into that role and so you didn't really know any different in some ways. But, for the other traders who I presume had been there for a lot longer and did you find that some of them, and I think you might have already hinted at this a little bit, but was there a bit of pushback from those traders and how did they adapt? I mean, what kind of impact did that have on the desk as a whole?
So you're absolutely correct. It had a huge impact. And it was kind of funny, though. It had a huge impact, but the traders adapted quicker than you would guess. But at the beginning, there was a lot of pushback. So a lot of it so one of the things that we did was we actually used to price baskets. And so a client would win oftentimes in the institutional equity world, the clients win mandates from pension plans or from some sort of other client, and they actually they change their provider, meaning like their money manager. So if money manager like ABC, wins a mandate that used to be held by money manager XYZ, they just take their product, they just take the shares and they hand them to ABC and say, here, this is yours to manage. But a lot of these money managers didn't want to own those shares. So what they would do is they would phone us up and they would give us this list, and it would basically be a portfolio of the previous money manager's stocks. And then there would be on the other side of the list, there would be a portfolio of that they wanted to buy, like the new portfolio that they wanted to do. So we were at RBCDS, we were actually one of the big basket traders, and we would offer liability markets on these huge baskets of with the whole portfolio would switch over. And so when I first got there, we used to go and win these things, and then we used to print them by hand, meaning that so we would give them a price, and then my job was to go and actually go onto the floor and or not the floor, but through the machine and basically put up the trade one by one. And it just now it just blows your mind that anyone would do this. But back then, that's just how it worked. So I kind of came to the conclusion after, sitting there for a few months that we didn't need to do this. We could just load it in a program and just basically put the cross up on the exchange instantaneously. And I remember when I first did it, the pushback was huge, and all these guys, these old, I call them tradosauruses, were mad about this, they were mad about that, it didn't work because they wanted a specific price on this, and, they didn't understand we were doing it as a basket. But eventually we got kind of through that. But the funny part of the story was that kind of, it was like a couple months into doing the new technique, the computer broke, or I can't remember what happened. And, I was forced to do it the old way, to trade it by hand. And the complaining was just as loud when I had to go back the old way as it was when I kind of tried to introduce the computerized way. So I was kind of shocked. So although they complained a lot, traders adapt, and they did adapt, and they did change their behavior, and they kind of figured out ways to make money and to deal with the new reality.
Right. So the lesson is some people just like to complain.
Well, it's true, and there's at times that the exchanges and trading changes more quickly than others, and I would say that HFT today is an example of there's a lot of traders that complain about it, and there's no doubt in my mind that HFT and VWAP trading and TWAP trading has changed the nature of trading. And you can complain about it, and you can pine about the old days, or you can just adapt. And I would encourage everyone to just you can kind of reminisce about the old days, but it's not going to help you, and it's not going to help your P&L. So you better just figure out how to make money today.
Absolutely. I mean, that's something which has really stood out to me from a lot of the really great traders, is their ability to embrace new technology and keep up with current times and what's happening in the now, and, not get bogged down and stuck in doing things the old way, because that's how it's always been done. They're very innovative in some ways and very creative as well.
Yeah, I'll tell you, what, when I first came to my job on the institutional desk, I used to listen to all these stories, and I used to go, oh, if I had only been here 5 years ago or 10 years ago, because these stories always sounded so great, and it would always seem like no matter what, back then they made more money because of this, and this was easy. And my point is that it's always easy in hindsight. And there's always somebody making money today. It's difficult to kind of realize it at the time. And it always looks so easy in hindsight, but the reality is that at the time it's difficult. So the example I use is that, HFT, well, you could sit and complain about it, or you could go and automate your kind of trading. And a lot of guys did. A lot of guys adapted. And it's not like there weren't guys that you don't need to be doing HFT, but there's a lot of guys who have computerized their trading and have adapted and made themselves a lot of money. And there's others, who have complained about it. But it always looks easier in hindsight than it is today.
Exactly. Yeah, that's a really good point you bring up. And it kind of, I guess I've had similar thoughts in the past where, so even some of the guests who I've brought on this podcast, I mean, let's just pick Ed Thorpe, for example. I mean, an absolutely phenomenal story of a life that he's lived. It's all very well and good to hear about that now, but you have to think there's probably someone who's actually living out a tale just as great that we're still yet to hear about. It hasn't really come out yet in some ways, if that makes sense.
Yeah, no, you're absolutely correct. There's going to be the next Ed Thorpe is out there today doing that. And you're going to be interviewing him kind of 10, 15, 20 years from now. And it's going to seem so easy at the time.
So that is a really great lesson that you've picked up from working on an institutional desk. I mean, is there any other lessons which come to mind?
Well, yeah, one of the big ones that I kind of repeat often is the fact that what's obvious is kind of useless. So I'll give you an example. When I was working on the institutional desk, there was a day when there was an IPO, and on the day of an IPO, there's a lot of trading often in the stocks, and the way an institutional desk works is that I guess it doesn't work as much this anymore because people don't trade principal as much. But back then, there was a lot. We would actually call markets in the stocks, like for our institutional type clients. So we would look at the board, meaning the quote on the exchange. And so if we had a stock that was like $8 bid to 8 and an eighth, we might go around calling a market and saying we're 8 bid, 500,000, and we're 8 and an eighth offer 250,000. And we would be calling markets like this. So on a day of an IPO, there's a lot of trading. So there's a lot of pressure for the traders to kind of call good markets and to get involved and to make trade for the firm. Because ultimately, as an institutional trader, there's prop traders, but most of the traders are actually agency traders / prop traders that are trying to make commission dollars and trying to put as many trades on the tape as they can. So on this day, it was a great lesson, and it's something that's kind of stuck in my mind forever. Is that one of my senior traders was out, and he was calling a market, and he would go around, and when I say call a market, he would basically put out on his squawk box, what the actual quote was that he was willing to buy and offer, and then all the institutional traders would be phoning their clients, telling them what our market was, and if the client liked us, he would give us a trade, or if the client wanted to respond, or maybe they would give us an offer that we would work or bid. But anyway, so he would go around and he said things like, so I think the stock was trading like $8, and so he would go out and go, I'm $8 bid, $500,000, and I'm offering $250 at 8 and an eighth. Well, my senior boss that didn't trade very much, but was kind of somebody I learned a lot from. I remember him coming in and saying, "There's no point in doing that. Everyone's out calling that market. Let me take over." And so I watched him. And so what he did was he immediately, instead of calling a market, he just stopped calling a market, and he basically put $1 million to sell at 8 and an eighth. So he put it out on the board out loud so that everyone could see it. And then he went and he sold $500,000 on the board, meaning he hit the bid, and he sold it at $8. So he hit the bid, and it's still $8 bid, and it's offered at 8 and an eighth. And whereas before it was kind of bid for $900,000, now all of a sudden it's only bid for $400,000. So he watches the tape a little bit. He's looking for things. He's watching the different prints that are going up. Then he kind of sees his opportunity, and instead, what he does is he offers $1.4 million at $8. So now all of a sudden, instead of the quote being $8 bid at 8 and an eighth offered, it's all of a sudden 7 and 7/8 bid at $8 offered, because he's now the offering. So now all of a sudden he's changed the quote. And so what he then does is he finally calls a market and he tells our clients, he says, I'm 7 and 7/8 bid. He says, I'm $8 bid, 2 million shares, meaning he's willing to pay the offering, which is like on the board, even though it's his, he's willing to pay the offering, which is $8. And all of a sudden clients that basically, had been hoping to sell on the offering, they now get a chance to sell on the offering. So he goes, I'm $8 bid, 2 million. So all of a sudden, all of our institutional traders call around and we find the big seller. So the seller comes back and says, sold you 2 million at $8. Where are you bid for another 2 million? And he goes, I'm 7 and 7/8 bid 2 million, but let me work it. And then we proceeded to do the trades for the rest of the day. But the important part to realize is that until he moved the quote, until he took some chance and he actually took some risk, there was no point in offering what everybody else offered out there. It was too easy. Like the clients weren't going to go and trade with us, but he made it so that the clients had to trade with us because we were willing to pay the offering price. And that's kind of the lesson that I learned, is what's obvious is kind of useless. So it was calling it like a 7 7/8 market to $8 was not really that, impressive, but willing to move the quote and then say you're going to pay the offering for $2 million, that was like true genius.
So essentially, if we had to summarize that, it's about being one step ahead of the next person, really?
Yeah, you're absolutely correct. That it's just kind of that what's obvious, like if everybody's doing something, you're not going to make any money doing the same thing. And you need to kind of think one step ahead.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Can you think of another example, perhaps more recently, on where I guess this lesson has been helpful? Like it's, you've been, how do I say this? You've almost been willing to follow the herd into something, but then you've almost remembered this lesson in some ways about, what's obvious is useless.
Yeah, like this whole idea of the bears that have been trying to short the stock market the whole way up. Like I wrote a piece about how it's so easy to write a bearish piece. Like if you want to get attention, all you need to do is write a bearish piece, and people will flock all over you. Like and they'll retweet it, and they'll say how smart you are, and you'll seem like a genius. But it's actually it's too easy to write the bearish pieces, and it's actually much more difficult to stand in there and say I'm bullish, because don't get me wrong, I'm not bullish because if I were to be bullish on the stock market, it's not because I think that everything's great. It's just that I understand the dynamics, the cash flow, the situation, the flow of funds situation that might cause the stock market to go up. But what the hard trade is to go up and say, yes, I know the stock market's overvalued, but I think it can keep rising. And it's difficult, but it's what's obvious is often wrong. And in fact, more and more, I found that when all the hedge funds go one way, like when you go and you start looking at the commitment of traders reports, and they're all getting bearish on the euro, or they're getting bullish on gold, or bearish on that. In this day and age of limited alpha, it's like the worst thing you can do is to go along with their trades. It's hazardous to your financial health. You almost have to. They have almost become the dumb money that you need to fade.
What are these commitment of trades reports?
The futures exchange is always they classify different users in different ways. So a farmer would be a hedger. So like if a farmer goes out and sells wheat, he's considered a hedger. If I go buy wheat, I'm considered a speculator. So they kind of, they classify the traders in different ways, and then they actually provide the data every Friday at 3:00, and you can have a look and see which way the speculators are positioned in every futures contract. So it's a way to measure sentiment. And you can get a good idea. And there's other things like I know some of the foreign exchange firms will also offer retail sentiment. Like they'll actually tell you what their clients are leaning. Like they'll say the retail is long the pound, short the euro, long the yen. And so there's different ways to measure sentiments. It's just that the CFTC COT report is often one of the more popular ones.
Okay, cool. Now let's speak a bit about, I think it was around about 2000 when you went out on your own. So you went out trading. I think there was also you and a buddy of yours who you kind of teamed up in some ways and were just trading your own book. How did you guys go doing that? And what were some of the big differences you noticed from previously trading on an institutional desk to now trading your own book? Like I presume there were some challenges that came along with this.
Right. So let's just back up a little bit, because when I first started at RBC Dominion Securities, I was purely kind of an agency trader, meaning that I executed orders on behalf of clients. Gradually, I kind of did more things where I would trade proprietary, mean trading on behalf of the bank. Kind of within a couple of years, I had kind of transitioned from all the way from an agency trader to a full-time, what they like call a prop trader.